If you are just tuning in, my name is Jay Martin. I am an investor and the CEO of Cambridge House. Now, what we're doing today is diving deep into a handful of resource investment opportunities, talking to the company CEOs, and in addition, stress testing our investment ideas and strategies with some of the most prolific money managers that I know in the business. Now, the reason that I do this is because I'm an investor first, and I'm trying to grow my portfolio. In addition, I'm trying to identify blind spots I may have that would be compromising my decision making. I do this through conversation with industry personalities and company CEOs right here on the channel. Now, today we have a killer lineup of amazing content, and the whole agenda is right beneath this video in that YouTube description. Check it out, stick around. I'll be active in the live chat. Drop me a line, say hi. Please hit subscribe to stay tuned with what we're up to at Cambridge House, and enjoy. What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome. Okay guys, Jay Martin here, CEO of Cambridge House, and I am right now joined by Minister Ranj, the Deputy Premier of the Yukon. He's the Minister of Energy, Mines and Resources, the Minister of Economic Development, and the Minister responsible for the Yukon Development Corporation and the Yukon Energy Corporation. I'm also joined by Ann Turner, the Executive Director of Invest Yukon and our Canadian regional partner here at Cambridge House. How are you doing?
Great, Jay. Good to see you.
Excellent, Jay. Thanks for having us.
Good to see you both. So I'm excited to jump into a handful of topics here. We record in the last week, I think 50 conversations, all focused on the resource sector, and jurisdiction has become one of the underlying themes with anybody I'm talking to. It's far more relevant to a resource investor than it used to be. So 2020 was a hot market in the commodity sector, but like rife with complications operationally, financially, et cetera. Yukon had a banner year. And so I want to jump into some of the performance highlights that you could showcase, and then and any specific stories that come to mind that you think investors should be spending time looking at. And Ranj, maybe I'll start with you, hand it over to you to begin.
Sure. Yeah, I mean, 2020, of course, what a year. So much uncertainty going into the early part, just finishing Q1. We all came back from PDAC and quickly found out that the world was changing. What we saw, which was a pleasant surprise, was this real growth in commodity prices. And for us, a destination for gold investment, as well as silver and copper. But what we quickly found out is that we had to work very closely with industry to ensure that we came up with plans and opportunities to make sure that we had exploration happening, because all of a sudden there was a huge amount of interest. More growth than we thought we were going to see going into the start of the year. Right. And at the same time, we had operational mines that we had to support. So, our team on the ground, the government works very closely with industry, and really that's what it was, day to day, making sure that we had alternative isolation planning in place. We had exploration teams out in the field, and that we continued to see Victoria Gold, as well as Minto on the copper side, continue to have a healthy staff and continue to extract.
Yeah, Victoria Gold being Canada's newest producing gold mine. So get into the details a little bit for me. What sort of government initiatives? I mean, because that's quite the situation to manage from your standpoint, right? You've got some very important businesses in your region and unprecedented complications that no one's ever managed before. So walk us through some of the initiatives that you took in that scenario to assist Victoria Gold, Alexco, et cetera, the producing mines in the Yukon.
Yeah, we worked extremely closely with all of these different companies. When it came to really looking at these different isolation plans, we needed to still ensure that we had workers on site. Other parts of Canada shut their mines down. We kept our mines going. To date, we have had no any challenges with health on site of any of those mines. They were leaders in how they put together best practices to keep their staff healthy. There's 2 jurisdictions in this country right now, provinces or territories, that when you reflect on 2020 that had positive GDP growth. And we're one of them. So, it made a huge impact to our economy. And I think Yukoners saw that. I would break it into 3 categories, Jay. We had the exploration side of things where we worked directly with those companies and the sector to ensure that we could get people on site. We got them out to the field. We had the chief medical officer reviewing their isolation planning, which gave us sort of different opportunities and tools to get people out. Same thing we did with Minto and with Victoria Gold. So really hand in hand, making sure that we worked with the communities that they operate in, making sure there's flow of communication all the time. So all the stakeholders that were involved understood what was happening. So I think that's part of it. And then on the placer mining side, which was early in the season, not something that people see across this country, but a banner year, the most, from a perspective of value of gold taken out. And so all of those operations that were underway continue to shore up our economy. Couple of 2 or 3 things that we did, I think that were, they were best practices in this country. We were out of the gates first on making sure that people could take a bit of time off with financial support to be tested if they needed to. Right. That's something that the federal government essentially looked at our program and adopted. We were first out with a business relief program. So early on, we shored up and took care of all of the fixed expenses that companies had in our territory. We had 500 clients. That was something that, again, looks as best practices for the country. So what that meant was that the service sector that supports the industry were all in place. They were healthy by the time activity began. We made sure that our drilling companies, our expediting companies, were all looked after in Q2. So by the time a late season started, they were ready to deploy. So I think that was also key. And then really just working with individuals, depending on, we put some money in place to shore up some of our frontline workers as well. And okay. There's ancillary benefit of that, really, to make sure our economy was still moving and that these companies, whether it's on the exploration side or on the production side, had access to all the things they need within their supply chain. So I think those are some things that, when we look back and reflect on what happened, they were the right moves, and they certainly helped us to have a foundation in place to have the season that we did. And now we're really excited about 2021.
Awesome. Well, yeah, the proof's in the operation, right? I mean, that's pretty amazing how many, the lack of missed days that your company's experienced compared to anywhere else on the planet, truthfully. And I'd love to pass the puck to you and just talk about some of the activity that you're seeing in the Yukon right now, because maybe historically people associate the Yukon with gold, but it's not so much the case, right? You've got producing gold, silver, and copper mines. So talking about why investors, de-risking is key point number 1. We talked about that, tons of government support. But why should investors look to the Yukon and the variety of projects, exploration, developments, and production that are running right now?
Thanks, Jay. Well, I feel like you built in the answer a little bit there for me, and it is the variety. It's really great that our connection and the thing that we're known for is the gold rush. It's a really beautiful story going back 120 years, and we love that. But what you take from that to today, 120 plus years later, is the diversity of the minerals, and that it is underexplored. And you're in a space where you've got the right ecosystem for exploration to advance projects, to see companies move into production in a whole host of minerals. And I just think it's a very exciting position to be in at the end of 2020, challenging year for everyone, and start 2021 with 3 operating mines. It's been a little while since that. And the 3 operating mines are Canada's newest gold mine, a copper gold mine, and then, a premium silver mine. So, that right there just says, different scale in all these projects, different operation styles, different capacity, and different mineralogy. And they all move forward, move through the system. And that's a pretty exciting place. But I think that's the tick box that you're looking for, right? Is that these projects could move through the system and get to place and be in such a positive place for investors kicking off 2021.
Right. Okay. Now, actually, something else that just came to mind, the most important resource of a resource company isn't always the resource, right? It's capital and the people. right? And one thing I've noticed as we're looking at the variety of companies up in the Yukon, whether it's Victoria, Alexco, or down to the exploration stage like Banyan, there's a lot of crossover in the boards, I've noticed, right? There's a lot of communal support among these companies, which has got to be a huge asset. So I'd love you to touch on that, and then maybe expand to how does Invest Yukon support these companies, and what do you provide?
Yeah, if I could point to one thing that I think is Yukon's greatest competitive advantage, it's our partnerships. And you see it across the board, whether it's the foundation between governments at a territorial, federal, and First Nation or Indigenous position that we grow from. But, you know, the collaboration that you see between companies, I think, is unprecedented in almost any other jurisdiction. You know, these are people that are friends and colleagues. They trust each other. They get advice from each other. They lend each other equipment or rib each other when they're like, man, I need that drill on my site. Like right now, can I get an extra one? Right. And so when you've got that kind of collaboration, you gain better understanding of the geology. You have better relationships with the supply service that supports the sector. And you're all essentially pulling in the same direction with a very cohesive message. And that is, whatever is good for my company is going to be good for whoever's exploring around and near me or in the Yukon in general. And that, I mean, that's the foundation of Invest Yukon and Yukon Mining Alliance. You know, it came together because we saw these companies and these projects that had been here for a substantial amount of time, that were well invested, that understood the region, that were really committed to these values of the region in terms of ethically advancing and using innovation to do so. And went, how can we ensure that investors are aware of this? You know, we are a smaller jurisdiction in a very big country, in a very big market. And so, you know, how do you try to punch above your weight in the investment world? And it's through collaboration, getting out there ahead. And, you know, if we can talk about the positive relationship that is in the Nutchinai-Dun traditional territory with Alexco silver mine, Victoria's gold mine, and then you see metallic minerals and their silver all the way around Alexco. You see a new project in Strategic's Mount Hinton. It was, I got to go into the field this year. It was actually a really cool year for me that way and do our virtual tours. But going up to Mount Hinton, when you stand in their mountains, you can actually see the Belkino at it. And I actually got cell service up there, which was fantastic. And so, but the team there was so excited. They were pulling out visible gold on these rocks. And, you know, this is an area that's had 100 years plus of exploration, mostly silver, but there's a brand new placer operation that was in there in the last 2 years. And it like that, when you can be in an area for so long and still get this level of excitement and these new discoveries, I think it's a really compelling message. And it's, you know, the sharing of resources between these companies is a big part of making that effective.
Okay, now there's a lot there that I want to unpack. It just a side note, those virtual tours that you produce are amazing, and I want to publish all of those on our channel here. Ranj, I want to pass it back to you and just talk about ESG for me a little bit. And it's a big topic, so you know, maybe in the context of what I'm hearing from retail investors today, why this matters more to them is because source country is going to become increasingly important when you're looking at exploration, development, and production companies, and for very good reason. So walk me through some of the initiatives that you are undertaking right now to provide a better working environment, ethically, sustainably, et cetera, in the Yukon.
Yeah. Well, I think I would start by saying that the approach on how we speak to the world broadly is I would parallel it to what we see in a lot of jurisdictions when they're trying to encourage tech investment. You know, AND's put together a really sophisticated approach on how we go out, and government aligns with the Invest Yukon team. So we are consistently have all hands on deck as we go out to look at investors, as we go out to look at new companies. And I think that's, you know, it's important. The same way that Toronto will go after, you know, a tech company to set up, we're out there making sure that we are bringing dollars in, and that we have the best companies that are coming to the Yukon. And I think so that's important. That's how passionate we are and how important it is to our economy. When I think about ESG, again, I think Ann and I, you know, in our discussions this goes back a number of years. I mean, we saw that. We saw it on the horizon. We were speaking to, you know, the global financial players, and understood that wow, we're in a position where a lot of the building blocks of what makes ESG a destination or investment destination, if that's the filter you're looking for, it's here. We knew from an environmental perspective that we had strong rigor in the environmental structure, but we knew that Indigenous governments were in their decision making was embedded in that, and so you had everybody at the table: federal government, territorial government, and our First Nations governments. From a social perspective, when you have this legacy of mining that goes back to the late 1800s, you can consistently learn about maximizing benefit for your communities on the social side and what best practices looks like. I mean, in this case, Anne also wears a hat as president of Women in Mining. So things like that are key. We have ensured that all parts of our population here have opportunities to work in the sector, and how important that is. So I think on the social side, we've been getting in for a long time, and we know how important it is to get that right. And then on governance, I mean, there's something called the Yukon Forum that's really unique, and I want to share it with your listeners today.
Please.
We're the only province or territory in the country that every quarter we have our premier and all of our ministers at the table with the leadership of every First Nation, sitting there discussing priorities. We made a commitment 4 years ago that our government would do that. We have not missed a meeting. We've all come together, and in those we have over a dozen working groups that focus on everything from mining to infrastructure to health and social. So we are consistently at the table, having the smooth conversations, having the tough conversations, but being able to work through those relationships and build our priorities together. And so when you talk governance, it really doesn't get any more progressive than that, than what you see here. It's a best practice across the country. So I think when you put all that together, what our industry figured out very quickly, and what we as well understood was that we're there. We meet the criteria of ESG. So to be open, I have other provinces reaching out to me, other ministers that are in the same role. This last year, myself and the federal minister chaired the mining table, and in those discussions, we had senior people across the country saying, "How do we do that? How do we position ourselves like the Yukon is?" So I think from us, that's we just see an opportunity of growth when sitting down in Bay Street with even understanding what kind of capital is going to be deployed by some of our major banking institutions. They're excited to see jurisdictions like ours position ourselves in this way. I also think that we increased our grassroots support for exploration this year by over $1 million. It's about $2.5 million. And one of the reasons as well, we knew we wanted to make sure that we shored up the industry because of the year we were having. But I'm a signatory to the Canadian Metals and Mines Plan. We're also focused on critical metals. I mean, we want a diverse portfolio of operations here. A clean tech economy. I know you do a lot of work, Jay, on the renewable side. That's some of my work here as well. And we think that we can extract what's needed to have a clean economy in the future in the most environmentally appropriate way. And we're going to do it in partnership with First Nations. Minto is a great example. I mean, you're looking at a partnership, again, that is unique in this country, where a First Nations working hand in hand with Pembridge to ensure they're extracting copper. And again, that's going into this massive demand across the world as we pivot to a clean tech economy.
Got it. Okay. Now, the last thing I want to talk about, it's kind of tying this all together, right? When we look at the resource business, it's inherently high risk. And right now there's less certainties in general for investors than there ever has been. And so any that we can identify and rely on are vitally important. A big challenge that resource companies are facing, and I think they're going to continue to face, is attracting those inputs, getting their hands on those inputs, whether it's equipment, whether it's people. And you touched on the benefit of collaboration between the companies based in the Yukon, and it's capital, right? And it's interesting. I think I was talking to Terra Christie of Banyan Gold yesterday. Her two largest shareholders are her two neighbors, Alexco and Victoria Gold. And so there's there's significant advantages to what you've built up there and how you've got everybody working together on a team. On my whiteboard at any given time, I have a list of names. I'm a very people-driven investor, right? And it's maybe 25 names at any given time. I have to see one of those names on a company's directors, executive team, in their shareholder base before I'll really take it seriously. I'm very people-focused like that. But now I also have a list of jurisdictions, because that has increasingly become more of my focus. And it's not as simple as federal, right? Because every province, every state, every region operates independently. So, I mean, Anne, you've got the Invest Yukon poster behind you. I want you to just address this. And for anybody who's thinking like that, and investors should be thinking like that, why is the Yukon a safe place for capital right now?
On the people side, I as you said, it's the rocks in the ground, it's the people, and then what you can do with them. And the people who are working in the Yukon have been for a long time. They've really put in the time, they've invested in understanding their projects and understanding how to do business, and understanding the systems that effectively move projects forward. You can have the greatest rocks in the ground, but if you don't know how to work with the community, the government, and move things forward, and even access, the right drill at the right time to get your project going for the season, you're not going to go anywhere, and you're going to fall behind others. And so, those people that have the experience here and that partner with each other really do have that step ahead. And as you said, there's that alliance. There's the alliance of all of us, which is 18 companies that collaborate from a marketing perspective. But the alliance you see on the ground and in money between like the metallic group of companies as well, right? So you've got 3 companies in there advancing their projects and working with their neighbors as well. So that's a really critical piece of moving it forward. And these companies and the people and the teams leading them are incredibly invested in their projects. One of the key things about Yukon companies, for the majority of them, is that their primary project is here in the Yukon. And that's the badge of confidence that they have put into the projects themselves is, they are putting all their energy, all their focus, all their personal investment into these projects. So, when you follow money, I like to make sure that, you invest with people who are investing in themselves. You've got your whiteboard, and that's on my list as well, is making sure people believe in themselves and the projects they're working on, and investing in each other. And so you can see that across the board, as you said, with Alexco, Victoria, and Banyan. So, and those exist kind of across the Yukon. So that's pretty important as well.
They do. Okay, look, Anne, Minister Pillai, it's been great having you on and getting you in front of our audience and diving into the region a little bit more. Thank you so much. I appreciate your time and letting me hit you with some questions. And I'd love to do it again sometime.
Thank you so much.
Thanks for having me.
Hi, I'm Veronica Van Wollen, and joining us today is Paul West-Sells. Paul is the president and CEO at Western Copper and Gold. Western Copper and Gold is listed on the Toronto Stock Exchange under the ticker symbol WRN, and they're listed on the New York Stock Exchange. Paul, how are you? Thank you so much for joining us.
Well, thank you very much for having me. I'm doing well. It's a fun time to be in the mining industry. It's a fun time to have a big copper gold asset, and with both of those commodities doing well, these sort of times only come around every 5-10 years, and so we're in one of these situations right now where we have very strong copper market, very strong gold market. And so it's an exciting time to have a large copper gold asset like we have with our casino project.
I think you're right. And I'm glad you pointed that out, right? Copper and gold, 2 very hot commodity classes right now. That's exactly what the casino project is all about. You guys are developing a mine in the Yukon of Canada. You have a lot on the plate for 2021. You raised a lot of money in 2020, close to 30 million. You're expecting a new feasibility study this year, and you're anticipating a lot of drill results, which will kind of dictate how the company unfolds for the next little bit here for investors. I want to dive into all of that and tell investors more about the opportunity here. Before we do that, for anyone who's new to the story, can you give us a quick overview of what Western Copper and Gold is?
Sure. Western Copper and Gold is a single asset company. It's got one asset, which is the Casino Copper Gold project located up in the Yukon. The Casino copper gold project, we've been developing it for over a decade now. This is a large copper gold deposit. 21 million ounces of gold, 11 billion pounds of copper contained in a little over 2 billion tons. So a very, very large deposit. I mean, this is not only a significant deposit when we're talking about Canada and the Yukon, but globally. Located in the Yukon, we love being up in the Yukon. The Yukon is a territory that has had a lot of promise. And over the past couple of years, it's really delivered on that promise as a mining jurisdiction. There's now 3 mines operating, and compare that to 3 years ago when there was only 1 mine operating. So that it's really sort of emerging as a real mining district, and we love working there and lots of good support. And as you alluded to, I mean, we as a company, we've got, a substantially new board. That new board sort of came together over the past couple of years. One of the first things that we did as a company with a new board is go and raise some money, and we have $30 million. It's actually the largest equity raise in the history of the company. And with that $30 million, we're now we got to spend it. So we got lots of things on the plate, as you were alluding to.
Yeah. And we're going to get into, how the plans for spending that capital, because it is a lot. It is a lot, and the most for the history of your company. I want to focus a little bit about the casino project, because you said it is unique and it's big, but I want to give investors some context. Like how big are we talking here? Give us some sense of perspective.
Yeah, the thing that's really interesting about the Casino deposit is actually that a lot of these large porphyry copper deposits, as they're called, tend to be more copper or more gold. We're almost 50-50 copper and gold, and then we have a little bit of moly as well. So when you look, let's talk first of all about gold. With 21 million ounces of gold, this actually places us in the top 10 junior-controlled largest gold projects. And I'm not sure, we updated the resource last year, and so we actually went up a notch. So I'm not sure if we're 9 or 8 or something like that, but we're top 10 in terms of size gold deposit. Then switching over to copper, and copper, the thing that's really interesting about copper, and I've had a lot of investors, copper's been on an absolute tear. And so I've had a lot of investors sort of come to me and they say, you know what, I like you guys for a bunch of reasons, but more importantly, I want to be invested in copper. There's not a lot of good copper stories out there. It's just the way the geology of the world works. There's a few there's a few copper deposits. There's lots of gold deposits. There's literally thousands of them. Copper is few and far between, and having a copper deposit of size with good economics located in a great jurisdiction such as the Yukon is a real rare thing.
And you kind of led in really nicely to my next question, which I want to ask you is about the copper projects that are available right now. So you mentioned that there aren't a lot on the Toronto Stock Exchange or the Venture Exchange, and it's a very tight-knit, small space. And in your opinion, a lot of them are smaller, have bad economics. So maybe elaborate a little bit about how Casino stands out and what makes it so significant compared to the other copper projects that you see.
Sure. So, the first thing I talk about is size. So, with 11 billion pounds of copper, the same amount of value in gold with 21 million ounces of gold, 2 billion tons plus, it puts us into that tier of copper projects that gets global attention. So this is a copper project that, if you look at the top 5-10 global copper companies, they're going to have interest in the Casino project because it's relevant to them. There's lots of smaller copper projects and nothing against them, but those types of projects are going to have to be sort of self-developed, self-financed. They're a different animal than what we have with Casino. So that's point one. Point two, I've brought it up a couple of times. I'll bring it up again, jurisdiction. Mm-hmm. If you look at where copper tends to be, there's a lot in South America. There's some pluses and minuses to some of those. Some of those South American jurisdictions are good, but they're challenging. They're at 4,000 meters, and you got to bring oxygen tanks. We're up in the Yukon. It's cold, but it's pretty accessible. And then the third thing, and the most important thing, is the economics. Now, we did a feasibility study in 2013. As you alluded to, we're looking to update that right now. But this is a project that looks very, very good at even $2 copper, let alone, copper. Last time I looked, it was $3.65, this week. And it's an important thing because, mining companies are actually not in the job of making copper and gold. They're in the job of making money. And sometimes I think they forget about that, but it's important that you have a strong project, strong economics, good jurisdiction, and sizable. Mm-hmm. And that's exactly what we have with Casino.
Yeah, and I know when you're alluding to your 2013 feasibility study, it's not a small capex or investment to develop this project, right? I think it was in the range of $2.5 billion that you guys said. Now, I don't want investors to think that's a scary number, because when it comes to copper development, that kind of falls in the middle of the range of cost for capex of investment to develop a project. With that number, would you guys be looking for a partner to help develop this casino project?
Yeah, I mean, definitely. And I've always sort of said, like this, for us to finance this completely by ourselves, it's doable. We've looked at it, we've run the numbers, but the best return we think for investors and the best way to create value within the company is to bring a partner in. And so, we're always having a number of conversations, and a higher copper price makes more of those conversations happen. It's one of the ways that I like to sort of lay this out is so you bring in a partner. Okay, so a partner would buy into the project for a certain amount of money. Let's say they buy in for sort of $500 million on this project. Okay, and then they have 50% of the overall project. That leaves us with, let's say it's $2.5 billion, which is from the 2013 feasibility study. That then leaves us with $1.25 billion. Well, okay, that we need to raise. Okay, but the first $500 million, which the company bought in for, is already carried for, so that drops it down to $750 million. You put some debt onto that, it leaves us with actually sort of $200-300 million that we need to provide as equity. That's why it's very financeable. And as you sort of alluded to, $2.5 billion is sort of a mid-sized copper project, and people sort of roll their eyes at it, but it's true. I mean, you look at the projects that are currently, one of the biggest projects, one of the more recent projects is Cobre Panama. That was $6 billion US. Wow. Quellaveco, which Anglo is building right now, is I think $5 billion US. I mean, so we're actually sort of a small copper project, very financeable by ourselves, bringing in a partner. And now we've got enough money in the bank really to sort of push this project forward aggressively.
Yeah. Let's talk about that raise and what the plans are for that $30 million. Yeah, around 30 million. I might not have the number perfectly, but
yeah. Well, I mean, we had a little bit of money as well, so that's what we've got in the bank, and that's the important thing. And so, yeah, I mean, moving forward, three fronts that we're moving forward on as a company. So first of all is the advancement of the project. Well, what does that mean? We announced at the end of last year that we've launched a PEA. We wanted to do that really quickly to sort of take a look at the economics of the project. But right after that, and actually concurrently with that, we're actually working on the feasibility study. And the important difference between the PEA and the feasibility study is that feasibility study will be the foundation, the fundamental document that will launch back into permitting. And so we were in permitting, we sort of pulled back for a bit. We're now looking to aggressively get back into permitting. So we'll have, right now the PEA is expected to be done sort of the beginning of Q2 of this year. We hope to have the feasibility done around the end of next year. And then about 6 to 8 months after that, we'll have be back into permitting. So that's sort of front number one. Front number two is exploration. We did some drilling last year. We acquired a project right next to us the year before that we haven't really done much work on. So, creating some great news flow with some exploration. And so that's going to be a focus as we sort of go forward. And then the third one is that partner. I talked about how important that was in terms of financing the project. We're having a number of conversations right now. We'll see where those go. I'm pretty excited about some of them, I'll be honest, but we'll see where those go. But with the copper price where it is, I think that we'll see something happening on that front as well.
Yeah. How is that going to translate into expected milestones and catalysts that are going to make the needle move for existing shareholders, but any new investors that are looking at the story now? What are going to be the things over the course of the next 12 months, let's say, that's going to make the needle move for these investors potentially? Right.
So I think the first thing is that we do have some drill results that are coming out from last year. Like everybody, and I'm sure a number of the companies I've been talking to, it's been very, very slow to get assay results out of the labs, and we're no different. So those are going to come out. We should have those out this month, I'm hoping, or at the absolute latest, early February. PEA will be big. I think that this sort of refreshes the project, takes a look at, what do the economics look like in this environment, accelerated up from 2013, which is our last feasibility study, up to 2021. And then, the feasibility study, roughly by the end of the year is going to be another big catalyst. And then in between, let's just talk about that this year. So that'll be this year, and then permitting will be into next year. In addition to that, we'll have some exploration results this year. And then, anything that on the partnership or business development front, the new board has taken a very aggressive view on that. And I should say, look, it's not just partners. It's, what do we partner with? Are there assets we could be adding in? Is there other companies we could be working with? It's a pretty blank mandate in terms of how we can create value. But that's, the other sort of things. And I can't, put a diamond on when that milestone exactly is, but, I expect a few of those things to come to fruition in 2021.
Yeah, I'm going to assume that because the copper prices are so strong right now, are you guys in a position of power and can be kind of picky with who you choose to work with, how you deploy capital? You can kind of be a little bit more selective with potential discussions on groups and how that would look like for a partnership. Is that a fair statement?
Yeah, I think that's there's two things. One is the price of copper, and the other is that we actually have a pretty good bank balance. So with $30 million in the bank, if you look at us as a company, that's if we move aggressively as we're planning on the casino project, that's at least 3, if not 3.5 years of capital to move us forward. So we're not sort of waiting for somebody to sort of come. We're not waiting for a savior. We've got lots of things to do over the next 3 years. Copper price is up. And, it's interesting. I've been with the company, I've been with this project, for over 10 years. And one of the things that's interesting is that, you look at the major copper producers out there and people are saying, well, this is a great project, Paul. How come they haven't, how come you don't have the majors just snapping you up? And I said, look, when copper is $2, the majors aren't looking to buy assets. They're looking to sell assets, but they're not looking to buy assets. Now that copper is up at that level, they're starting to move into buying mode. And that's certainly what we've seen. And I think that we'll sort of see that moving forward.
No, that's exciting. And, we talk about copper, like everyone knows what's happening in copper. Maybe speak to us a little bit about your sentiment towards copper and gold and why there's such a strong push for copper in the future, especially with EV, more electrification of vehicles. I know Biden, that's a big part of his platform as well. So talk to us a little bit about that.
No, certainly. Yeah. And when I look at the copper market, actually, sometimes, I've talked to other people that really know the space well, and we're all like, where is the copper going to come from? Because it's sort of, there hasn't been a lot of mines built, mostly because the price hasn't supported it. Now you have a price that supports it, but it takes years to get things permitted. It takes years to get things built. So it takes a while for all of that to catch up. And the first thing is, well, 50% of the world's copper goes to China. Well, China's doing pretty well. I mean, China doesn't have the sort of COVID challenges that the Western world does. They're firing on all cylinders. I mean, talking about electrification, they're electrifying like crazy. And, one of the statistics that I love is that China launches a fleet of electric buses the size of the entire London bus fleet every month. Like, that's how fast they're electrifying, public transit, let alone, private transit. And yeah, I mean, if you look at the copper space and you look at the projections, I mean, they're projecting a 5 million ton deficit over the next decade. That is 65 mines the size of Casino. And that isn't taking in any sort of bump from electrification. That's just simply, taking a look at the historical growth of copper and transferring it forward. If you start to look at some of these projections, I mean, even if you look at conservative projections of electrification and electric vehicle uptake, it adds another, 3 million tons. And again, that's, where is it going to come from? So that's what's driving. I mean, and we're seeing that now in the copper price. That's why the copper price is going up. And that's why, companies like us are getting attention from shareholders, from potential partners, and why it's a fun time to be in part of a copper company.
Definitely. And, I want investors to really understand what is the opportunity here and why they should invest in your company, in Western Copper and Gold, right? There's a lot of gold plays out there that people can look at. There's other copper plays people can look at as well. Why you guys?
Yeah, I mean, I think, we've been around for 10 years. We've been very, very good with our shareholders' money. I mean, part of the story of the $30 million, well, actually $28 million that we raised as being the largest equity raise is that we weren't, we could have raised these large amounts of money, but we weren't in a position. We didn't have a share price to support that. So we're very, very careful with our shareholders' money. We've got a very, very good track record of that. We've got a project, and I haven't sort of gotten into some of the challenges of copper projects in they're large mines. Large mines can create controversy. We've been very, very good in the Yukon at making sure that this is a project that has, broad community support. I spend, well, not in the past year with COVID, but in a typical year, I spend as much time up in the Yukon talking to Yukoners as I do out talking to shareholders, because it's important that they understand the importance of this project, and I'm there to answer questions and their concerns. And so, I think we've done a very, very good job on that, and that's another sort of advantage of our project. And this is the year. 2021 really is the year for Western Copper and Gold. We have, the PEA and the feasibility study drill results coming out. Copper, the copper price is peaking. We haven't talked much about gold, but gold. It's 21 million ounces of gold, and gold is bouncing around $1,900 an ounce. So all of that sort of is coming together very, very nicely to make 2021 an excellent year for us.
Paul, thank you so much for joining us. I really like how you sum things up for investors at the end here. Again, Western Copper and Gold, we had the pleasure of speaking with President and CEO Paul Westsells. Western Copper and Gold is listed on the Toronto Stock Exchange and the New York Stock Exchange under the ticker symbol WRN. Paul, thanks again.
Thank you very much.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined by Terra Christie, the President and CEO of Banyan Gold Corp. Terra, how are you?
I'm wonderful. How about yourself?
I'm really good. And I'm looking forward to diving into this story because we haven't had you on the show yet. But I know some of your investors, which is always where I start. So to open this up, I'm hoping what we can do today is introduce the Banyan Gold story to our subscribers and give them a thorough understanding at a high level about what you've done and what they can expect coming down the pipe. So where I like to begin is with management, and specifically management ownership. and significant shareholders outside of that, so we can understand who made a bet before we did. And I'd love to hand it over to you to field that one.
Great. Well, I'm pretty significantly invested in Banyan. I'm about a 5% shareholder, which is pretty significant. And I was not the first CEO of this company. So I became the CEO in August of 2016. So I didn't get any founder stock. So my shareholding is primarily from investing in the market and purchasing in all the private placements, particularly since I've been CEO. I've participated in every financing that we've had. So I think that shows that my money's where my mouth is. The first 6 months of being CEO of Banyan, I actually didn't take salary because I really wanted to be aligned with my shareholders. And I think that is something that's really quite unique is our insider ownership. And then again, our big shareholders. We've got the two miners that are our neighbors, Alexco and Victoria. We option properties from them, but they also both invested equity in our financings and have participated in our financings, which really shows that they believe in not only our team, but also the properties that we have, and particularly the Ormac property, which they're both right near. And then a Cisco development. It was a Cisco royalties when they invested in 2019 in November, October, November. And that was when, I went to them and said, we'd worked on the Ormac property, which we optioned in 2017. By 2019, we thought we really understood what was going on, but we needed the money to drill it, to put together that resource. So October, which is late in the season for a Yukon projects, we went and pitched to them on the technical merits. So they invested equity. They do not have a royalty to help us put together that resource.
Excellent. Okay, so yeah, we're up right beside Victoria Gold, Canada's newest gold mine, about 40 kilometers away in the Yukon. And then I guess on the other side of you, or even closer, 10 kilometers away, is Alexco's silver mine. And yes. So they're the two largest shareholders you're referring to, in addition to a Cisco. And I think I saw Sprott as well.
Yep, Sprott has about a 3% holding now, and that's in some of their funds.
Okay, so let's dive into these projects a little bit. I see two, Ormac, which seems to be the focus, Highland, which provides some optionality, but we should probably talk about Ormac because that's where you're getting busy. Is that correct? Absolutely.
We're focusing most of our exploration budget this year on Ormac, and of course that was our big success story last year. We committed to putting together a resource, and that came out in May of 2020. And I think we over-delivered on what we promised with that 900,000 ounces. Of course, it's very similar look to Victoria Gold. It could potentially be an open pit, heap leach mineable project, which of course with exceptional infrastructure and in a jurisdiction which is permittable is a pretty exciting thing. We spent all of 2020 working on expanding the two resource zones there. We have both the airstrip zone and then a kilometer to the south, the power line zone. And the results that we have back to date are showing that both of those, the mineralization is continuing well beyond what we've drilled. We've expanded the airstrip by 200 meters to the west and 125 meters to the south and down dip. Power line zone, which had a grade of 0.61. We had 129,000 ounces there, and it was a brand new discovery in the first phase of drilling in 2019. In the short course of that 1 year, already 129,000 ounces. And we've now extended that mineralization by 500 meters to the south. And then in the press release last week, we've now shown that there's continuous mineralization over 2.5 kilometers to the east, all the way to another zone that we call the Oryx Hill, where we know that there's similar gold mineralization. So, we've got tremendous targets for 2021.
Okay, now you surprised me when you said you were going to be able to begin drilling in Q1 of this year.
Q1, we're going to get drilling. We're already mobilizing and getting things organized for starting drilling.
Okay, because you have road access year-round at your property.
Yeah, so we drilled to December 15th before we shut down for Christmas. And now people needed a break too this year. We could have continued with the way the weather was over the winter. This year was very mild, but with COVID and all the things that happened last year, everybody needed a bit of a break. So with year-round roads, government maintained highway goes right beside power line and airstrip, plus Victoria Gold's year-round road, cell phone access. We're pretty well positioned there for year-round drilling.
Yeah, the infrastructure is appealing. How much of that, Terra, is a consequence of having Victoria and Alexco? I mean, you're beside the highway. That's what it is. But how much of this infrastructure was built during Victoria Gold's mine production?
Well, that's a good point. We have to give credit for the new power line to Victoria Gold and Alexco, because without them being there, that line that goes to the hydroelectric dam probably wouldn't have been upgraded. It was partly also really well timed for economic stimulus this last year, but it's being energized here in January to replace the line. Plus, Victoria Gold's switching station is right beside our airstrip deposit. That was built because of Victoria Gold, as well as the drop-down line that goes to Victoria Gold. So that was there. The cell phone coverage, probably was a good part of with Alexco getting started there, on the highway in the community and seeing economic development. Certainly the maintenance and the amount of attention that the area gets for road maintenance is a good part.
No kidding. Okay, I'm with you. So we're going to be turning drills in Q1, again, I guess in a few weeks. That would make sense, right? When it comes to news flow, what can investors expect this year?
Well, we still haven't got all the results back. Labs are backed up, and we delivered the last samples December 15th. So it hasn't been that long since those samples have been in. So we will get results back. We got another 22 plus holes and soils that are still to come back from the lab. And so that'll be all through Q1 probably. I expect we'll start drilling before we get all our news flow. And then, we'll have results going through the year. So we are planning to work on our Ormac property, the airstrip, power line, and Oryx targets, as well as the Nitra property. This last year, we staked another area right up by Ormac that we think geologically looks very similar. We're going to do some trenching out there to start, and then some late season drilling if all goes well. And we do plan a small program out at our Highland project this year, which is down in southeast Yukon.
Okay. Now talk to me about operating in the Yukon a little bit, Terra, because we actually have a handful of companies I'm talking to this week: Western Copper and Gold, Victoria, Alexco, White Gold as well. And it's a very tight community, it seems. We've been running the shows forever, and the Yukon Pavilion is always a buzz at our conferences. So, there seems to be very strong support. So talk to me about the community and the engagements and how you guys interact.
Yeah, so, the Yukon Mining Alliance is an important part of working together in the Yukon to talk about mining companies. But, the relationships between companies are very solid. We tend to try and work together, share information.
I see a lot of board crossover.
There's a lot of board crossover. Yeah, you notice that. So, some of my favorite companies, I'm also on the board of a couple of them, which, I think I've been working in the Yukon since I was 8 was when I first came to the Yukon with my dad. And then, I ran a mining company. I've been a consultant in the Yukon. I've sat on the environmental assessment board. And all those skills, and being close-knit with the community is important in having good communication networks. Permitting is it's as important to have a good relationship with the community as it is to be technically correct in your permit. So I think that's what you really see in the Yukon Explorers is that they've really got the environmental and the social part well integrated into what they do and how they operate, and that makes a key difference. And and then we communicate out kind of collectively through the YMA to make sure that message is heard.
Right. Yes. Yeah. Prior to Banyan, you were the president of Gimlex Gold Mines, right? Privately held company.
Yeah, privately owned alluvial mining operation for quite a long time. And during that time period, I did consulting work. I worked up in Hope Bay for Newmont, did work for a bunch of other companies, worked for Kaminak, helped them with that. And, certainly was part of seeing the whole story. And I think that what makes me well positioned to be the CEO of Banyan is I've been in those management positions. I've seen what it takes to take a project from exploration all the way through to development. And that's really important to have that experience and the strong connections in the Yukon to know how to make it happen from a permitting perspective, from a communicating with the community perspective. And that's what I think means we can start in Q1 here to get drilling is because we know how to operate in the north. And, I've dealt with cold temperatures before, and we have all the infrastructure set up.
Right. So talk to me about that transition. Because you weren't the first CEO of Banyan, right?
No.
What attracted you to the project?
So I actually joined the board in 2011, when just after IPO'd, and the Highland was the first asset that the company had.
That's right.
And then, I'd been on other junior public company boards since about 2006 when I joined my first public company board, but really was involved in the private space and other businesses. And then in 2016, of course, my consulting company, my major client was Kaminak, that got bought out by Gold Corp. I had been on the environmental assessment board for 12 years, and that was a tiring thing to do. So decided not to try to get my term renewed there. So all of a sudden, and we were interviewing as a board for CEOs of Banyan, and it just seemed like the perfect opportunity to step up and say, yeah, I can do this. I think I'm perfectly positioned to advance this. And, we had Highland, we took that and put together that almost, 500,000 ounce resource there, 0.85, which, in the Yukon, when Victoria Gold's grade is 0.63, life of mine grade,
that's good.
Both of our projects are comparable. And I didn't say that about Ormac, but, if you look at the grade of Ormac, it's 0.54 is the current resource, and we are very confident we can both get the grade and the ounces up. If you were to increase the cutoff grade by 50% to 0.3, the grade goes down, or the grade goes up by 20% to 0.65, and the ounces go down by less than 15%. So that's comparable to 0.63 to our neighbor down the road, which was economic in 2018 to build that mine. So, and both of our projects road accessible, and that really is our forte. What I look for: road accessible, potential open pit heap leach mineable projects with on-surface deposits that have multi-million ounce potential. So you need the geology, the land package size. I think both of our projects have that, and I think that's what makes us really well positioned going into this gold market, which, all this monetary policy and things that have been happening in the world have really, I think, poised people to start investing in things like gold. And we have two projects. We've got the one where we're advancing very quickly, and our goal is to get it to around where you can see that there's at least 2 million ounces there in the areas where we have the resources. Doesn't mean we'll have a resource by the end of this year, just to be clear of that, because we need an awful lot more drilling than we'll get done in one season.
Okay.
And then we got Highland, which is another option on the price of gold for us.
Okay, talk to me very quickly about your cash position, and do you expect to go back to the market to finance?
So we have 5.8 million when you count all of our cash and deposits for things. So that gets us all the way through this year and G&A. So we don't anticipate going to the market soon.
2021, yeah. Got it. Okay. Thank you, Terra. I appreciate this. I have a better understanding than I did 15 minutes ago. Thanks for your time. It was great to introduce the story to our audience and introduce you. This has been fun, and I'd love to do it again sometime.
Yeah, me too. It's always fun to talk about my favorite projects and Banyan. Hope people take the time to look us up, and don't hesitate to reach out to me. I'm always happy to talk to people about it.
If you are just tuning in, my name is Jay Martin. I am an investor and the CEO of Cambridge House. Now, what we're doing today is diving deep into a handful of resource investment opportunities, talking to the company CEOs, and in addition, stress testing our investment ideas and strategies with some of the most prolific money managers that I know in the business. Now, the reason that I do this is because I'm an investor first, and I'm trying to grow my portfolio. In addition, I'm trying to identify blind spots I may have that would be compromising my decision making. I do this through conversation with industry personalities and company CEOs right here on the channel. Now, today we have a killer lineup of amazing content, and the whole agenda is right beneath this video in that YouTube description. Check it out, stick around. I'll be active in the live chat. Drop me a line, say hi. Please hit subscribe to stay tuned with what we're up to at Cambridge House, and enjoy.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
All right, guys, Jay Martin here, CEO of Cambridge House, and I am joined by a true legend in the business, Rick Rule, the CEO of Sprott US Holdings. Rick, how are you?
Life is good, almost embarrassingly good, given the trials and tribulations that other people around the world seem to be going through. My wife will tell you I was born for lockdown, so.
Yeah, I can kind of relate to that. I really enjoy not having to leave my house. Okay, I have a challenge for you. In 30 minutes or less, you need to make me a better investor. Do you think you're up for it?
Yeah, I do.
All right,
absolutely.
Awesome.
You're a curious young man. You'll make a good investor without my help, but I'd love to take credit for speeding you along.
I appreciate that. So, I thought it'd be just kind of fun to open this one up with a quote that I heard you say on my podium about 18 months ago at a show in Vancouver. And I think you were essentially summarizing the sentiment of retail investors over the previous 7-year bear market. And it went something like this: please, Lord, give me one more bull market, and I promise I will not waste this one. So it might be staring us in the face now. What do you think about that?
Well, I think it certainly is staring us in the face. It was pretty obvious to me at that point in time that things were turning. Cash was coming back into the sector. We were coming off oversold bottoms. So irrespective of whether or not we were going to launch into a full-blown bull market, anybody who paid attention was going to make money. And it's important that you not be a spreadsheet millionaire. That is to say, it's important not to add up your winnings and not take them. It's important, if you've endured the pain of a bear market, to enjoy the gain of a bull market, but enjoy it very fully, which is to say, come out of it with something. It's important, too, in natural resources to understand that bear markets are the cause of bull markets, and bull markets are the cause of bear markets. And when you're doing very, very well, doing well is seductive, and you tend to overstay your welcome. So that'll be a lovely topic for today.
Yeah, okay. I'm very keen to jump into that, the how to sell, right? Because we always talk about what to buy, when to buy, how to buy. Rarely ever talk about how to sell, which in my experience is the harder part of the trade. And as I said before we hit record, that's where I lose sleep at night, is how to get out of positions, when to get out of positions. Did I get out too early? All the what's in your brain. So I want to get to that. But prior to, let's address this. We are moving into, let's say, the next resource bull market. And as you know, and I know, as the market heats up, so is all of the noise and the pollution in our news feeds and our deal flow. And it becomes more treacherous for retail investors. Sure, the upside could be greater, but there's lots more landmines out there. And so what can you tell retail investors, new or not to the sector, what they should be watching out for in the coming, 12, 18 months if things continue to heat up?
Well, we're already seeing it. We saw an absolute explosion of interest and money available to the junior sector beginning in June of 2020. There were any number of companies that had a choice between filing an offering memorandum or filing bankruptcy. They chose the offering memorandum, raised more money than they could possibly dream of. We've already seen the first blow off, the first of several in this bull market. And we've seen the first real incidences of excess in the market. I myself had never seen a bull market that went directly from the best of the best, which is to say the Franco-Nevadas, the Barricks of the world, all the way to the penny dreadfuls without missing a beat. You didn't see the middle of the market move. What you saw is the best of the best move, and then you saw the penny dreadfuls move. So we've already seen the beginnings of the excesses. Every bull market is the same, and every bull market is different. This one is different because precisely of what you do, social media. I'm not saying you particularly, but I'm saying your venue. The really good news about that is that information isn't distributed any longer in a top-down fashion. Investors don't wait to be force-fed research reports, if that's what they are, from investment banks, which tell you a lot about what the bank is long and not very much about the companies that they purport to cover. Rather, information is increasingly peer-to-peer, which is fantastic. The other thing that's fantastic is that the amount of information, real information available online at Edgar, at Cedar, at places like that, the amount of information that investors have at their hands to make intelligent decisions is huge. There is so much information, however, that many people feel daunted by it, and they don't avail themselves of either knowledgeable peers or of the company's legal filing statements, which is to say there's so much information around that at times there's a surplus of information. And people new to the sector in particular are more narrative oriented than they are fact oriented.
Absolutely.
Which makes them absolute suckers for the online promotional factories, which are proliferating from everywhere.
Right.
Now, this will sort itself out. Every generation of investors, you're going to have to, pardon my jocular financial phrase, but every generation of investors has to get their ass kicked. Happened to me in the decade of the 70s. I've told you before, I went from being broke to being an extraordinarily wealthy young man to being broke again. I round-tripped it. Something I hope doesn't happen to most of your readers. But the truth is that this will follow predictable patterns, and people will make some fairly predictable mistakes. Not all will, not all need to, and I'm delighted to have this discussion to help people avoid some of the worst of them.
Okay. Now, there's some interesting points in there, specifically about, I guess, newer investors appealing to the narrative approach, right? The storytelling approach, which you're right. It's like, it's far easier to use that strategy online. The tough part is that even the best CEOs in the business recognize that, and they do it very well. Take a Robert Friedland, for example. He's an amazing salesman, but he backs up that story by hitting milestones and delivering value for his shareholders. And I think you'll find that Ross Beaty tells a great story. So how do you differentiate then, Rick, between, the CEO with credibility and sure, Ross and Robert are easy, but go down a tier to the newer individuals?
Well, let's start by saying that it's okay not to catch every story, which means it's okay not to follow every CEO and every leader. It's okay if you aren't in a future superstar's first deal. It's okay to miss his or her first deal. You start off in any speculative business by understanding that the people are, in the near term at least, more important than the assets. And so find a team, old or young, that has an established track record already. And there's plenty of them. You don't have to, you don't have to look for old fat bald guys like me. There are plenty of people in their 30s and 40s and 50s in every major mining center in the world who have already established a track record of success. And then examine obvious flaws in the narrative. Even back in the days when your father ran Cambridge House, people would ask me at your Vancouver conference, Rick, if the price of gold goes to, pick a number, goes up, what would that do to the affairs of Amalgamated Moose Pasture Mines? And I would have to say, well, Amalgamated Moose Pasture is looking for gold. They don't have any gold. And if the price of something that you don't have any of goes up, why should it matter? So an awful lot of avoiding pitfalls is simple common sense, which seems to be lacking. If a small exploration company is headed by, parenthetically, a butcher, a baker, and a candlestick maker, but it's missing geologists or engineers, or if the geologists, while experienced, don't have any experience in that terrain or looking for that deposit type, the probability of their succeeding is extremely low, irrespective of the gold narrative, and irrespective probably of the blandishments offered up by the broker who's trying to sell it to you.
Right. Yeah, I'm with you. And that's like my core ambition in this sector is to find those individuals who have one or two wins. You pay a bit more, right, to enter the deal than you do for somebody who's fresh out the gate, but you don't pay as much as a Ross Beaty or a Friedland. There's that sweet spot. And I call out CEOs like Ivan Bebek. I mean, I've called him on the show before. I'm pretty bullish on Ivan and a shareholder in his deals, but he's got Keegan resources, Caden resources, delivered in bad markets. Now he's got a tailwind. Now I'm really curious what he's going to do with it. Okay, so moving on then, Rick, if we do well in the spec market, what I wanted to get your thoughts on is how you cycle your profits, meaning that at a super high level, the way I organize my portfolio is I have assets and investments and speculations, and fingers crossed things go well. I generate cash in the speculative market. I take those profits out and reallocate them to my assets or my investments. How do you work that system? Talk to me how your portfolio works together like that.
Well, let's back it up. We began by saying that bear markets are the authors of bull markets. The right time to start speculating in a sector is when nobody else is in it. Now, we're a little late in the precious metals, probably 2 years too late for that. But it's important to know, particularly for somebody of your age, that you're going to have another opportunity to buy things cheap. You may resent it because you may have left some money on the table. We'll talk about that later. But you're going to have another chance to buy these things cheap. When extractive, capital-intensive sectors move, the biggest and the best move first. So if you are anticipating a move in a commodity price which hasn't occurred yet, if that commodity is hated, which is the right time to buy it, you begin by investing, not speculating. You buy the biggest and the best in the sector. When interest returns to the sector, the best of the best move first. And importantly, even though you're early, the best of the best usually pay fairly handsome dividends. So the time value of money goes away. Normally, bull markets follow fairly predictive patterns. The biggest, the best of the best of the rest. Then the single asset producers, it sort of cascades down the quality trail. That didn't happen this time. It went from the best of the best all the way down to the penny dreadfuls without.
Why do you think that occurred, Rick? I
have no idea. Honestly, one of the joys of life is that it's completely unpredictable with regards to that.
Yeah.
I just react to it. When beginning in June, there wasn't much to buy in the junior sectors, I began to do some selling. And I began to see value popping up in the large single asset producers that I thought needed to be taken over. Okay. And some of the second tier multi-asset producers that were generating rather spectacular amounts of free cash flow, which is to say that although we were in a bull market, there were certain sectors in the market that weren't, never mind they weren't overpriced, they were actually in historical terms cheap. And I tried to cycle my money there. Returning to your original question, I think it's important in terms of building wealth in cyclical sectors that you remember not to overstay your welcome. Now, in truth, Jay, I've always been early, both on the buy side and on the sell side. When I tell famous stories about things like Paladin, which went from 10 cents to $10, or Arequipa, which went from 30 cents to $30. What I sometimes neglect to tell people is that I sold all the way up. The idea that I bought all of my Paladin at 10 cents and sold all of my Paladin at $10, while it's an interesting fantasy, is in fact a fantasy.
Yeah.
Bernard Baruch famously said the only guy who absolutely bought at the bottom and sold at the top was a liar. It didn't happen. You take your swack out of the middle. So that's what you need to do. Remembering, too, that making money really involves understanding the delta between price and value. Most speculators pay slavish attention to price because it's quoted. They can get it in the computer. It's easy to obtain. And it feels to them like something they can spend, although they don't sell. But price is of no importance if you don't have a sense of value. If something is selling for $1, and you think it is logically or is about to be worth $2, that's a reasonable speculation. If something is worth $1 and is selling for $1 and you have no idea what it's worth, why should its price matter to you? Most people forget that very simple fundamental.
Right. Well, and you can't really blame them when you look at the broad market and the valuations of some of the biggest companies listed and how these valuations aren't tied to tangible or calculatable value. And if you apply that same psychology to the junior mining market, then, I can see why that happens.
One of the lovely things when you come to be my age, if there is anything lovely about that, is that you come to understand that there's no particular need to do things that you don't understand. So for me personally, trying to value Amazon was an exercise that I knew I could never master. At least I couldn't outcompete 200 or 300 other people. And so I decided to set it out. The fact that I sat out a company that probably had 100-fold move is interesting to me, but not particularly relevant because I did fine doing what I do. And I slept nights and stayed calm. It is important, as you suggest, to remember to sell. And the most important part of remembering to sell has to do with the relationship between price and value. Every time I buy a stock, every single time, I write down why. I write down what could go right, what could go wrong, what my price expectations might be if things went right, my price expectations would be if they go wrong. What would cause me to declare victory and walk away? What would cause me to declare defeat and walk away? And I'm one of the few investors I know who does that. It seems in speculative circumstances that the prevailing ethos has got a hunch, bet a bunch, which is, I mean, this sounds fairly arrogant, but it's why I end up with the money.
Sure.
Let's say, for example, that the aforementioned amalgamated moose pasture, let's say this thing has some exploration tract in northern Ontario or northern Quebec that, it is within goggle range of a head frame. People are excited about it, all that kind of thing.
Okay.
And let's say it's selling for $1 a share.
Sure.
And that seems like a fair valuation. So people buy it, and you're in a bull market. And you buy it because they're going to drill some target that might validate a surface expression or something like that. Let's say the price goes from $1 to $2 on no news. Now you're elated. Your decision-making process has been validated. The stock went up, all these wonderful things. It's a hell of a company. It's also arithmetically precisely half as attractive. If the price of something doubles and nothing has changed with regards to the value, it is precisely half as attractive. One of the disciplines that I have stuck to for about 35 years is that I understand that speculation of all kinds, but exploration speculation in particular, is really a game of answering unanswered questions and trying to understand the implications of a market's more fully understanding the nature of an opportunity or a deposit.
Okay.
And whenever I buy an exploration company, I ask the management team to describe for me the principal unanswered question. What is it that you can determine that will increase the market's knowledge of your property? What do you think the probabilities of success are? How much money will it take? How long will it take? In other words, what's your business plan? Over the years, probably 80% of the time I've answered that question, the management teams have said to me, oh, that's an interesting question. I never thought of it that way. Which is actually doing me a favor because I can throw that company away and not revisit them. I don't have to waste any more time on that particular company. It's as though in Vancouver parlance, somebody was prepared to walk from Vancouver to Whistler, got all the right boots, all that kind of stuff, and then headed east towards Hope.
Right.
It might work. Yeah. But it's likely not to work. So if you have planned what you're going to do, nothing is ever going to work out to plan. But you'll have a framework which will allow you to understand if you should buy stock, hold stock, or sell stock. If, as an example, the aforementioned amalgamated moose pasture, let's say I think that there's a, 25% chance that their drill program will enjoy initial success and that they will prove that the deposit extends to depth in the same sort of strata geology that they had anticipated. And that answering that means that they have a legitimate target defined in a third dimension with a drill hole. And this dollar stock should go to $3.50. And let's say just for fun that happens. They drill a hole and their success is validated and the stock goes up. You don't necessarily sell if your target has been met. What you do is you repeat the process. with the information available to me now, what's the next unanswered question? What's the time frame? How long does it take to get a yes answer? Mm-hmm. By contrast, if Amalgamated Moose Pasture drills the hole and they miss it, and the stock goes down from $1 to 70 cents, when my reason to own a stock goes away, the stock goes away.
Yeah.
I would much rather lose 30 cents than lose 70 or 80 cents. It's important that people abandon hope. Hope is not an investment strategy. If the reason to own a stock goes away, the stock must go away irrespective of the price. Don't find yourself a new question to ask to justify an existing mistake.
That is such good advice. And it sounds so silly and simple when you say hope is not an investment strategy, but I think we've all been caught in that. Well, I can relate to it, where you buy something, the price goes down, you still have confidence, but news has changed and you're kind of wondering if speculation is going to pick it back up again for you, right? And you can sit on that all the way to zero.
And the opposite is true too. I've learned very well from a couple people in our firm, Dr. Neil Adshed, who's like you from Vancouver, Steve Toderick, who works for us in San Diego, both great geologists. I've learned that sometimes after a successful drill hole, a stock is cheaper at $3 than it was at $1 because you have information available to establish value. It's just important that your speculation be rationally based, empirically based, and information based. It's important too, Jay, in order to do that you don't own too many stocks.
Right.
You may know that I, for free, evaluate people's portfolios for them. And I've evaluated about 20,000 portfolios in the last 12 months.
Wow.
And one of the things that I've learned is that many people own many too many stocks. It's impossible for them, if they have any lives whatsoever, to monitor as many stocks as they have. It's impossible for them to make the connection between price and value. It's impossible for them to keep up on the news. It's impossible for them even to monitor insider filings in that many stocks. It's an impossibility. I would argue that most of your listeners would be well advised to have the number of speculative stocks in their portfolio correspond to the number of hours per month that they're willing to spend working on their portfolio.
Right.
Willing to spend 10 hours a month? Focus on 10 stocks. Willing to spend 15 hours a month? 15 stocks.
Sure.
Not willing to work? Don't own stocks.
Right. Yeah. Okay, I'm with you. Well, that may lead to another question I had for you. Why should investors who are entering the sector on the back of a discount trading brokerage like Robinhood, E-Trade, Q-Trade, etc., consider a broker in the junior mining business, Rick?
Well, the easiest way is how much work you're willing to put into it.
Yeah.
If you believe that information is worth something, then you need to know that you have to pay for the information. If something is free, if anything is free, if any product is free, what you need to understand is that you are the product.
Sure.
So as an example, if you're going to Robinhood, they sell your order flow to a market maker. Their investment advice is worth what they charge for it, which is to say nothing. If you believe that you are adequately versed in exploration, if you believe that you have sufficient geological knowledge, sufficient financial knowledge, and are prepared yourself to monitor those aspects of your speculation, you don't need any assistance from a broker. If you don't believe that, then perhaps you do need assistance with a broker. It's interesting to watch good shoppers, generally female, in a grocery store, reading labels, comparing cost per ounce, doing all the things that rational consumers would do, and juxtaposing that with the way people buy stocks, which are often bigger ticket items. The idea that somebody would spend substantially more time and attention buying a $2 can of tuna fish than they did placing a $10,000 stock order has always bewildered me. Mm-hmm. But it is a fact of life.
Yeah, you're not wrong. Okay. Want to wrap it up with some forecasts, Rick. 2021, what commodities? Maybe try to pick two for me. Two commodities most bullish on.
going to be a good year. Precious metals, the wind is in your sails. That isn't to say it's not going to be volatile. I mean, it doesn't mean that we're not going to have sell-offs. But the wind is in your sails. Governments around the world are debasing currencies. Quantitative easing, if it was done by Jay Martin, would be an indictable offense. You'd be in jail. But if you were a member of parliament, it would be highly popular and it would get you reelected. No doubt it debases the currency. Debt and deficits, debasing the currency, wrecking the savers of people in conventional instruments. Negative real interest rates, debasing the currency. Zero doubt in my mind that people need to own precious metals and precious metals equities. Good ones and speculative ones if they're willing to do the work. For a flyer commodity, although it has performed a little too well in the last 2 months for my liking, would be uranium. You need to buy things that are cheap, and uranium is cheap, that are hated, and uranium is hated, that's why it's cheap, but are already in an uptrend, which uranium is already in an uptrend. So from a sort of a speculative flyer point of view, I like the uranium trade. What could go wrong? Well, there's too few uranium stocks for one thing. Right. It's not even an asset class anymore. A faltering economy could limit demand for electricity and hence slow the pace of reactor construction and restarts around the world. Or you could have a repeat of Chernobyl and 3 Mile Island and set the industry back. Right. But a uranium bull market is a truly rare event. And there are so many people around who remember the last one. And the arithmetic, not the narrative, but the arithmetic around uranium is so compelling that I think if you want a flyer story, you asked me for two, I would go to uranium. Mm-hmm. My favorite commodity, mineral commodity, has probably always been copper.
Okay.
But the copper market is, from my point of view, I've been wrong for a year, mercifully, way ahead of itself. And one last commodity, you asked me for two, I'll give you four.
Sure.
Canadian oil and gas.
Interesting.
Way oversold.
Yeah.
Nice dividend yields.
Yeah,
Canada has spectacular natural resources and also has spectacular human resources in the oil and gas business.
Okay.
The only thing wrong with the oil and gas business in Canada is Ottawa. And I'm not trying to say that gets any better. But if you want to find a commodity that is cheap and unloved, but in a rebound, it's oil and gas. And in this continent, at least, the most unloved oil and gas in the continent is in Alberta.
Mm-hmm. Okay, that's excellent. Rick, thanks so much. This has been super valuable. You know what? I got one more minute here. I want to just clarify one thing if I can. I've heard you, because I've heard you say this a few times. There's uranium bull market is something special, right? I've heard you frame this differently than I've heard you talk about other precious metals and the sentiment surrounding them. And I can say from experience, whenever we build a uranium feature at a show or online, the audience is ferocious. I mean, it's amazing how enthusiastic, even in a depressed market, 7-8 years in, it's still always a packed room. It's an incredibly loyal following, it seems. So what is it about uranium when you say, okay, they are super rare, yes, it's been very depressed, but what strikes you about uranium specifically?
Well, for a small part of the market, the part of the market that's rational and logical, the arithmetic is so compelling. Uranium supplies 15% of America's electrical demand, 20% of the baseload demand. If the uranium price stays too low for too long in the United States, the lights go out. It takes about $50 a pound, fully loaded, not cash cost, but fully loaded, to make a pound of uranium, and they sell it for $30.
Yeah,
losing $20 a pound and trying to make it up on volume. If the price of uranium doesn't increase to the incentive price in 5 or 6 years, the lights go out in the United States or Canada. What do you think is more likely? The lights go out or the price go up?
Right.
And that one's fairly simple. The second thing is that the experience that people enjoyed, some of us enjoyed, in the last bull market was so extraordinary, if we got in early, that you have a class of old, fat, rich investors like myself who would like to experience that one more time before they die.
Right.
The taste of a market. And let me put this into perspective for you. There were 5 uranium juniors at the beginning of the last bull market. The poorest performer in my memory over 6 years, the poorest performer went 22-1.
Okay.
So when you ask why, first of all, it's a compelling story. And second of all, there's an institutional memory of what can happen if you are on time and right in the sector. It's a very potent combination. It's at once a reality and an extraordinary dream.
Okay. Thank you. Now, you mentioned you are willing to rank investors' portfolios. I strongly encourage people to do this. Essentially, you send your top 10, top 10 stock picks.
Any number
over to Sprott. He'll get back to you with, he'll rank them.
Yeah, let me make the offer specifically. Go to a website, SprottUSA.com/rankings. You'll find a drop-down form. Enter your portfolio there. Names and symbols, please. I'm too old to know all the symbols. I will rank them personally, 1 to 10, 1 being best, 10 being worst. And I'll comment on individual issues where I think my comments might have value. Please, no pot stocks, no psilocybin stocks, no banks, just stuff I have a hope of understanding. In addition, if you include charts in the subject line of your request, I will send back the Barron's Gold Mining Index, which is the longest running, most inclusive gold equities index on the planet. Not because I'm an adherent necessarily to technical analysis, but because it's a wonderful visualization tool that talks about the duration and dimension of gold bull markets and also points out the volatility in gold bull markets, which gives speculators the intestinal fortitude to handle fairly common 15 or 20% sell-offs.
Right.
And I'll also include a 100-year commodity chart, which will provide visual evidence of just how cheap industrial commodities are relative to other asset classes going back 100 years. Once again, SprottUSA.com/rankings. I'll rank your resource portfolio. If you want, I will send you these 2 charts, not as a technical tool, but rather as a visualization tool.
Yeah. Okay. Thanks for that. It's silly not to participate in this. Coming back to how much work is involved, vetting these companies, trying to pick the winners. Why wouldn't you send your portfolio over to Rick and get his thoughts? I've done this and he fired back. I sent him 10 stocks. He fired back best to worst with comments beside each. And he doesn't pull any punches. He told me most of them are too expensive to buy right now. So he's honest about it. Okay, Rick, I really appreciate your time. And it's always a pleasure having you on the show.
Jay, it's my pleasure. And please give my regards to your entire family.
I will. Appreciate that.
This mine will run for 20 to 30 years.
All right, ladies and gentlemen, my name is Jamie Keach from Resource Insider, a mining investment newsletter. And today I'm here on behalf of VRIC, the Vancouver Resource Investment Conference 2021, to talk to some great companies, meet some great CEOs. And today we're sitting down with the president and CEO of Victoria Gold Corp, John McConnell. And we're going to talk about Victoria's Eagle Mine, everything that's going on up there, and the company, a producing gold mine in the Yukon. So without further ado, John, thanks for taking a few minutes to sit down and talk to me today.
Thanks, Jamie. Hello, everyone.
All right. So for those who have never heard of Victoria Gold, and I imagine there's only a few out there, but can you give us the 30,000-foot view of who you guys are and what you do?
Sure. We're a publicly traded company on the TSX. We moved from the venture exchange late last year. And we operate the Eagle Gold Mine in Canada's Yukon territory. In full production, we'll be producing roughly 200,000 ounces per year at an all-in sustaining cost over the life of the mine of less than $800 per ounce. So big margins at current gold price.
So, okay. I'm looking at your share chart right now. And, in preparation for this interview, I was thinking back to when I actually went and visited the Eagle Mine with you. And I believe that was in summer of 2015. And if I look at the chart now, you guys were trading at about $1.60 at that point. Today, as we record this, you're at $12.76. So, it's been a pretty big 5 years. And, if I remember back correctly at the time, you were still you hadn't even really begun development at that point. So, can you give us a little bit about this journey of how you created so much shareholder value over the last 5 years? And then maybe we can talk about what comes next and what potential shareholders of Victoria can look forward to, and what the key catalysts are over the coming months.
Sure. I'm sure many of your viewers have heard reference to the Lassonde chart, or the life cycle of a junior miner. And, there's two times when you make money on a junior. One is at the discovery stage. We're well past that. And the second opportunity is as a developer is moving from building a mine, moving into full production. And that's the stage we're at now. And we've seen that re-rate as we came through construction and into operations.
Okay. And how much are you currently producing? How many ounces did you produce throughout 2020?
I don't have the exact number. It was just over 100,000 ounces, but in the fourth quarter, we produced roughly 45,000 ounces. So, if you just do it quarter by quarter, we should be producing 50,000 ounces per quarter.
So, you said 100,000 ounces roughly over the year, almost half of that in the last quarter. What was going on over the previous 3 quarters? Was this all part of the ramp-up period? Were there delays or issues? How do you explain so much of that return coming in the last part of the year?
Yeah, there's two things. One is, as you said, mechanical issues. Sometimes chutes aren't designed right and you have to redesign them. In our case, we found the material was more abrasive than we'd anticipated. So we were going through liners and things like that at a far faster rate. And, then you look to find different types of liners. There's harder metal. You can go to ceramics. Sometimes, it's a rubber liner, but it's a little bit, there's lots of smart people that have experience with this. Mm-hmm. Unfortunately, COVID prevented us from bringing those people in. So you can imagine trying to diagnose an issue via a Zoom call as opposed to having the expert on site.
Yeah.
But, come July, August, we were able to get that expertise onto site, and it's no longer an issue. So, the second aspect of the ramp up is this is a heap leach operation. And, we're seeing that a full recovery cycle of gold is close to 200 days. So, we're actually taking gold off now that would have been stacked on the pad, almost half a year ago.
And so this is just part of that natural ramp up, and I guess sort of the heap leach really hitting critical mass of functioning properly.
Correct. And, we feel we'll get to steady state production sometime in the third quarter of this year.
And is steady state production 200,000 ounces per year? Is that
a little more than 200, but yeah, that's a good number.
And John, I don't know the answer to this. What is the life of mine of the Eagle? What is the life of the Eagle mine?
Yeah, based on the reserve, it's 11 years. but we're having good success with exploration as well. The feasibility study was done at $1,250 gold, and certainly at a higher gold price means you can go deeper. So we're actually drilling some deep holes now to explore at depth. And my gut feeling, I've been in this business for plus 40 years, is that this mine will run for 20 to 30 years.
So today, as of today, you have, almost an $800 million market cap within the company. Let's talk a little bit about the financials of Victoria. Do you have significant amounts of debt? Are you cash flow positive? Do you have cash in the bank? What does the general financial situation look like?
Yeah, we have roughly $175 million in debt. We've paid down ballpark 30 or 40 million this past year. We refinanced the original project construction debt just before Christmas. So our lenders are now BMO, CIBC, and BNP. The refinancing was done at a much lower interest rate. We save about $10 million in 2021, so quite significant.
Yeah, I guess it's you get a much better deal on that when you're in production than when you go out for those sort of debt financings pre-production, I assume.
Well, the project's de-risked, and certainly, BMO and CIBC in particular did their full due diligence before they would refinance the project debt. But, they see it as a very low risk money lending situation now.
And how much cash are you guys generating annually now? Or maybe I should ask, how much do you anticipate generating in 2021?
Well, you tell me what the gold price is going to be, and I can give you a pretty good idea, but it'll be somewhere north of 150 million in free cash flow, US.
Okay.
So roughly 200 million Canadian in free cash flow.
200 million Canadian. All right. So let's talk for a minute about what it is like working in the Yukon right now, both with COVID going on and I guess generally speaking. Have you had any issues on site in terms of getting your staff there, keeping people safe and healthy, keeping things operating effectively over the last year?
No, it's been very good. Recognized COVID was going to be an issue quite early on. To give you an example, we didn't send anyone to PDAC. We, saw the writing on the wall and said, this is going to be an issue. And so my whole executive team and I, we went to site and put together a plan that would keep us operating. Met with government officials and, said, here's our plan. And, they worked hard to allow us to keep operating. Now, we did some things like we went from a 2-week in, 2-week out schedule to a 4-week in, 4-week out schedule. And, that's been hard on people. So we're actually going right now in the process of going to 3 weeks in, 3 weeks out. And people say, what's the difference? Why is 4 weeks hard? And, you're from BC, it's roughly a 12-hour drive from Vancouver to Calgary. So if you can imagine driving from Vancouver to Calgary every day for 28 days in a row, that's what working 4 in, 4 out is like. So
yeah,
it's hard on people, and we start to see productivity losses, after 3 weeks. So. And people are away from their families, so it's been a trying time for a lot of people. If your wife is home with a couple of young kids and you're away for 4 weeks, that's hard on everybody.
Yeah, no doubt it adds up. So they're making that transition to 3 weeks. Are most of your employees, are they based in the Yukon, or are they coming from all over Western Canada, perhaps?
Yeah, we've been very successful at recruiting Yukoners and bringing Yukoners home. So roughly 50% of our employees are Yukoners. I would say probably 30% come from British Columbia and 20% from the other prairie provinces.
So, as I understand it now, you guys have about just over 3 million ounces in reserve at Eagle. Is that right?
Yes.
And you are the biggest gold mine ever in the Yukon, correct?
That's correct.
So, when I look at the Yukon, and I've looked at many projects there, you know, there are a few places that compare to it geologically, but there are challenges working there. There's challenges with infrastructure and energy costs and access and all these things. You guys have been able to clearly very successfully address that. Are you looking seriously yet on behalf of Victoria at, I guess, M&A prospects within the territory? Are you looking at acquiring other projects? Do you think, you know, this is sort of the starting stage of a real Yukon-based multi-asset mining company?
You know, we look at a number of jurisdictions. We're not quite ready to enter any sort of M&A process. We feel, you know, 100% of our time still needs to be focused on getting Eagle up and running and optimized. And, you know, so we keep an eye on what the other companies are doing in the Yukon, but I don't see anything right now that's at the stage Eagle was when we acquired it 11 years ago, back in 2009. So we keep an eye on what people are doing, and there's certainly some great companies that are exploring in the Yukon, but there's nothing in our sites right now, you know.
And what made Eagle so unique? Was it you know, its access to infrastructure? Was it the advanced stage of exploration? How did that stand out for you particularly?
Both of those. I mean, you know, it was something you could drive to, had a power line within 40 kilometers, was a large deposit. As I said, I think this, you know, will run for 10 to 30 or 20 to 30 years. People, you know, point out that it's low grade. For a heap leach mine, it's probably average grade.
And what is that average grade?
0.65 grams per ton.
0.65%.
But, you know, what people forget is that when you look at a open pit heap leach operation, there's three things you have to consider, you know. And one is grade, obviously, but the other big one is strip ratio. So the number of tons of waste you have to move for every ton of ore. In our case, the geometry of Eagle is such that over the life of the mine, the strip ratio is less than 1-to-1. So we move less than 1 ton for every ton of ore.
Yeah. Can you give up people an idea of how unusual that is? And you know, I've seen mines with strip ratios of 10-to-1, 15-to-1. I mean, there are very, very few operations in the world with such a low strip ratio. And I guess I assume that largely accounts for such a low cost of production per ounce.
Exactly. You know.
So, John, you know, before we say goodbye, there's going to be a lot of investors watching this conference. There's going to be a lot of companies presenting. A lot of people are interested in gold, getting exposure to gold, making money over what they see and what I believe is going to be a very significant bull market over the coming couple of years. Why Victoria over your other mining competitors? How do you guys stand out compared to other mid-tier mining companies?
I would say, you know, the fact that we'll be cash flowing $200 million per year, you know, at current gold prices. You know, I think, you know, if you compare us to many of our peers in terms of metrics like P/NAV, we're at the low end. And I think as we prove that Eagle is up and running properly and we're cash flowing, people will see that, you know, we are probably an easy double over the next 12 to, 24 months. You know, with Victoria, unless gold price goes to $5,000, we're probably not a 10-bagger. but we're pretty easy double over the coming months.
Is there an environment where Victoria would ever pay a dividend, or is that not on the table?
We certainly will, I would expect we'll have paid down a significant portion of the debt by the end of the year. And I would think that's a discussion we'll have at the board level in the fourth quarter. But personally, I own 1% of Victoria, so I have a very large shareholding, and I'd love to receive a quarterly dividend check.
All right. Well, thank you very much for taking the time today, John. Any parting thoughts that listeners should be left with? Anything I haven't covered?
No, I think you've done a great job, Jamie. And I think
all right.
People should have a good look at Victoria.
Well, guys, thanks for watching, and you're listening to John McConnell from Victoria Gold Corp. That is VGCX.com, and you can find out more information there. I'm Jamie Keach from Resource Insider, and you are listening to the Vancouver Resource Investment Conference 2021. Thank you very much for watching, guys.
Thanks, Jamie.
Never been more excited to be a shareholder and a part of this company than I am today.
The price is very inexpensive at the moment.
Yeah,
so it's time to get in now.
Hi, I'm Veronica Van Wollen, and we're joined today with White Gold Corp. We have Sean Ryan, Chief Technical Advisor, as well as David Onofrio, CEO. How are you guys doing? Thank you for joining us.
Yeah, we're doing great. Thanks for having us.
Yep,
we're excited to be here.
Thank you.
Excellent. Well, we're excited to dive into it. So for anyone that doesn't know about White Gold Corp, you're listed on the Toronto Stock Exchange on the venture. You have the ticker symbol WGO. You also have an OTC and a Frankfurt listing. And for anyone new to the story, I know you guys are exclusively focusing on exploration of gold in the historic Klondike region in the Yukon. So we're going to get into that. And I know you have two very significant backing by Agnico as well as Kinross. So to start off with, let's dive into a summary of the company, and then we'll go from there.
Perfect. That would be great. And I think that's, the most compelling part of this company. I've been in this industry for a long time. I've had the good fortune to be invested and involved with some incredible teams and assets throughout the world. And through that process, when you are successful, it really sort of validates why we kind of put it in the time and effort to really try to, find these special opportunities. And, looking back, you sort of say, what did that process look like? And, how can you really, improve your odds of creating success in that regard? And, what is that process? You find a piece of property, hopefully in a good jurisdiction that has some, interesting prospectivity. You raise a little bit of early high risk capital, you do some work, you define some targets, maybe the next year you're able to drill it, you come up with something interesting. If you're really lucky, you have a discovery and you raise some more capital, you come back, you maybe can delineate a discovery, delineate a deposit, bring in some real institutional shareholders if you're lucky. And then over the course of what would probably take, 7 or 8 years, you come to realize, the dream of all exploration investors is to either have that asset taken out or, bring in a major to help sort of move it to the next level. And what White Gold is, it's all of that. White Gold, its projects anyways, have had tremendous success over the last decade. White Gold's a very new company. We're bringing these assets that have seen all this success back to market and in a very strong gold market. It's actually the perfect storm. And what that's all accumulated to is a flagship deposit, which is just under 2 million ounces, over 2 grams, open pittable. We've attracted and invested through the legacy companies over $100 million. We've been able to attract 2 major mining companies, being Kinross and Agnico, as partners. We've attracted Eric Sprott to be an investor. We're backed by the Power One Group. And we're in a tier 1 district, the Yukon, Canada, an area that's seen 20 million ounces of gold surface mine placer from the creeks over the last 100 years. This was all put together by the notorious Sean Ryan. His work in the district has led to 2 major discoveries, the most recent of which was acquired by Goldcorp for over $500 million. And what we put into White Gold now is basically the 80% of the targets in the district. That's 40% of the land area. We're talking about 400,000 hectares, 1 million acres. And just to put into context, the majority of this has only seen limited surface type exploration. Based on what we've seen, we think there's a very high probability for additional success. This is coming from the people who've had all the success in the district. And to me, it's really like owning the majority of a district, like the Abitibi, like Timmins, like some places in Nevada, but right from the very beginning with the backing of this incredible team that we have and the guys that have done it before in the district.
I want actually to give Sean the floor here, because for anyone who doesn't know, Sean, you bring quite the pedigree to the table. I know you've been responsible for 2 major discoveries in the last 10 years that were acquired by major companies, and you have won Prospector of the Year. So Sean, why don't you tell anyone that's new to White Gold kind of your pedigree that you bring to the story here?
Well, we've been working this district since I came up here in the early 90s. And the idea was, but we really started prospecting in 96. So the point is things take time. And the idea is what we really did different that led to all these discoveries is really the science of using soils to hunt these. Basically, what we're doing is looking for mineralized systems. And the idea is that soils map it out. You don't know where the needle is sometimes yet, but you've got the haystacks marked out. So that's kind of what we've done now. And we've made the discovery of the white that happened back in 2008. Once they started drilling that, and Kaminak, the coffee project, was 2010. So the idea is that then we found another one, Comstock, was another claim block of ours across from the white, and that was another QV, another smaller deposit. But these things started popping up out of I used to be a mushroom picker, and that's what they're doing. They're starting to pop up. But what the soils led us to do from the science point, why I think I believe in the district, I'm a prospector, but the idea is that we were able to map out with well over 400,000 soils in this big district. We know where the mineralized systems are, where the cracks are, with the juice that are moving through. Now, are they economic grades? That's the challenge, to find the needles in the haystack, but we know where these mineralized systems are without a doubt. So the idea now is we're slowly honing in on it, and the hunt continues. But realize, like, I'm from the Timmins camp, and they're looking for gold 1,500 feet below surface. And here I am out there with these, I call them tulip planters, but they're soil augers. And you could actually see, like, you could map these mineralized systems out. So I could still find stuff 3 feet below surface.
Wow.
So that's what's kind of unique about the Yukon in that way, versus you're just selling swamp in the Timmins country. It's high value potential swamp, but you can't do too much more as a company and prospector. It costs you a lot of money, like, to continue on. But here we still can as a prospector. But the fun part about this is we're literally still looking for, it's not going to be one source that produce all this placer gold. Like, there was over 20 million ounces, but there's numerous sources. And so what I did is I put all my projects into one company, believing that, if you find 2 or 3, there's got to be more. And if you break it up into 10, well, you may have 8 to 9 losers. But if it's in one company, that should be the winner. And so that's what we're up to now, is the hunt continues, and we're just understanding more and more every year. And that's what the fun part about this is. It's science driven. And that's what a big chunk of this is.
So that's what we have here, right? Is all eggs in one basket in White Gold.
Yep. And that challenge was to do like the majors did in the early 80s. That's when I started exploration, which was when you had a super company, a major company. They looked at regional structures. They looked at the airborne geophysics. They looked at the soils. They had teams of that. And that's kind of how I worked with them. And that's what I learned. And so, but nobody's applying that science to a district because they're focused on one property. And what we're trying to do is step back and act like a major. And so now that we own the camp, so it's kind of, so this is the opportunity. And if we're lucky, a high probability of 1, won't be surprised that 2 deposits, should be 3 in there somewhere over the next few years.
No, that makes sense. And I want to get into what 2021 has in store, but let's first reflect on 2020. What were the main highlights from last year?
Want to jump in, Dave? Or?
Sure, yeah, I'll touch on a few things. So 2020 was a really successful season for us. You know, we're still in the process of receiving some of the final results, and we'll be continuing to release those to the market in the coming weeks and months. A little bit of a smaller program than we've had in the past couple of years. Just, you know, with COVID, there was some delays, and out of an abundance of caution, we wanted to dial it back, keep the camp size a little smaller, just to sort of manage risk as best as we can. Touch wood, you know, we avoided all risk, and we're able to do as much as we hoped and a little bit more. The program in 2020 was divided into sort of 3 buckets, you know, and that's typically what we did. If you look at our portfolio of properties, we categorize it as our advanced stage stuff. This is, you know, like our Golden Saddle, you know, 1.8 million ounces, and our other advanced projects, looking to find opportunities to show, you know, the ability for that deposit to continue to grow as it has. You know, when we bought that, you know, the company, we mentioned, you know, this has all been happening for about 10 years in the district. White Gold was really only formed in the middle of 2016. So we're still a pretty new company. Part of that formation was actually buying one of Sean's original discoveries, which Kinross owned, and taking that over. Well, actually, we didn't buy it. Kinross rolled that in for their equity interest in White Gold, and they became a 20% shareholder alongside Agnico, who was one of our initial founding funders. And, you know, basically for them, they saw the district, you know, they love Canada, they did great work, you know, operators in the north, and they needed to be a part of this. And, you know, that's how we were able to establish our initial relationship with them. So that asset there, we bought it 3 years ago. It was 1 million ounces. You know, Sean had discovered it. The team that worked on it was part of White Gold. They said, guys, this thing here, there's still a lot of meat that can go on the bone. Let's take, you know, theoretically we're a project generator, yet we're bringing a project in. But it's just because we knew that we could sort of, within a short period of time, really sort of expand the size of that and the prospectivity. So when it's ready to be sort of moved out, it'll be worth a lot more. And, you know, fast forward 3 years, we've increased the size by about 60%. You know, fortunately, we bought it in an environment when gold was 1,100, gold's over 1,800 here. You know, we had nothing to do with that, but, you know, it's just sort of a play on the commodity, which has worked out in our favor. So we've done a tremendous job in increasing the value there. And where it stands now is, you know, probably in the top decile of, you know, the pre-development stage assets in Canada. It's just under 1.8 million ounces. It's over 2 grams. The majority of it's open pit. So that really stands out, you know, in terms of the assets in Canada. And I think, you know, it's gotten a lot of attention. I think it'll continue to get more and more attention as, you know, the M&A activity heats up in this cycle that we're in here.
So do you plan on selling off any of your assets, or is that part of the plan for 2021? If anyone's looking around and seeing anything that they want to buy, would you spin it off or sell it off?
Yeah, so that's the $1 million or multi-$100 million question, I guess. We are not, you know, mine builders. Our team, we're explorationists. We have an incredible track record. You alluded to Sean being, you know, Prospector of the Year. That's one of many of the awards he's won. We built an incredibly accomplished team around Sean. And so we're looking to maximize the value of those assets to a company like us. Now, what does that next step look like? I can't tell you today because I don't know specifically. Obviously, we have 2 majors as partners. They've been incredible partners to date. They're, you know, presumably they could sort of look to take those assets off our hands, advance it to the next level. They can do that in combination, perhaps, with us as a separate spun-out vehicle with another group. You know, so it's a hard answer for me to give you today. The good news is that, you know, there's certainly, it's the right market to do it, and there's a lot of interest and motivation to sort of look to take that particular asset for sure to the next level. And I think, you know, there's a lot of value that can be and will be created for White Gold shareholders. You know, sadly, you know, where our shares are trading at now values that deposit itself at about, you know, $35 an ounce. I think the average is probably double that. And that's without giving any credit for the balance of this 1 million acres, you know, we discussed earlier. So Certainly it's getting attention, and I think in this environment, we're going to look to take advantage of that. And obviously do something that's smart for the shareholders. Our group, Power One, we're the largest shareholder along with Sean and Nico and Kinross. So, we're kind of all aligned here to figure out what's going to make the most sense to realize the value. Like I said, this is not some new discovery. We know what's there. We know there's a lot of value. We're pretty sure that this thing could be, a robust economic, 100,000 type ounce producer. We're fortunate to be in a great jurisdiction. The Yukon has been nothing short of exceptionally supportive. They're building roads in our district to help support the advancement of exploration and development. So, all the chips are really falling into place to optimize the value of that asset.
Yeah, that was the original intent of the company. When you throw all your eggs in one basket, is that the idea is once we make like a bona fide good discovery that has legs, then if it's going to cost a heavy lifting to get to the next level, that's when you either spin and co or joint venture it out.
Got it.
And, if we do and I look at that as kind of like dividends paying. If you're a white gold holder, shareholder, if you get spin co, basically paper, it's kind of like a dividend. So that's kind of how I'm looking at it over the long run here.
Yeah, that's over the long run. I want to focus on today, though, because we are seeing quite a disconnect with the share price. I know you have some analysts saying that white gold should be at over $3. So why, in your opinion, is there such a disconnect in the market cap?
I'll tell you my suspicion.
Going on?
Having too much going on in a company is a little bit of a double-edged sword, right? The story gets a little bit confusing. Where are you focusing? Are you trying to develop this thing? In my view, white gold's effectively 4 companies combined into one. And I'm pretty confident, based on my involvement in the capital markets exploration space for, over 15 years now, if these were each listed as their own independent companies, the sum of the value of those companies would certainly be far in excess of the market cap of white gold right now. So I think partly it's taken these types of opportunities to really properly articulate the story, allow people to realize the value, start to sort of show that we're able to execute on this plan of monetizing the value in some of these assets. And, I think, once we can sort of demonstrate that, maybe perhaps see a little bit of increased activity in the Yukon. If you remember, 10 years ago, it was a mad, modern gold rush that slowed down a little bit in 11, 12, 13 when the junior market was depressed. But I think you're starting to see it come back online. Victoria Gold's gone into production. More juniors are heading up there. Newmont's doing some great things in their coffee projects. So I think we're going to start getting some momentum in that regard as well.
Sean, do you want to add?
Yeah, like the big part is like people don't realize the asset value, and that's what we're not given. And that's fine because that's what Dave's talking about. They're just giving it to us. So until we get a SpinCo, or a joint venture, but SpinCo will be better for everybody. Then the idea is that then people are going to believe. But really what's coming down the pipe is kind of like the Beaty project that we have. That was everybody's favorite project when we went into this in 2016 with white gold. Well, we were there in 2018 and drilled some 50 meters of 1 gram plus material, and we haven't been back drilling it yet. So next year we're going to go in there. But that was that's tied on to the Gold Corp or the Newmont project. But we just basically started working another project called Bonanza, right on Bonanza Creek, 6 million ounces of placer. And basically they're starting to find something at the headwaters, and that's the original stuff they were finding on the Lone Star. But after our work this summer, we're sitting there right behind the dredge, right in prime country, elephant country, and we're just getting ready to bat. So the whole point is like these cards are still coming in. So like I believe in the statistics that there's going to be, at least 1, high probability of 2 or 3, and maybe more, because we're just starting to understand it. So, but until we get one SpinCo, because this is what's going to happen. The Beaty is, if we start hitting some nice stuff on there, well, that within a couple of years will turn into a potential. What are we doing with it? So that's what we're doing as a company. We're trying to figure these cards out. JP Ross coming down the chute is another high quality asset. That's, it's joint venture potential or spinco. So, but these are the kind of projects that we're moving through the pipe.
Right.
The big one will be once we get the first one through, then people will be believers.
What a segue to talk about what investors can anticipate for 2021. So what are those kind of key milestones that are going to, make the needle move here that investors can expect?
Well, I think the first one is if we basically what we're trying to figure out what to do with this white, because this Ryan surprise area that we found that we've been kind of hitting it a little bit, just a couple of holes a year for the last 2 years. This year we went in a little bit. Well, we put, I think, 5 or 6 holes. But the idea is that we found a bunch of, it was kind of blind ore. It was a blind target underneath the cap rock. And that's, from a significance point of view, that's what we needed to see on the white, because we've been chasing just basically stuff that's on surface all the time. Now we're proving the district's got more meat to it. And so we got to figure out what we're doing with that asset. But then, like I say, then we have the JP Ross. We're going to look at that because we've set up that for some diamond drill targets. And then we're thinking of next year putting in the queue some diamond drill holes on the Nolan. We've been working up in that part of the world by the 60 mile. We did some shallow holes historically, but we know this is a juiced up structure that near vertical. So we're going to chase it with probably a few diamond drill holes on that one. And then we're actually looking at the IND also. So it's not the IND, the dime. And the idea is that one, we had some success and we kind of left it, but that's kind of how we've been working. So now we're going to actually go into there with probably a small diamond drill program. So the idea is we're going to scatter our kind of cards, because this is what we're playing as a probability game, and then hit the Beaty, the JP Ross, the Nolan, and the dime with the diamond drilling. And then we're going to get probably our Bonanza and our Heart Mountain target that turned into a fast, about a 4 kilometer gold anomaly. That's basically, so that's a system and it's a robust system. So we're going to go in and tweak that up with probably some trenching and some rab drilling and get those queued in the queue for 2022.
Yeah.
So
David, do you want to add anything to that?
Yeah, I think that's a great summary. Everything that we've done, we're identifying sort of multi-kilometer trends. Sean mentioned the Ryan surprise. We did 6 diamond holes. They all came back with high-grade gold this year, 18-gram type material. It remains open in every direction. It's 2 kilometers from the Golden Saddle. That's a prime opportunity to increase the ounces there. And some of these other targets, we continue to make new high-grade discoveries. We're increasing sort of the size of this mineralized trend. And, the more we learn, sort of the more confidence we have in our other projects, and the more confidence we have to come back and invest to follow up with some, more detailed type exploration with the diamond drill. So, we've done it every year. This year was, also very successful, and, we're looking forward to follow up on that and hit some of these very highly anticipated properties that we haven't had a chance to do much work on yet.
That's exciting. Okay, I know it's crazy how quickly time flies. I feel like we're just scratching the surface here, but I want to leave it off with, I guess, the most important question for any new investors looking at the story. Why should they invest today?
I think now, you have a very special story. We're right about to sort of get our planning work laid out for 2021 program, which will start up in the late spring. We're in a very strong gold environment. You have a company here with great assets, great prospects, great shareholders, great team. A lot of companies say that, but this is proven. It's company's had over $100 million invested. I've never been more excited to be a shareholder and a part of this company than I am today.
And you got to say that the price is very inexpensive at the moment. So it's time to get in now. You're at the bottom.
White Gold Corp, we had the pleasure of Sean Ryan as well as David D'Onofrio joining us here today. White Gold is listed on the Toronto Stock Exchange under the venture with the ticker symbol WGO. You also have an OTC listing and a Frankfurt listing. Thank you so much for joining us.
Thank you, and stay tuned. I think the best is yet to come.
If you are just tuning in, my name is Jay Martin. I am an investor and the CEO of Cambridge House. Now, what we're doing today is diving deep into a handful of resource investment opportunities, talking to the company CEOs, and in addition, stress testing our investment ideas and strategies with some of the most prolific money managers that I know in the business. Now, the reason that I do this is because I'm an investor first and I'm trying to grow my portfolio. In addition, I'm trying to identify blind spots I may have that would be compromising my decision making. I do this through conversation with industry personalities and company CEOs right here on the channel. Now, today we have a killer lineup of amazing content, and the whole agenda is right beneath this video in that YouTube description. Check it out, stick around. I'll be active in the live chat. Drop me a line, say hi. Please hit subscribe to stay tuned with what we're up to at Cambridge House, and enjoy.
We will have significant sovereign debt crises in the near years to come, very soon.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House. It is my grand honor to introduce our next guest, the 22nd Prime Minister of Canada, Stephen Harper. Mr. Harper, how are you?
I'm very well, and thanks for having me. I'm delighted to be able to attend, even if it's only through our virtual format this year.
Yeah, well, I'm looking forward to chatting with you, and thank you for your time. Next year, hopefully, we'll have you on stage where we do this in person. So I have a handful of topics I'd love to cover with you today. We're going to get through as much as we can in the time that we have. And when I was reflecting on where I wanted to start this conversation, I think we have to start with, call it the COVID spill out, right? So not necessarily the pandemic, but the economic fallout that's occurring and probably will continue to occur, because the most important question that we're always trying to answer, my audience is investors, Mr. Harper. So we're always trying to figure out what's next, right?
Right.
And the reason I wanted to start here with you is because you managed the 2008 great financial crisis. And we actually, as a country, Canada, we came through that very strong, right? We had the lowest debt to GDP of all the G7 nations. Articles are being written in The Economist about how Canada came out stronger than any of our peers. We also entered that crisis from a position of strength, right? Alberta had a positive balance sheet. I think we'd paid down something like $92 billion in federal debts in the previous 12 months, largely as a result of your government. And our banks, I guess compared to our southern neighbors, maybe we're well capitalized, right? So how much of that, because there were three factors at play, how you're moving into a crisis, how you manage the crisis, and then what happens next. But how much of our setup, moving in a position of strength, impacted how we came out of that event?
Well, look, I won't deny that obviously how we were positioned at the beginning was a big factor. This was, after all, a global financial crisis. And we did not have a financial crisis in Canada. We did not have the failure of a single significant financial institution, and the government of Canada did not have to bail out any financial institutions. We did. I tell people this is a part of the period that's often forgotten. We did enter into some interesting market transactions to sustain liquidity, including doing some paper swaps, short-term paper, long-term paper swaps with the banks, on which the government of Canada actually made money. I think this is probably the only time in history someone's made money at the expense of a major Canadian bank. But we obviously didn't have that problem. We had a strong federal balance sheet. Frankly, household balance sheets were stronger then than they are now. Corporate balance sheets were also stronger. So look, we went in a very strong position. But I would say that the government, we did do some things right as well. We did, of course, execute a large scale, quote, stimulus spending program. But we did, first of all, we delivered it through existing institutions. We didn't try to build new bureaucracy, which meant we got it out the door on time. And we wrapped most of it up within the 2-year time frame that we promised. Then, of course, we used the subsequent 4 years to get ourselves back to balance. And by the way, that part's very rare. Jay, this is what, I think the Canadian public in some ways took the wrong lesson from that. They took the lesson, okay, you can run a temporary deficit and get back to balance later. In fact, when governments run deficits, they usually become permanent. It's very rare that you actually come back from it. But I had, 2 strong finance ministers, and Jim Flaherty and Joe Oliver, and we executed that plan. Money out the door, activity created, and then getting ourselves back to balance gradually, and with, frankly, a little disruption. Obviously, we're in a totally different situation this time, obviously not as strong. It's a totally different kind of crisis, in fairness.
Yeah.
This time we're dealing not with a financial crisis or even an economic crisis. We're dealing with a pandemic that has become an economic downturn, recession, major recession.
Yeah. Okay, now I want to pick your brain just on crisis management, because when you're in that seat, and sure, during the 2008 crisis, you have, to really simplify, you have two buckets you have to balance. One is the immediate economic needs, right? Income disruption, business insolvency, corporate bankruptcies. And you have to weigh that. I mean, to solve that, you've got to create some stimulus. So you got to balance that against essentially mortgaging our financial future. Right. And so what conversations do you have in that moment?
So, look, each crisis is different. I would tell you that, having been there, the crisis is actually a little more complicated than that. That's the policy side of managing it. The real parallel for the government is you've also got to manage the communication side, which is, sending the public and markets and everybody else the right signals, frankly, in an atmosphere of constant media misinformation. And so that is a big part of the challenge you face. But as I say, in that particular instance, when it came to policy, we had a very, very clear vision from day one, which was we were going to spend money. We were going to spend money in ways that could be delivered quickly and generate meaningful economic activity, but that we were going to wind it up. So winding it up solved basically half of the deficit problem. The other half is the fact that the recession's knocked you off your long-term track. And then that required 4 years of, frankly, quiet but very hard work on re-engineering government expenditures, on, obviously keeping taxes low, but nevertheless increasing your revenues. So that was that's a very long-term plan. And look, in fairness, we thought, and I'm sure you thought back in 2008, 2009, we were doing a massive government spending and deficit program. It is, compared to today, nothing. It's an order of magnitude smaller than what has happened this time.
Right.
Yeah.
Now, I wondered how much of a contributing factor was it that we came out of 2008 into a commodities market and into a market where, the world wanted a lot of the resources that Canada had. And how much did that contribute to our recovery?
Well, look, I've always said that one of the great strengths of the Canadian economy is that we are very rare in being a developed economy that has the range of market strengths, all the way from some of the largest and best commodity producers in the world, all the way through to, secondary, tertiary service sectors and high tech. That's an advantage of Canada. On the one hand, for the government, it's hardly the case that everything's always firing on all cylinders at once, but it's very rare in Canada that everything is in recession at once.
Right.
And you can usually count on some recovery somewhere. Obviously, for my government, the commodity sector was important. I think we did a lot to encourage its natural advantages. And obviously, one of the things that concerns me today is, there's simply not the same, at the national level, simply not the same appreciation for and encouragement of the growth of the commodity sector, because that is coming. That is, Jay, once again, I think coming out of this recession, that will also be a potential benefit for Canada.
Right.
Parts of the world are going to grow, and some of them are going to start to grow, in my judgment, very quickly, very soon. And they will largely be in the developing world, and there will be big commodity demand. And Canada, as a safe, reliable, rules-based order of law producer of commodities, has a big advantage if it chooses to exploit it. So that thing that helped us in 2009 could just as easily help us today with the right public policy and attitude.
Okay, and I want to dive into that key point there. Last question on this topic, though, is if we look at what's unfolded, we talked a lot about 2008. I want to get your perspective on what's occurring now. Since March, there was an announcement of a global pandemic. We experienced this liquidity crisis in the markets, flight to US dollar. From then we transitioned into what you could call the hope phase, right? The Fed swooped in, stimulated the economy, replaced incomes. Everything's going to be all right. Maybe that's how it maybe seemed. And I'm wondering now, looking at sort of my peers in the entrepreneurial world, a lot of restaurant owners, hotel owners, you can't print small business cash flow. And so, are we going to experience some sort of an insolvency crisis?
Yeah, let me talk about that, Jay, because I think it's important for us to fully understand how different this crisis is, not just the pandemic, but how different the economic side of this crisis is.
Sure.
2008, 2009, we had a financial crisis that resulted in a recession, and for which the government's response, not just our government, governments around the world, in a fairly coordinated way. Our response was to have expansionary fiscal and monetary policy for the purpose of generating economic activity as quickly as possible.
Right.
Obviously, in the case of other countries, Canada was unique. In the case of other major countries, they were also intervening in the financial system to keep banks from collapsing and give them bailouts, whatever. We did not have that side of the phenomenon. We had a couple of bailouts, but obviously not in the financial sector. So this time, we've had a pandemic. In fact, we haven't had a financial crisis. What we had was a series of government measures in response to the pandemic, deliberately mandating a recession, an economic slowdown. Now, I don't say this blameworthy. I think governments, we can debate the degree, but had no choice but to intervene to create social distancing and try and stop the spread of the virus. But the result was that government mandated the recession. And government's intervention in this recession, for the most part, has been not to promote or not to spark economic activity, so-called stimulus, not to stimulate economic activity, merely to provide liquidity in the absence of economic activity. That's completely different than what we were trying to do in 2008, 2009. I should add, much more dangerous in the long term than what we were trying to do in 2008, 2009. And the consequences of this around the world, I'm not trying to talk about specific governments here. The consequences around the world are very clear. We will leave this recession, the world, with a debt overhang that dwarfs what we saw in 2008, 2009. And what we saw after 2008, 2009 was, after financial crisis, recession, somewhat of a recovery, was in a series of of sovereign debt crises in various countries, Greece and Italy and Portugal and Ireland, we know them. Mm. This time, the debt overhangs by governments as well as businesses and households are much larger. It's absolutely the case that we will have all kinds of solvency crises around the world, and we will have significant sovereign debt crises in the near years to come, very soon. A lot of that will depend, it isn't going to hit everybody equally. It will depend on the circumstances of the country, the circumstance of the debt. I could go into some of the considerations, but there is no doubt that we will have, governments will have fiscal crises, and obviously all kinds of businesses are going to have trouble. There's lots of businesses that will, in fact, never recover from this. There will some that I think will bounce back quickly. But there are many businesses that will never recover. And as you know, in some cases, business models, we already had a trend towards high-tech and high-tech business models. That's been accelerated during this, and there's no reason to believe we will go back to the way things were before. We'll not have the same level of business travel, the same level of conferencing. We will not have office spaces configured and used the same way as they were in the past. So there will be some permanent changes, but there will be a lot of enterprises that do not recover. And as I say, a lot of states, they're going to have very serious fiscal and economic crises following this.
Right. Okay. Now, when you mention sovereign insolvencies, I can't help but think that some of these emerging economies that you referenced that are poised for growth also have some of the healthiest balance sheets. Right. And I want to jump into that, but I think the growth of emerging economies, the transition to renewable energy, currency debasement, possible inflation, no matter what your thoughts are on that, and a general trend that I'm seeing from money moving from financial assets to hard assets is is a macro picture that supports another commodities market. So what are your thoughts, Mr. Harper? Like, are we set up like we were to capitalize on that as well as we did last time?
Well, look, I try and avoid commenting much about sort of Canadian politics today, but I don't think there's much doubt that as we speak at this moment, governments in Canada are simply not as supportive of the resource sectors as they were 10 years ago. In fact, in some cases, they're outright hostile.
Yeah.
Now, I tend to believe that as resource sectors present a significant opportunity, that, you know, this being a modern advanced country and electorate, that common sense will prevail and we'll find a way of taking advantage of those things. I think we'll absolutely have to. But as I say, the growth markets, as you identified, will not necessarily be in traditional technologies leading to the kind of traditional demand in commodities. The demand in commodities could be very different this time. And a lot of it, as last time, a lot of it will occur away from Western economies.
Right. Okay. Yeah. Now, is there any scenario, I'm sure you've thought about this, where we would have benefited from, or we would benefit from establishing some kind of a Canadian sovereign wealth fund that's financed by the income generated from our natural resources?
Well, theoretically, yes. I mean, absolutely. You know, we look at what Norway's done, and unfortunately in Canada, you know, that wasn't done when we had the opportunity. You know, obviously the biggest opportunity was here where I am in the province of Alberta. Alberta did establish, you know, back in the 70s, the Heritage Fund.
That's right.
But the truth of the matter is that over the years, the bulk of the revenues have ultimately been used for government operations. They were not used to create a long-term fund that was invested. They were in fact used just to expand the size and cost of services. And, you know, I think that's now a missed opportunity. We can, you know, if oil were to go back to $100 a barrel, or we were to suddenly to have a resource sector that was providing the federal or provincial governments some kind of vast and unexpected windfall that erased all of their debt and gave them all kinds of additional money. Yes, one of the best things we could do would be to create a sovereign fund. But I just don't see that. We missed the boat, and I don't see that opportunity happening going forward. And I think the other thing to say, Jay, in fairness, it would have to be the provinces. I mean, people forget that, well, the federal government benefits from corporate and income tax revenue that come out of resource growth. Actual resource revenues accrue almost entirely to provincial governments.
Right. Okay. Now we touched on the debt picture a little bit. I want to revisit that, right? We've seen the US Fed balance sheet grow by $3 trillion alone in 2020, and in Japan, the Eurozone, England, Canada, you know, we're right behind. It's hard to wrap your mind around these numbers, and you touched on it. We're leading up to some sort of we're running a game plan that I don't think any of us know exactly what the end game looks like. But I'd love you to speculate for me. You know, how does this end, Mr. Harper, in your perspective?
Yeah, it's a really good question. I don't know precisely how it ends, but I think we can say with some accuracy what's occurring now and what the possible endings are. First of all, it's important to understand what is occurring now, because we constantly hear there's all this injection of liquidity through low interest rates, quantitative easing, in the case of the Bank of Canada, actual creation of cash. And yet people say, but we don't have inflation. Well, that is not true. We have massive inflation. It's asset inflation. We've had very little consumer inflation, but we've had asset inflation because, and why would we have consumer inflation? The vast majority of these dollars have been dedicated towards banks, large corporations, high income individuals. They've gone towards assets and asset purchases. They haven't gone to the ordinary worker and spender and consumer. And so we already have an inflation problem. And I am concerned, I'd be very frank with you about this. I'm very concerned that we have bubbles everywhere. You know, in real estate, in stock markets, you name it. The Fed and other central bank balance sheets have not just been buying government securities or their own securities. They've been buying the security of other governments in Canada. You know, it's been unprecedented what the Bank of Canada has done. It's bought provincial securities initially because the government of Newfoundland and Labrador was on the verge of bankruptcy. It's bought corporate securities at an unprecedented level. So we've got an enormous. I think we've just got enormous bubbles, and we've got a debt overhang, whether it's government, I say corporate, or household, that it is hard to see, how that could be unwound in a meaningful way. So as I say, I think you're going to have crises. And when you have those crises, governments will be confronted with a series of options, none of which are very good, but there will be austerity. Austerity is, people complain about austerity, but austerity is rarely done as a choice. Austerity is usually done because markets will not lend you the amount of money you want to borrow. And there will be governments that hit that wall. As COVID-19 begins to pass and some major economies begin to recover, there will be governments that cannot borrow the amount of money they want to borrow. They simply will be unable. They will have a financial crisis, and their choices will be a combination of austerity, devaluation and default, or frankly, general inflation. And so I think you'll see in different markets combinations of these things. The big question is the United States. How long will the world loan trillions of dollars at 0% to the United States? Right now, I would say to you that in the short to midterm, the market appears willing to do that, but it's not going to do it for everybody in the world.
Right. Okay. Let's stick with the U.S. then on that. So if we run this forward, Mr. Harper, is there a scenario where you can see, enough confidence lost in the U.S. dollar that the reserve currency status becomes compromised?
I don't see that today, and I'll tell you why. It really just comes down to a lack of alternatives. Okay. There obviously is a reason, or there are growing reasons to have, questions about the U.S. dollar, and we've seen the U.S. dollar trend down in recent months. But I experienced this a bit after 2008, 2009. Obviously, the U.S. economy was hit very hard. It was the epicenter of the financial crisis. And you had a very small number of developed countries that had reasonably strong economies. They were us, they were Australia, Switzerland, Norway. It was a very small number. And what we saw happening when I was in government is a lot of hot money moving towards our currencies. And then we immediately had a constant battle to keep our currencies from appreciating too much, because there simply is not the volume in those kinds of currencies. If the US dollar's in trouble and the euro's in trouble, there's just not enough. There's just not enough size in those other currencies to absorb the money that's floating. So first of all, to have an alternative to the US dollar, you have to have a large alternative. What are the large alternatives in the world? There are only two. One is the euro. And the truth of the matter is there's every reason to have as much, if not more, doubt about the long-term value and stability of the euro than the US dollar. Yeah. And the other is, of course, Chinese currency. What the problem with Chinese currency is you have no idea what it's actually worth at any given moment. And you have no idea, what arbitrary measures the Chinese government could take to revalue its obligations or the value of the currency itself. So you can't put money in that kind of a currency. And as I say, the only other Western alternative is the euro. So in the short to medium term, it's hard to see, unless the US becomes a catastrophe, it's hard to see what the alternative is to the US dollar as the world's major reserve currency, other than, gold, Bitcoin, some kind of a whole basket of things, right? Today it will have to be a whole basket. And I think that's what you will see. I think you'll see that reserves will, the number of things that people use as reserves will expand, but the US dollar will still be the bulk of it.
Okay, I want to pull on some strings there. Is there a scenario you see where the US revalues gold?
I don't see I wouldn't put it that way. I mean, I think there's every reason to believe that the value of gold is likely to continue appreciating. The one thing we do know about gold is that it does well when there's general threat to currencies, or even worse, a generalized inflation. And as I think I'm telling you, given the debt overhang we're facing, the risks of inflation around the world at some point are fairly significant. So I think you would see, you know, once you would see, you will see gold, you know, once again become a something that people would be attracted to. But I don't want to exaggerate. Gold has its own downsides as well.
Sure. But talk to me about that. How are you positioned, Mr. Harper, to protect your wealth? I mean, we're looking at some potential dire situations. Have you hedged? Like, how are you set up to ensure you can weather a storm?
Yeah, look, it's a really good question. Both, and I'll give you a personal and a business answer, which are kind of the same.
Okay.
Obviously, as a person, my household's in Canadian dollars. I'm a Canadian taxpayer, Canadian resident. Our business actually operates largely in US dollars, just because we run a global business. And so the quickest, the easiest way, or the best way that we keep ourselves protected is we keep debt levels low. Both in our house and in our business, we've always been pretty averse to debt. I'm not saying we don't have any, but relative to our ability to get it, we don't have very much. So, that's the first thing. We have my business is diversified. That helps. It's diversified across industries and geographically. It's a global consulting business. That helps. But look, the ultimate answer to your question is, if there really were a really serious crisis in the United States around the dollar and around the stability of the US economy, the truth is, I gained this through with Department of Finance officials and others after the global financial crisis. After the global financial crisis, we sat down and we said, okay, we kind of got through this, but could we have seen it coming better? What could we do to avoid other scenarios? Are there other crises that could hit us?
Yeah.
And so we gained those things through. And the only thing we never had an answer for was, what happens if you have a sovereign debt crisis in the United States? The truth is, if you have a sovereign debt crisis in the United States and a fundamental crisis in the US dollar, there's not a lot of places for anybody to hide. That's just the reality. So we've got to hope that American entrepreneurship and ingenuity always outpaces the stupidity in Washington, which fortunately is the major lesson of American history. It usually does.
Got it. Okay. And do you hold gold yourself?
No, we don't hold gold. This relative, both in terms of my household and my business, I think we would have to be at a more significant scale to make a significant gold holding worth doing. But it would just be a small hedge, frankly. It would, I say there's only so much you can do with gold. Gold has its own risks.
Okay, I'm with you. Now, we're seeing a lot of central banks announce either unrolling or planning to unroll central bank issued digital currencies. And do you have any thoughts, just to begin? Do you have any thoughts on that concept?
Well, I guess, look, I'm not going to claim to be an expert on that at all. I think to some degree it's inevitable. I guess any thoughts I have about it are subordinated to my general concern about monetary policy around the world. I am quite concerned about several aspects of monetary policy we're seeing in major centers. Government of Canada, the Bank of Canada under my government did not do quantitative easing. I'm not saying I wouldn't have done it this time, but it's a policy I'm generally skeptical of. And I am, just very worried about the kinds of assets central banks have been getting into. They're increasingly moving, in my judgment, from being merely institutions that monitor the money supply and monitor price stability, and they are increasingly becoming kind of a general banker, which I think is not their role and very risky. And I feel this about, well, it starts with the Federal Reserve and all others. So I'm, ultimately, if you have a digital currency and the purpose of the central bank is to control inflation and create a stable currency and price stability, then, digital currency is just kind of an evolution of the marketplace. But if it's part of series of what I think are wild experiments as to the role of central banking, then it worries me a lot.
Yeah. Okay, it makes sense. I mean, the potential implications there are pretty dramatic, right? People often argue, well, we already have a digital currency, right? Everything we do is online or with our phones or et cetera. But it's really just a digital ledger for physical money, right? The money itself isn't digital. It's not code. It can't be programmed to behave a certain way. And you can run the digital currency scenario into some sort of dystopian situations where, if the government's providing stimulus checks that they would encourage people to spend and they're not, they could put expiration dates on that currency, maybe geographic incentives to stimulate certain parts of the country. I'm not sure, but okay. Is there a scenario that you can imagine where a decentralized digital currency, i.e. Bitcoin, actually becomes competitive as a world reserve currency?
Look, I've read a lot on digital currencies and the Bitcoins of the world. I still don't confess to be an expert. It's hard for me to see, frankly, on a large scale, how they operate really as a store of value, which is pretty critical to a currency. Currency has three purposes, a medium of exchange, a unit of account, and a store of value. A digital currency is certainly a medium of exchange. It can be a unit of account, but it's difficult for me to see how private digital currencies like Bitcoin in significant quantities operate as a store of value, because I, as an investor, have no idea what this investment represents. When I have a traditional currency, or for that matter, a government instrument of any kind, I ultimately have behind me the promise of the government backed by its taxation power. But I don't know, as a store of value, what I'm holding if I'm holding Bitcoin as a major reserve on my balance sheet.
Right. Okay. So I want to pivot now to the U.S. civil unrest and just get some of your thoughts on some of the root causes. I mean, and I'm not American, neither are you, so I'm an outsider looking in, but paying a lot of attention, inevitably. My wife's American, et cetera. So, Mr. Harper, like from an outsider's point of view, it looks like two populations on opposite sides of maybe extreme populism, where their roots are based. Would you agree with that?
Yeah, look, I actually wrote a book about this a couple of years back, Right Here, Right Now, Politics and Leadership in the Age of Disruption. It wasn't strictly about the United States, but we see some of the same trends happening in a lot of Western countries and a few non-Western countries. And what I think the root cause of this is a whole lot of ordinary working and middle class people who have not done particularly well in the age of globalization, and are increasingly frustrated with traditional options that don't speak to them.
Sure.
I predicted, and what we've seen a lot of in the last 5 years, what we saw was we've seen the rise of a lot of what are called populist or nationalist, Eurosceptic, unconventional political parties, mostly on the right, not all, but mostly on the right. My view has been that the concerns of those people can actually be addressed through intelligent policy. It's not easy, but they can be. But that if they are not addressed, what you are going to see next is the rise of a populism on the left, which will be more explicitly Marxist or socialist. When I say socialist, I don't mean, social spending. I mean government control of the means of production. And so you're now seeing that on the left. The US is more advanced on this. Right now it looks to me like both, frankly, we'll see what happens with Mr. Biden, but both the traditional Republican Party and the traditional Democratic Party are struggling to really combine their traditional policies and voter bases with these new populist movements, and being able to kind of keep the public together and deliver coherent policy. But if we can't do this, what you're seeing is increasing fragmentation. I mean, you see this in Europe. You see this in countries that have proportional representation, multi-party systems. We're seeing more and more parties less and less ability to form governments. There are now European countries that are just perpetually turning governments over. And what you see in majoritarian countries like, our system, or more particularly here, the United States, is you just see a fragmentation, the inability to assemble a coherent coalition. So I've given some thoughts in the book as to how this should be addressed, particularly by conservatives. Obviously in the United States, I would just say this as an observation. The Trump presidency did some things to address this. I think we have to say that before COVID, the United States had really started to see really strong growth, frankly, the kind of strong growth we hadn't seen in a long time. And it was broadly based with increases of income for blue collar workers, which is why, interestingly enough, President Trump's vote among those kinds of people actually went up in the election, including among non-white voters, blacks and Hispanics. But at the same time, President Trump ran the most fiscally irresponsible government in history in a country that already has a big fiscal problem. And obviously, he was not able to heal the kind of social divisions that are underlying some of this turmoil. In fact, if anything, as we see, he's exacerbated them. So, look, I'm just very concerned that unless we can find a way of addressing the broad base of working and middle class people with policies that benefit them, that we are going to end up with the kind of deep cleavage you see in the United States and some parts of Europe.
Right. Yeah, which is a little bit scary. We talked about one scary scenario that kind of lacks a clear exit strategy. I won't dwell on this one too long. I promise after this, we'll turn it around and think about the positive future or the optimistic side of things. But, I just wonder, reflecting on history, Mr. Harper, have you ever seen, how does a scenario typically end? If we dial back to maybe 2010, right? Occupy Wall Street emerged on the left and the Tea Party sort of formed on the right. And fast forward 2016, candidates like Bernie Sanders and Donald Trump emerged, right? Evolution of those ideas. And then more recently, it's gotten more extreme, QAnon, Antifa, et cetera, et cetera. It's a bit intimidating when you think about that trajectory and what happens next, right? This great debate.
Look, I guess, let me give, I'm at the age now where I can start to reflect on history that I experienced.
Yeah.
And, just a reflection, when I was growing up, in the 60s as a boy, we had a United States that looked very much like the United States today. It wasn't just in political turmoil and division. There were increasing levels of political violence. Major political figures were assassinated when I was a boy. And you had, that political turmoil and division went into the 70s with, by the way, all this started out when times were actually pretty good economically. And then it turned into stagflation, rapid inflation, unemployment. We know all the problems of the 70s. Governments came and went. There were more extreme actors, as you mentioned. But ultimately, in the Western world, under Ronald Reagan in the United States, Margaret Thatcher in Great Britain, and similar leaders, frankly, a new policy consensus was created. Was created by conservatives. For the most part, liberal parties, the Tony Blairs and Bill Clintons of the world, adopted those consensus themselves. And we had, another period of political stability. Now we've entered, independent of the pandemic. Long before this pandemic, we had certainly, at least by the global financial crisis, if not before, we'd entered another era of poor performance, growing poor economic performance for parts of the population, social instability, political instability. And look, I am always optimistic. People point to China and they say, look, China's growing and it's orderly. I'm always, my optimism is that democratic societies that have free speech and free association and party competition and debates, that we get things wrong pretty constantly, but over time, we eventually gravitate towards solutions. Dictatorial societies at any moment in time can adopt the right, quote, the right solution. But when they go off the rails, when a dictatorial society goes off the rails, it stays off the rails. Because if you're a dictator, you not only can get it right, you must get it right. Because if you don't get it right, you undermine your reason for being. And then the only thing you can do is you have to double down and triple down on your mistakes to prove you were really right all the time and jail more and more people who disagree with you.
Right.
Until there's a revolution. So as I say, my optimism is that as bad as all this turmoil looks like, that somehow we will get, we will get political entrepreneurs out of it who come up with ways of moving the bulk of the population towards some kind of new political consensus around good, strong, viable economic policy.
Okay, I appreciate that perspective.
But it won't be easy. It will not be easy when we're gonna, all of our countries, maybe not the United States in the short term, but the rest of us in the very short term are going to be faced with the reality that we are borrowing far more monies than markets are willing to lend, and we're going to have to find ways of scaling that back. And the scaling back is going to create a lot of winners and losers.
Right. Okay. One more question on this topic. I'd love to get your thoughts on the role of media in these scenarios, right? Yeah. If you look at the way, social media tools can be leveraged to convey a message, and I think this has been realized and now responded to by these same entities. I mean, the president of the United States is banned from Twitter, Facebook, and YouTube. This is sort of unprecedented. Any thoughts on the role media plays in this and potentially the role media could play to turn it around?
Well, I know there's a lot of hand-wringing about how terrible social media is, but at the same time, social media is one of the few places you can also get the facts if you know how to use it. I don't think traditional media has anything to brag about in terms of the quality of information they pass to the public. And the difficulty with traditional media is if it was wrong on traditional media, there was no way of finding out what was right. I mean, I would tell people if I had the time and inclination, I would love to teach a course in schools to people on how to use media and social media tools to actually get information. In many ways, it's easier and more reliable than ever before. You just have to know how to use it. Look, I won't comment on the individual, President Trump's account or whatever. I will just say this, that I think, once again, the strength of social media is the same as the strength of our society. Diversity of voices, competition, eventually the public figures it out. The thing that bothers me about what's happened increasingly in the United States, and especially in the past week, is not what one thinks of Donald Trump's Twitter account, but when I see social media companies trying to limit competition, shutting down competitors. That is, I think that's, first of all, I think shutting down competition is bad for any industry. But when a group of private actors believe that they should control the airwaves and that nobody is allowed to compete with them, I think that's a serious problem, not just for freedom of expression. That's a serious problem of economic policy.
Okay. Okay. Now I want you to daydream with me for a second here, Mr. Harper. You're 20 years old. You're an aspiring entrepreneur. What are the industries that you would point somebody to at that stage right now?
Well, I'm not. How old did you say? 20? I'm not 20, but I left public life 5 years ago. I guess 4 years, more accurately 4 years ago.
Yeah,
because I spent a year in Parliament after the election. So 4 years ago, I left public life and determined to start a new career, really a new business career. So even though I'm not 20, I have exactly that outlook.
Got it. Good.
So what I have done, I could have joined a whole bunch of blue chip corporate boards. For the most part, I haven't done that. I've really only joined one. I instead started my own business, and we've focused on industries and clients that we think are going to be the economy of the future. And, so I'm involved in the energy industry. Look, I still think there's lots of opportunity in oil and gas over time, but obviously we're focused on energy transition opportunities as well. We're involved in a lot of technology. It's quite obvious to me that in any industry, new technological platforms are going to be the future. And I think that what you're going to see Jay, in the next 10 to 20 years, is I think you'll see there's a lot of cases where existing occupants, existing strategics, don't necessarily dominate their industry 20 years from now, that they're actually completely displaced by new entrants operating on new technological foundations. It won't just be a question of industries technologically updating. I think in some cases, these big companies will actually fall and be replaced. And I think we're going to be surprised. If you look 20 years from now, how few of the kind of top 100 companies of the world are in the top 120 years.
Yeah.
So we're focused on the tech space in almost everything. I'm involved a little bit through one fund I'm involved in called Circuitous. I'm involved in infrastructure work where, we really are working on at the private end, more further developing the investment triple P model of infrastructure investment, because governments are going to have to invest more. At the same time, governments are not going to have money. So the only way they're going to be able to do this is use the private sector, and the private sector should develop a greater range of tools for them to use. So look, so that's, as I say, I'm tech is obviously, I think, central to just about everything. But I would also say that, you're right in what you're doing, resources. There's, and I'm not trying to dismiss environmentalism, because I think there's a lot of great environmental tech and a lot of great environmental stuff coming onto the market. But anyone who thinks that the new sets of industries are not going to demand materials and resources and commodities are fooling themselves. They will change, but there is, the demand for all sorts of commodities, for not just minerals and energy, but also food, et cetera. I mean, these demands are just going to continue to rise. So I think there's also, although, and we have a little bit of business in that space, but I think it's also a great space going forward. But once again, it will have to be, current with, environmental improvement.
Yeah.
And it will also have to adapt to technology as well.
Yeah, I'm with you. Okay. And I really appreciate that perspective. It's a constant balance. So just to follow up, any industries specifically, Mr. Harper, that you think are ripe for disruption?
Oh boy. I think almost every industry, has significant, well, I shouldn't say risks of disruption, significant opportunities from new technology, the ability to use big data. Let me just give an example. The example I'm most familiar with is the oil and gas industry, because I used to work in it a long time ago, and I'm still an investor in it. For example, that industry is only starting to figure out how to use the kind of big data analytics solutions for drilling, for reserve monitoring, et cetera, that are possible out there. And I could just extend this to virtually every business. Every business has vast amounts of data that it doesn't use to optimize its business models, because it just hasn't had the technological capacity to do so, but those capacities are being developed. And if you can get on top of it and figure out how to use it, there's lots of opportunity. There's also the risk. I mean, look, the big risk is that companies, and I've seen this as well, I've seen it in the government of Canada, companies that are not familiar with new technology bring in technology consultants and ultimately get involved in what I call big digs in technology, where they just get technology projects that they put in place and spend years to develop, cost, tens of millions of dollars, and don't go anywhere. So all I can say is what's important about technology is not become too far behind the curve, or then it becomes very hard to adapt at all.
Got it. Okay. Look, Prime Minister, I want to thank you for your time. This has been a super enjoyable conversation and an absolute honor for myself. So thank you for spending some time with me and my audience. I really appreciate it.
Well, I appreciate it. And good luck as we come out of this in the next year.
What I love to do is introduce the right people to the right people.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and we are searching for our next investment opportunity. I'm now joined by Randy Smallwood, President and CEO of Wheaton Precious Metals. Randy, how are you?
Fine, Jay. Many thanks. Always good to see you.
Yeah, it's good to have you back because last time we chatted, it was the spring of 2020. It was April, maybe early May. And the conversation at that point was around a potential emerging bull market in the commodity sector. And it could have been 10 years ago, considering how many things have changed since that conversation.
Changed since then, eh?
Yeah, a lot's changed since then. The commodities market, one of those things. And, I thought an interesting place to start, Randy. I mean, as the CEO of Wheaton, and for anybody who's not familiar, Wheaton Precious Metals is the largest streaming company in the world when you're looking at revenue generation. And that's coming from streaming deals, predominantly like I think 61% of your rev comes from the gold sector, 33 from silver, and the balance from platinum. There's one cobalt deal in there, I believe. But projects all over the world and really like the 800-pound gorilla in the space. And so, Randy, why don't we start with, I want to catch up on sentiment right now because the market's, it's heat up a lot since we last spoke. There's a lot of new capital coming to the sector and commodity prices have all risen. I'm hearing two conversations now from my guests. One that is sort of the perma bulls. This is only going to increase. If you look at all the macro trends supporting increased commodity prices, they're all there. And a second that's more tempering that enthusiasm, saying prices might be getting ahead of themselves. Prepare for a pullback, maybe prepare cash. But where do you sit in that camp, Randy?
Well, all the vectors point towards continued strength in precious metals. We're going to see some short-term volatility. I think that we saw some to the positive with this pandemic, but we have seen precious metal prices rising for many, many years now. And the pandemic and all the issues and all the challenges that we as a society see over the last year, that accelerated us and of course pushed gold to record highs, and silver also performed very strongly in that phase. So precious metals definitely did move up. As we're starting to see a path out of this pandemic from at least a health perspective and a health of society and such with different vaccines becoming now available. We're going to see some of that pandemic response come off, but the key thing to keep in mind is that we still are on a very strong, continual upward path in precious metals. We haven't seen any change in that. And we're going to see some short-term volatility from things like pandemics and such. But boy, when you start measuring the economic impacts and costs of this pandemic in terms of trying to restart economies around the world and the amount of stimulus money printing that's going to be required when it comes to precious metals and solid stores of value in the face of that, all the vectors still point towards continued strength in precious metals. Yes, there's going to be ups and downs. There's going to be sentiment changes and stuff like that, but the fundamentals are very strongly still in support of precious metals.
Okay, now I have two questions for you, and keep in mind, these are coming from, we have a significant portion of our audience, most of our audience, they're pretty versed and experienced in the precious metals business, but not everybody. We produce a lot of content in the health science sector, in the tech sector. And so we have a lot of investors that came into our audience on the back of those topics and now are curious about how to enter the precious metals business because they see the gains being made and their interest has peaked. So two questions for you, Randy. Number one, a mistake I often hear investors make when they're new to this game is using the words royalties and streaming interchangeably as if they're the same. So I'd love you to start with that and just provide the difference. What is the difference and what is Wheaton?
Well, streaming was a business model that we invented back in 2004 when we created the original Silver Wheaton, now Wheaton Precious Metals. And there are some similarities to a royalty, but there's also some strong differences that actually create more value for us and for our shareholders and for the partner companies. A royalty is basically a registration on land. It's not really a contractual partnership. It's a registration on land where you get generally a part of the revenue, no matter where that revenue comes from. And so it's not focused specifically on precious metals or such. It always depends on what's being produced at the asset itself. Streams have the ability, it's a contractual partnership where we actually work with the operating company to come up with the best way to create value. And you have to recognize that most of our production comes as a byproduct, a non-core byproduct from copper mines and from lead zinc mines and from nickel mines. That's where we get most of our gold and our silver and our palladium, not platinum, but palladium from, is as a byproduct of these base metal mines, or even silver sometimes from gold mines. And it's a key thing where streams, we're allowed to focus on the specific commodity, and we structure these contracts so that it's a true win-win for both the operator, the mining company, and us, the streaming company, where what we're doing is providing a means for them to crystallize the value of this non-core asset that they have in their copper mine or in their lead zinc mine, this non-core precious metal. And they then take that crystallized value and apply that back into their core focus, which is growing their copper business or their lead zinc business or their nickel business, or, you know, investing back into themselves. And we, of course, as an investor into these assets, get the benefits of all that reinvestment. And so streaming is focused. It's basically a contractual agreement between parties where we get a certain amount or a certain percentage, and it's key, it's a certain percentage of whatever that mine produces. And if we're it's this combination of wise and lucky, although, you know, luck is generally related to hard work and how much work you put into it. And so, but if we're smart in terms of which assets that we invest into and choose assets that continually deliver back to, you know, their stakeholders, their shareholders, then we'll have success. And I would say that that's what we've done at Wheaton. You know, we produce more gold, and we've had higher revenues than any of the other streaming and royalty companies out there. We have an incredible growth profile over the next few years, and an incredible capacity in terms of continue investing back into the ground. And you know, we're actually we're probably at a state now where the biggest challenge that we have is being able to put our money back into the ground fast enough. And if we can't do that, then it just means increasing our dividends back to our shareholders. And so it's a good, strong business model. It because of the streaming structure, we don't have the traditional cost risk that mining companies do.
Right.
But we still get all the upside of exploration success and expansion potential, and obviously levered exposure to the commodity price that all just delivers superior returns to precious metal investors.
Yeah, because all of your terms are agreed to prior in a contract. We see inflated prices, labor, fuel, whatever, all the inputs that go into the mining companies, you're protected from that. And that's why when we say there's protection from the downside risk, less of a risk profile with the royalty company, that's really what you're talking about.
Yes, the streaming company, as I say.
Sure, yeah, there I go.
Yeah, the streaming company, there's less downside risk. We'll get everyone changed, because even you know, just to highlight the strength of a streaming agreement, even the traditional royalty companies are now streaming companies. The bulk of their revenue has now come from streams, because they recognize that there's just better and more value created from streaming contracts. And as you said, Jay, the contract, we make an upfront payment, and for that we get a percentage of whatever metal is produced. And when that metal is produced, we make a fixed payment on a per ounce basis as that metal is produced to us or delivered to us. And so there's no cost surprise. Our upfront payment is our capital cost. We know what that is. And then as the metal is delivered to us on a per ounce basis, we make a fixed payment on a production basis. And so there's no cost surprises. A huge advantage over traditional mining.
Right. Okay, and my previous comment there is evidence that I don't edit these videos. You get the raw file. Perfect timing. Okay, so I want to back up a little bit, because you guys have been very active since 2004, invested something like $9 billion into these agreements. The most notable part of that is only $2.5 billion came from financing. The balance came from cash flow. So I guess my question though, Randy, is, are you going to be as aggressive now that metals prices have risen? Like, is it time to hunt for you still for new deals, or is it time to harvest the deals that you have?
Well, I would say that we're definitely in a stronger market than we were a couple of years ago, but there's still growth and upside. And what people have to remember is that our opportunity set doesn't generally come from the gold space. And so when we look around the gold mining companies and the precious metal mining companies of the world, of course, these prices are generating, good, healthy cash flows, and there's not a lot of need for outside capital. But our biggest marketplace is actually the base metal producers. And we are starting to see copper, of course, go for a nice run. We're seeing nickel start to wake up a little bit. Lead, zinc still lagging a bit, but still going in the right direction. And that's where our opportunity set comes from. And I have to say, the base metal sector has not had a lot of reinvestment over the last 4 or 5 years.
Right.
And so what we have now is a lot of base metal focused companies that are looking, they see, not only do they see good prices today, but they see the vectors pointing in the right direction, that this is the time to perhaps start reinvesting back into their infrastructure and to expand and chase some of that exploration success that they haven't had for so many years, and start reinvesting back in. And so we're busier than we've ever been in terms of opportunities out there. The bulk of them coming from base metal companies that look at their non-core precious metals byproduct production and say, wow, precious metal prices are doing okay right now. Maybe it is time to crystallize that value and shift that in. And so we are very hopeful that we added a couple of deals in 2020. Smaller scale deals, but still pretty attractive deals that we know will be delivering value to us for a long time. We've got a pretty good portfolio of corp dev opportunities that we're working on right now, and hope to be able to put some of this cash flow back in, because as you mentioned, to date in Wheaton Precious Metals, we've invested $9 billion into the ground, but we've already returned $7.2 billion in cash flow out of that $9 billion. Hence, we've only had to raise a bit of money. The amount of cash flow we're generating now at current prices is going to be, we should be getting pretty close to $1 billion a year. It's tough to put that into the ground, as fast as we'd like to. And so, but we're going to try.
Yeah, no doubt. But I guess, that would put you in a position where you're not having to go to the market for capital anymore, right? You'd be able to fulfill all the deals you want to do off of in-house cash flow.
Yeah, we took the approach back probably 6 years ago now that our preference was not to issue shares. In fact, I'm proud of the fact that, even since we last talked, we put an ATM in place last year, an at-the-market financing mechanism where you can actually issue shares into the market to raise capital. I guarantee you, we are the only resource company, the only precious metals company that has an ATM in place that hasn't exercised it. Why? Because we've got such strong cash flows. We're very adverse to issuing shares. And in fact, we've used debt to finance and successfully finance the bulk of our acquisitions over the last 6 or 7 years.
I knew that. Yeah.
And that debt, here in the first quarter, it is gone. We will have paid it off here in the first quarter. And so, in our eyes, if we'd have taken a more traditional approach that some of our peers have taken, we would have probably had about 16% more shares issued and outstanding. That is permanent dilution to our existing shareholders that we chose not to do. So I'm proud of that track record in terms of what we've been able to build and how we've built it.
Yeah. Well, for a $24 billion market cap company, you don't have very many shares outstanding.
Yeah, it's and we're hoping it stays constant. We don't, right now, with the amount of cash flow and the access to very reasonably priced debt, incredibly attractively priced debt, well below 2% interest rates. That capacity, we've still got plenty of capacity to grow without ever issuing shares again.
Okay. Now, I wanted to ask you about pent-up demand. And normally this question comes from a place of M&A activity, right? We haven't been able to travel much. I know you're a geo by trade, right? So you like to get, when I first talked to you, you said you like to get on the ground and kick the dirt, right? When you do these deals.
Yep.
Obviously you haven't been able to do that. Has that impacted the amount of deals that are now stacking up in your pipeline? Is there some pent up demand at Wheaton? Once you're able to get back in an airplane, do you expect activity to increase?
Well, we did close 2 transactions last year. The first one, we were fortunate enough to get the site visit in before the pandemic hit, and so that checked it off. But the second one, we utilized a combination of consultants. It was on Capstone's assets in Mexico, the Cozamin mine. It's an asset that we already had a stream on at one time. We inherited it when we took over a competitor back in 2009, but it had a term to it. And so happy to be back into the Cozeman mine, because it is a mine that we think would be running for many, many years in the future. And we had the advantage of knowing the asset because we had a previous stream on it. So we felt comfortable with using consultants, in-country consultants, to provide support for our due diligence. I do like, I'm a geological engineer, and I like getting in and feeling just getting a feel for it. I just find when it comes to project reviews, talking to the on-site geologists, getting a feel for the rock, for the geology. The more time I spend in this industry, the more respect I have for intuition, and intuition is best felt by being on site and just getting a feel for not only the operating team, but the infrastructure, the support, if it's an existing operation, you can always tell when assets are running well, and when they're well invested and when they're underinvested. And so it does prove a challenge. We have found a way around it. We have conducted some site visits, and we just have to take some measures to minimize risk as much as we can, and move forward. And so, as these opportunities arise, we'll find a way around it. It is the one thing about we as a society, is that survival is the strongest instinct. We'll find a way to make it work.
Yeah, no doubt. I love that. Okay. And do you think broad sector, from an M&A perspective, Randy, is there some pent up M&A demand in the mining business right now?
Well, there's no doubt. Anytime we see movement, if certain companies tend to have opportunities in front of them, and there's perhaps hidden value in terms of synergies that you might be able to align, then it'll justify that. But whenever we see markets move forward, if we see certain companies catch that wave ahead of others, that creates opportunities. Anytime there's a disparity in valuations between entities out there, it always opens up opportunities for M&A.
Okay.
I don't see much in the streaming space. There is a lot of new companies coming into the streaming space. Just about as many new streaming companies as there is vaccines nowadays. It seems like once a week or every couple of weeks. But that will represent an opportunity at some time in the future. There just has to be a consolidation of that space, and it will happen eventually.
Yeah. Okay. So in October, you guys listed on the London Stock Exchange. I know you already had a substantial shareholder base in London, around 15% of your trading activity, if I'm correct. But what will this listing do for Wheaton, Randy?
Yeah, 15% of our shareholder base was UK based. What we were seeing, though, while we were over there, and London, essentially is almost a second or a third home for us. We originally listed on the Toronto Stock Exchange, but a few years after that original listing back in 2004, we listed onto the New York Stock Exchange, and within a few years, New York became our dominant market, and we're now probably about 60 to 70% trading on New York, and the rest on Toronto. London, because we didn't do a financing over there, we don't have a lot of liquidity on the London Stock Exchange. We knew that was going to be the case. But what we were seeing in all our time spent in London meeting with funds over there is that there's a lot of UK funds that have limits in terms of how much they can invest outside of the country, typically limited to about 10% of their 10 to 15% of their portfolio. And these are, the diversified funds. They're the ones that have a broader reach, but they want to bring some precious metals into their portfolio. There's not a lot of options outside of Russian risk. There's not a lot of options on the London Stock Exchange. So we saw an opportunity and demand there. But the other criterion was the fact that if a fund over there has limited capacity to invest outside of the UK, and they're a diversified fund, they're probably going to be focusing on some of the big tech names, the Apples and the Facebooks and the Googles and Alphabet, or whatever the parent company are, with that 10 to 15% capacity. So there was a lot of requests about whether we could actually somehow get a listing in London to allow them to invest. And what we have, and hence, by our calculations, there's probably about 400 billion in assets under management looking for a way to expand their capacity for investing into precious metals. So by listing in the London Stock Exchange, what it does is allows them to own our stock now. Now, they don't have to actually acquire our stock. If you look at our trading on the London Stock Exchange, it's almost embarrassingly low in terms of volumes and liquidity. But that's because we don't have a good pool of stock on that exchange yet. But what we have seen already is what we know of 3 or 4 funds already that have invested through the much more liquid New York Stock Exchange. But they've been allowed to now because we're listed on the LSE. They can now invest, buy, and sell our stock on any exchange in the world. So the LSE is really a check mark to give us access to a broader investor base. And everything we've seen so far, we're pretty happy with the results.
Okay, and I'd love you just to talk to anybody who's looking for their next home for capital in the precious metal space. What they can expect from Wheaton. I know you're a big shareholder. Last time we sat down, I said, Randy, are you deploying capital into the precious metals market? And your answer was, I'm all in on Wheaton. And, that's what we want to hear. So let's talk near term, Randy. What can people expect from Wheaton in like the 1 to 5 year time horizon?
We've got a really strong growth profile. We, 2020, of course, has finished. We did have to reduce our guidance a bit because of the number of our mines had to suspend production early on in the pandemic. But in the end, it was about a 5% hit. And as we announced at the Q3 results conference call, it now looks like we may have overestimated the impact, that things actually look quite positive. And so it looks like we're going to be at the upper end of our guidance, which should be somewhere around 670 to 680,000 gold equivalent ounces. Still tallying up the final numbers in terms of production. But so a good, strong year, especially in the face of the pandemic and the impacts there. Our average production over the next 4 years should be somewhere around 770,000 gold equivalent ounces. And that's just organically in not counting any new acquisitions. And in fact, that doesn't count the Cozeman acquisition, which will add a bit also, not a lot, but a bit. What we'll see is good, strong growth from a number of assets. Earlier this morning, we saw Hudbay announce that they've got their final permits for the Pampacancha zone down in Peru. So they expect to get that up and running. That's going to substantially increase that Pampacancha zone has substantially higher precious metal grades. And so when they start that ore through the mill, we're going to see a nice big uptake in gold and silver production from the Constancia project with Hudbay. We've also got the highest grades we've ever seen coming out of the Peñasquito mine with Newmont over the next few years, and so very good, strong silver production from that Peñasquito operation. Continued growth in a number of different opportunities. We just started receiving our first cobalt from the Voisey's Bay operation with Vale, and so we'll now just added our 4th commodity into our trading mix. That started as of January 1st of this year. Probably won't report revenues because what we're seeing is that the production pipeline in terms of working it from production through to sales in bulk commodity sales like cobalt is going to take 2 to 3 months to get us to the point of having sales, but we will see that'll bump our production by about 2 to 3%, our overall gold equivalent production by about 2 to 3% over the year. And then probably the most exciting thing that we're going to have over the next while is the Salobo mine down in Brazil, which is our flagship operation. It's an incredible copper asset that produces substantive amount of gold. 2019 it delivered close to 270,000 gold ounces to us, and we just. Vale is most of the way through a 3rd phase of expansion. They expect to be turning on the switches on that expansion next year in 2022, which will increase throughput capacity by 50%. And they're in the process of updating their mining plan. They had a very successful drilling campaign, and so we're expecting to see updated resources, reserves, and an updated mining plan that should really highlight the strength we're going to see out of that Salobo asset. We've actually taken a pretty conservative approach to our forecasting, and so I think there's a strong chance that when that update comes from Vale, that we'll see a significant bump to the upside. And so just organically, everything seems to be purring. Everything seems to be just ticking along. Nice growth. I point to the team at First Majestic with SAND.NYSE, where they're opening up, the silver-rich areas and continuing to expand and improve the milling capacity down there, improving recoveries and improving throughput capacity. Stillwater, where we get our palladium and some gold from, continuing to strive towards, their Blitz project, where they're trying to maximize mill capacity. Their mills were only running about 70 to 80% capacity, so they're opening up more working faces to try and deliver more. Just everywhere I look, we've got a good, strong portfolio that continues to be, and it's one of the reasons why we focus on high margin assets, is because our partners are motivated to continue reinvesting into these mines and growing them, and we're reaping the benefit of that.
I love it. Okay, Randy, thank you so much for catching up. For anybody who's curious, the ticker is WPM on the TSX, the NYSE, and the London Exchange. I love getting your perspective, Randy. Really appreciate you coming back on the show and updating my audience. So thank you.
Thank you, Jay. Always a pleasure.
One thing that we've done at Sandstorm is it's not just for me, that we've done this for our entire senior management team. People have to own multiples of their annual salaries in terms of shares.
What I love to do is introduce the right people to the right people. I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome.
Okay, what's up, guys? Jay Martin here, CEO of Cambridge House, and we are searching for our next investment opportunity. I'm now joined by Nolan Watson, the president and CEO of Sandstorm Gold Corp. How are you, Nolan?
Pretty good. How are you, Jay?
I'm very good. So anybody who's not familiar with Nolan, he's the founder of Sandstorm Gold, a company that he founded in 2008, gold royalty company, founded after departing a career with Wheaton Precious Metals, where at 26 years old, you were named the youngest CFO of a multi-billion-dollar company listed on the New York Stock Exchange. And Nolan's got all kinds of awards behind his name, from Canada's Top 40 Under 40, Ernst & Young Entrepreneur of the Year, recipient of the Queen's Diamond Jubilee Medal, which I'm very curious about, among many other things. But Nolan, it's awesome to have you on the show and get you in front of my audience, because I'd love to hear the Sandstorm story from you and introduce it to my audience or anybody who's not familiar. But before we jump into that, I wanted to talk to Nolan, the investor, to open this up so we can get to know you a little bit better. My investment strategy is always driven by the people steering the ship. And so I want to talk about your portfolio. You're an investor as well. And a lot of the conversations I'm having on the show right now are very focused on how to hedge our portfolios against currency debasement and the potential rise of inflation. So how are you doing that to start with your personal cash?
Yeah, I would say with my personal investment portfolio, one of the things that I am a big believer in is the fundamental devaluation of currencies over time. I really hold almost nothing in cash at any point in time. And I think right now is a particularly risky time to be investing if you're investing in anything that is not going to be inflation protected. And so I oversimplify a little bit. I literally just own only real assets, and I break it down into two broad categories. One is one that I know best, which is precious metals and a little bit of base metals. And the other is real estate. So I've got my portfolio currently invested about 35% in real estate, and the other 65% is precious metals with a small base metal component.
Okay. And when you look at the precious metals component of this, are you holding physical equities and all the way down the food chain from producers to explorers, or how does that break down?
Yeah, I own everything from producers, mining companies, to royalty companies, to explorers, to a little bit of bullion as well. What I would say, though, is that the makeup of where I am in that ladder has been changing over time. So when the real bull market started for precious metals, I had, it was mostly just my Sandstorm exposure plus a lot of junior companies. Junior companies tend to float fairly quickly, and they float fairly hard when they go up. And then when you get into the more mature start of the bull run, they're the riskiest things to hold, because if things do sort of peak out or top and start coming back down, the less liquid names get hit the hardest. And so I've been slowly shifting my position into more and more mature names and bigger companies. And I've been moving from exploration into development here over the last few months.
Okay, that's interesting. So then if you were to speculate, at what inning we would be in this current resource bull market, early stages, mid stages, approaching late stages, what are your thoughts?
Yeah, I would say still early to mid stages, except getting the timing right is not always that easy. When you're in the middle, it's easy to get it right. When you start getting closer to the end, it's really hard to pick exactly when the end's going to happen. It usually catches you by surprise. So I tend to move into more safe things earlier than the average person, just to make sure that I don't get caught in any downdrafts. And I do believe that operating companies with operating cash flow are the best to be invested in later stages, and those with less risks. So royalty companies, Sandstorm obviously being a royalty and streaming company, that's the type of thing that by the end of the cycle, I'll be fully invested in. My entire precious metals portfolio will be probably precious metal royalty companies by the end of the cycle.
Interesting. Okay, that's great perspective. Thank you for sharing that. I want to jump into Sandstorm now. So for anybody, Nolan, who's not familiar, maybe give us the 30-second commercial. What is Sandstorm Gold? When somebody purchases a share of Sandstorm, what are they buying?
Yeah, Sandstorm is a collection of streams and royalties. And so we've got over 200 streams and royalties right now, which means these companies, they go and they mine their mines. And at the end of every month or at the end of every quarter, they figure out how much revenue they had, and they owe a certain percentage to us. So if they owe us 2% of their revenue, at the end of the month, they cut us a check for 2% of the revenue they received. And so Sandstorm really is just a check collecting company, a cash flow company, if you will, that is getting cash flow from gold mines all around the world.
Okay, now talk to us about how that de-risks a portfolio, right? I understand the cash flow model. It's largely a great entry point for investors into the precious metal space because of the reduced risk profile. Can you touch on that a little bit?
Yeah, so mining is typically fraught with a lot of risks. You've got floods that can happen and fires and roadblocks and any number of hundreds or thousands of things that could possibly go wrong at a mine. And when those events happen, the mining company not only stops making money, they actually start losing money, right? So if someone blockades your road, you're still paying a large portion of your employees. You still got a high burn rate for all of the equipment that you're leasing. And so mining is a business where you make money, and then you lose a tremendous amount of money for a short period of time while you have this exogenous event occurring. And then you go back to making a little bit of money. And so the equity investor who is investing in that cash flow profile ends up getting a lot less cash than they thought they were going to get because they weren't forecasting these negative events that happen to mining companies. A royalty company like Sandstorm, we get X% of revenue. So when the mining company is up and running and we're getting 2% of their revenue, we're getting that 2%, 2%. If a bad event happens and the mine stops, our 2% goes to zero for those couple of months, but we don't lose any money. And because we've got a portfolio of royalties, the vast majority of our royalties are still paying. So our cash flow as a business is still high. It might drop a little bit when there's a negative event at one of the mines, then it comes right back up. And so we're always cash flow positive entities. It's way more stable and a way more safe investment, a safe way to play the gold cycle. And so that's one of the reasons I'd mentioned that towards the later ends of the cycles, I like owning royalty companies the most because we always have positive cash flow. The question is just how much positive is it? And so when you're towards the end of a gold bull market, which I don't think we're there anywhere near there yet, but we will get there eventually, what you start seeing is people investing in mining companies that have really high costs. So gold price is $1,850 today. There's a lot of companies out there, the all-in sustaining cost of producing gold is $1,300, $1,400, $1,500. If gold price drops $400, their cash flow goes to zero. If they have debt, they violate those debt covenants, they go bankrupt. As an equity investor, you lose 100% of your money in that scenario. If gold goes from $1,850 to $1,450, Sandstorm, I think, is still undervalued and our share price could be going up. So that's one of the reasons that's the method that I use.
Okay, now I want to talk about how those various stages of the gold cycle impact your operation, right? Because you're going to be doing a couple things based on what the market's doing. Before we get to that, though, I just want to touch real quick on your team a little bit, because from Wheaton, you pulled your co-founder, David Aaron, with you. He's now your senior exec VP. Talk to me about, you must have received some inspiration after having a front seat with one of the world's premier royalty companies being Wheaton Precious Metals that drove you to create Sandstorm. Was that the case?
Yeah, Wheaton Precious is a fantastic company with a fantastic management team, and having been part of that was great experience. And at Sandstorm, we've built, I think, a similar culture and really high quality people, and we saw how to do it right, and we've been emulating that at Sandstorm and then trying to improve on it where we can.
Okay, now, when we opened this up, I said you've been really busy. Previous decade, I think you guys opened it up in 2010. Company was founded 2008. 2010, you had 5 royalty agreements. Correct me if I'm wrong. A decade later, or 2019, 190, right? The significance of that is that you were hunting in a bear market when metal prices were cheap and deals were probably more available. It takes a lot of boldness to take those steps in a bear market. And so a couple of things. I want to touch on some of the highlights in the portfolio. And then I also want to understand how your focus might shift now in a resource bull market. But let's begin. That's rapid growth. That's sitting now at 201, I believe, agreements, correct? So what should investors focus on within those agreements? What are some of the highlights?
Yeah, so of those over 200 streams and royalties, not all are created equal, and some are worth a lot more than others. And so we've actually got a lot of resources on our webpage investors can go to start understanding what cash flow is coming from where. But we've got a number of streams and royalties that are the bulk of that cash flow that are coming in. We've got a presentation also on our website that outlines what are the more material contracts. One of the big pieces of our growth going forward, so over the next 2-3 years, we're expecting to double our production and double our free cash flow. One of the big pieces of that growth is an asset called Hodmodden in Turkey. It's one of the best, highest grade undeveloped gold assets in the entire world. It's an absolutely fantastic asset. We should be putting out a feasibility study here on it in the next few months. And so we're happy that that's part of the growth. But really that portfolio is just Sandstorm as a snapshot as at today. As you mentioned, in 2010, we had 5 streams and royalties. Today we have over 200. Fast forward another 10 years, we expect to have over 500, and we're just going to keep going.
Interesting. Okay, that kind of leads to my next question, because I might have made the assumption, Nolan, that you would go hunting in a bear market and then you would harvest in a bull market when metal prices are up. I mean, and I'm sure you're always looking at things. You're never going to be sitting dormant, just focusing on cash flow. But does that impact the strategy a little bit? I mean, how does your focus change now that we've entered a bull market? It's been quite a dramatic shift.
Yeah, I would say the way that I run the business in terms of investment philosophy over the cycle is similar to how I would manage my personal investment portfolio, which is the more late stage you go, the more you focus on producing assets that are cash flowing today, that are stable, long life assets, that if you are towards the end of the cycle and it comes off a little bit, that's okay. You're going to catch multiple cycles and you're still going to make lots of money on that deal. The things that we're probably investing less in dollar-wise right now is exploration. We find that at the bottom of the cycle, all of the small and junior companies, irrespective of how good their assets are, they get washed out. Companies with $100 million market caps drop to $5-10 million, and they can't even raise $1 million at the bottom of the cycle. And that's where we'll step in and we'll sweep up 10, 20, 30 royalties at a time and really grow the number of royalties at the bottom of the cycle. But I do believe that right now is still a good time to be investing in operating mines and buying royalties on things that are producing cash flow or will start writing us checks for cash flow as soon as we do the deal. I really do believe that things are lining up very well for gold to be revalued long term. The debasement of the US dollar and just the quantitative easing and money printing is just beginning to take hold. And the US is in such dire straits financially. It's absolutely incredible. I mean, they're functionally insolvent. And if they were any other nation on earth, they would already be bankrupt. The only reason they're not bankrupt is because they have the ability to print their reserve currency, and they're doing it in large amounts. And it is going to flow through into real asset prices. It's going to flow through to real estate. It's going to flow through to gold and silver. And so I believe that right now, the average analyst is using a long-term gold price of $1,550, which I think is insane. I think that the gold price 5-10 years out is going to be more like $2,500 an ounce to $3,000 an ounce. And I think it's going to stay there for an indefinite period of time and then continue to go higher after that just because of the devaluation of the US dollar. So we still are looking to invest our US dollars now, trade those US dollars out to buy in gold in the ground now. And so we are going to grow, we think.
Do you think, okay, I want to touch on a couple of things you said there just because it's come up in conversations recently. Do you think there's any potential that the US would actually revalue gold formally, reprice an ounce of gold? No,
it's too decentralized now. The US doesn't have enough power to do that. I don't think that would be successful.
Got it. Okay. No, thanks for sharing that. Okay. Now I want to touch on the future a little bit. So what could investors look forward to, call it near term, Nolan, 1 to 5 years when they're looking at Sandstorm?
Yeah, over the next, we'll say 1 year, I think we're going to accomplish a few things. The most two significant of which are, we do think we are going to get new deals here. So if you're an investor in Sandstorm, you'll get the benefit of the acquisitions that we make this year. We are cashed up and ready to go. We've got over probably $110 to $120 million US cash sitting on our balance sheet right now. We have access to $300 million of undrawn revolving lines of credit. So we've got that plus our cash flow this year. We'll have access to $500 million US in cash flow to make acquisitions this year. So I think that's the first thing that investors can look at. And then secondly, we think that we're not only going to have a feasibility study out on Hod Maden, I think we're going to get the permits and start the long lead construction by the end of this year. So we'll have new large assets that have come into our portfolio, and then one of our large assets in our portfolio, Hod Maden, it's going to be put into construction. So we think it'll be a really good year for Sandstorm if we can accomplish those two things.
Yeah. Okay. So 100 million plus in cash, 300 million credit facility, in addition to cash flow, puts you at $500 million in available working capital to take to the market right now. That's a very strong position to be in. Talk to me about your ownership a little bit. I'd love to understand more about management ownership, insider ownership, et cetera.
Yeah, management owns a tremendous amount of the stock. So I had mentioned that 2/3 of my net worth is tied up in precious metals. The majority of that is tied up in Sandstorm. I own tens of millions of dollars of Sandstorm stock, and I can tell you that there's nothing that I think more about in terms of when I wake up in the morning every day. It's how do I add value to those shares.
I love that. And when I preach on this channel about focusing on the people, that's why, right? I want to focus on the CEO and the supporting cast, the other executives, the directors, the money behind the deal, because I want them to lose sleep over the operations, right? Exactly.
Absolutely. It's kind of funny, even in the investing that I do on the side, if it's a deal that I've just heard of, but I got fairly excited about it and I invest some of my own personal money in it, it's very frustrating when you realize that represents maybe 1% of your overall portfolio, and even yet you own now more shares than the CEO of that company. Because he was a hired gun. He wasn't there when they started it up. He didn't get to buy cheap shares, and his net worth isn't particularly high. He owns a nice house but still has a mortgage, and so he hasn't had the money to go buy shares, and he owns 0% of the company and really doesn't care if the share price goes up or down. He gets paid a salary, he gets a bonus, and the bigger he can make the company, the more money he's going to make year after year. So that CEO would care more about growing the company than they would about getting the share price up. And you get very disenfranchised very quickly investing in the mining space when you realize how little the CEOs on average care what their share price does. So one thing that we've done at Sandstorm is it's not just for me, that we've done this for our entire senior management team. People have to own multiples of their annual salaries in terms of shares. So the share price goes down, they're losing money. It's entirely possible that if our share price goes down, our management team is working for free effectively for the whole year because they'll lose more money on their shares than they'll make in their salaries. And so that's an important philosophy. We want not just the CEO, we want everyone in the senior management to own lots of the stock.
I love that. Okay. Now to wrap up, I just want to touch on anybody else in the executive team that is notable, and one that comes to mind is Dave DeWitt, just because I'm a big fan of Pathway Capital and the work they do and a lot of the companies they put together. I think it's a real high integrity firm. Anybody else on the team, Nolan, that you want to mention?
Yeah, Dave DeWitt, Marcel de Groot, who's his partner at Pathway Capital. He's an advisor to us, and they're fantastic to have. Dave DeWitt, as you mentioned, he's actually our chairman, fantastic chairman to have. In the management team, we've got a really strong technical team. We've got Tom Brewington and Keith Laskowski that we poached from the International Finance Corporation years ago, and they head up our technical. We've got a really strong corporate development team. We're really pleased with the team we built here.
Okay, awesome, Nolan. It's been great hearing the story from you and introducing you to our audience because we haven't had you on the show before. So this has been fun and I'd love to do it again. Thanks so much for coming on.
Yeah, thanks for having me.
If you are just tuning in, my name is Jay Martin. I am an investor and the CEO of Cambridge House. Now, what we're doing today is diving deep into a handful of resource investment opportunities, talking to the company CEOs, and in addition, stress testing our investment ideas and strategies with some of the most prolific money managers that I know in the business. Now, the reason that I do this is because I'm an investor first, and I'm trying to grow my portfolio. In addition, I'm trying to identify blind spots I may have that would be compromising my decision making. I do this through conversation with industry personalities and company CEOs right here on the channel. Now today we have a killer lineup of amazing content and the whole agenda is right beneath this video in that YouTube description. Check it out, stick around. I'll be active in the live chat. Drop me a line, say hi. Please hit subscribe to stay tuned with what we're up to at Cambridge House and enjoy.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome.
Okay, what's up guys? Jay Martin here, CEO of Cambridge House, and I am joined now by Ross Beaty, the chairman of Pan American Silver, chairman of Equinox Gold, founder of the Sitka Foundation, recipient of the Order of Canada, among many other things. Ross, it's good to have you back.
Thank you very much. Happy to be here.
So I thought a good place to start would be to follow up on a comment you made on our stage in Vancouver a year ago, last January 2020. And you were discussing the gold market. And at that point in time, your perspective was that we were maybe in what you would call the fourth inning of the secular gold bull market. And just given the year we've had since January, I want to start there and see, has your perspective changed and have the goalposts moved?
Well, it has changed a little bit. I mean, if I was bullish a year ago, I'm super bullish right now. It's been a crazy year, and everything that's happened, I think, has accentuated the bull case for gold. And so I mean, if it was the fourth inning a year ago, it's no greater than the fourth inning now, or the actual game is going to go into extra innings. And I just don't know how long it's going to go, how high it's going to go, but for sure, we are not at the end of the party. And every single thing every government in the world is doing right now to stimulate their economies is positive for gold. It's negative for currencies. It's positive for gold. It's negative for bonds. It's positive for gold. All the geopolitical stuff that's going on, all the mayhem and chaos that's happening in the U.S., all of that's good for gold. So, you know, I don't know what exact part of the game we're in, but I just know we're going to go longer and stronger, and by no means is $2,000 gold the record we had in July. By no means is that going to be the all-time high. I think we're going to blow through it this year at some point, and beyond that, who knows how high it's going to go.
Okay, interesting. Now, yeah, I mean, all those macro factors you pointed out, we're all watching, right? And it's like this perfect storm for the gold price. However, you know, recently there's been some chaos in events that typically would drive a rally in gold, and the opposite happened. You know, you've been through enough cycles, you're probably not even bothered by that. But for anybody who's watching the price thinking, what's going on here?
What happens today is people get overwhelmed with noise. I mean, there's noise. People are glued to their screens and glued to the media feeds that they get so much more of than they used to. So they're kind of so short-term focused that they don't step back and look at the forest for the trees.
Right.
So I think the best thing to do is to step back and think about what actually is happening in the entire world right now with respect to paper money, with respect to global debt, with respect to inflation prospects, and things that typically drive gold and will continue to drive gold. And it's not just the run in Bitcoin that's negative for gold. That's to me, that's noise. I don't see Bitcoin as a replacement for gold. You know, that kind of thing is just people that are glued to screens and look at things, analyze things too much. Step back, look at what's happening in the world, look what's happening to gold supply. It's very important, of course, supply is just as important as demand, and look at short-term, long-term trends. So, and I think when you do that, you're going to end up being as bullish as I am. You just can't avoid it, I think.
Got it. Got it. Okay. Now, actually, follow-up question to that then. If we see this market continue to heat up, as like the noise is just going to continue, on either side, right? A gold correction, you get extra noise, but a gold rally, you get just as much, and almost more dangerous noise because it comes in the form of promotions that don't deserve your time, but they look really great when they hit your desk. So what kind of advice do you have for retail investors, Ross, or what common mistakes have you seen retail investors make in a budding resource bull market?
The thing about bull markets is the tide comes in, it lifts all ships. So, you get a lot of money pouring into the space. We saw that in 2020, a huge amount of money, a lot of financings were done. And the investors typically don't separate the wheat from the chaff. So they'll buy crappy companies. Those companies will blow up and they get embittered to the whole sector. So investors should always look at quality. They always have to look at the quality of the project, the quality of the management team, the game plan, how well management sticks to its plan, opportunities to make a big outsized return, and not so much the slick promotion that the promoters are making. Go behind that and look at the underpinnings of the company before they really step in too much, because boy, good promoters can easily part people from their money without necessarily having the quality that's behind them that makes those stocks actually perform over the medium and long term. So in a bull market, that's a danger. But at the same time, I have to say also, no matter what you buy that's got gold in it, is going to go up if the gold price blows through $2,000, let's say, again this year. The whole sector will do well, whether you buy large caps, mid caps, or juniors. They're all going to do quite well. Of course, the better investors are going to do better because they have more ability to analyze good companies and separate them from bad companies.
So for somebody who works 40, 50 hours a week and they only have a small amount of time to do that kind of diligence, are there any hacks when you talk about the underpinnings behind the curtain? Should they find a guru they should follow or focus on just the people? Or what's one or two simple, actionable pieces of advice? Yeah,
I think, getting a good broker is good. A good broker from a good firm, number one. Number two, looking at newsletter writers. Some of them are really good. Some aren't so good. Some are really good. And look at the record and pick one. Go to conferences, go to virtual conferences or real conferences like yours. And those are all good things for investors to do. It doesn't take a huge amount of time, but it really gets them knowledgeable about the space and able to actually invest in a more, I would say, a more scientific way or a more sensible way. Now, underpinning that is the reality, however, that in today's world, it's a very different place than it was 10 years ago. It's much more difficult to get large pools of investment capital to go into the juniors. So it's just a more challenging time for juniors. A lot more money is following the ETFs, the robot investors, the algorithmic investing that's going on. So none of that has to do with real value. None of those are using classic quantitative analysis to get into, or even qualitative analysis to understand the value of companies. And this means, a lot of that's just dumb money. So what I've tried to do is build my most recent company, Equinox Gold, for that market where you get value for getting bigger per se. You get more liquidity, that brings in new investor pools. And it doesn't necessarily bring it in pools that actually look at the underpinnings of the quality of the company, the earnings, the cash flow, and so on. But that's also important, of course. So when you get when you have the ability to analyze or get advice from people who are good analysts, it's a very important thing to do in this space. It always was and remains today, even though there's less people doing it.
Okay, last question on investment strategy just came to mind. A lot of the guests we have on this show talk about the money flow as it enters the resource sector. Starts at the top, starts with the big cap producers, the stable bets, right? And then works its way down as the market matures until the final stages where the juniors get hit. And, I was talking to Nolan Watson. He has the opposite approach. And he's like, no, you go to the juniors first. They're the riskiest in a mature market. When the resource market begins to crash, they'll get wiped out first. Companies with real assets, that's the safer bet. And so he has the exact opposite approach. Do you have any thoughts on that, Ross? Do you think about it that way?
He's very much, Nolan's a smart guy. He's absolutely right. It's all about your risk acceptance, right? It's true. The equation is risk reward. That's the ratio, and you want to try to, you want to try to have lower risk, higher reward if you possibly can. But at the end of the day, if you have a low risk tolerance, you buy the low risk, large cap stocks that are going to do less well, but they're safer. They're more diversified. They have more liquidity. You can get in, you can get out easily, and thus they're just safer bets. The real money, though, especially when a bull market gets going, the real massive money comes from the juniors. It's the high risk, high reward stuff. And if you take a long view on gold, and you're right, that is the best place to go in terms of your performance. But you have to be diversified, because those juniors, they can blow up regardless of the gold price. You can have a bunch of drill holes that just don't work. Everything's right except they don't find gold, and so the stock doesn't do well. So you've got to have a diversified approach in that sense. But Nolan's correct if you have that risk tolerance.
And I feel like the best insurance policy against that junior risk is betting on the CEOs with that track record of success, because they'll have optionality, right? And if they miss on those holes, they'll have a plan B, plan C.
Totally. I mean, it's a trite thing to say, but you've got to bet on people.
Yeah.
At the end of the day, people are important, but even idiots can find mines if they get lucky. And there is a lot of luck in this business, and even criminals can, if they're in the game. Every blue moon, criminals find big mines and make a ton of money. So you can't be too clever just in betting on people. You've actually got to look at the quality of the project, where it is, other factors that affect value.
Okay, I'm with you. On that note, I want to talk about Equinox for a second. Talk to us just about the strategy, Ross. Why was the goal to become America's premier gold producer?
It kind of just landed in our lap. We ended up with this project in California and a project in Brazil. Then we got something in Mexico, and we just decided, you know what? Let's just tell people we're building a relatively safe company. We're not going to be in flaky places in Africa. We're not going to be in strange places, Papua New Guinea, parts of Asia. Certainly not the CIS countries. And so let's just go to places that we can fly to easily. We can eat the food, drink the water, don't have to worry about getting things stolen from us. And we're in Canada, US, Mexico, and Brazil as a result. Right. I would say it has become the plan. It didn't start out that way.
I feel like there's two factors driving that now. And obviously you want to go to stable jurisdictions where you can trust the government's not going to pull any, tax issues on you, or worst case scenario, nationalize something. But in addition, investors are more conscious about source country, right? So there's both the government risk, but also the ethical conversation that's thankfully more and more, occurring more and more frequently these days. And do you expect that to continue? I mean, ESG is in its own bull market, which is a great thing, right?
Yeah, no, it's going to continue. It's just good business to do all this stuff, and it's great that investors are actually valuing companies for their focus on environment, social, and governance. It's 100%. Fantastic. It's long overdue. Yeah, and there's all manner of I could make a long rant about investors that actually don't really understand what they're doing when they're looking at ESG. It's quite a complicated area, but it's generally speaking, the better governed companies are going to do better. The companies that look after environment and social aspects are going to do better. It's just goes straight to the bottom line, and thus it goes to fundamental value and share price performance. It's good business. Right. And it's easier to handle those things for sure in countries that respect those things as well. So, if you invest in a company that's working in say Canada, you can be fairly sure that they're looking after those things pretty well. If you're investing in a company that's working in, let's say, Kazakhstan, or maybe a number of other countries I could name easily, the odds are they're actually not going to be having very good governance, because those countries don't have very good governance. They're not really going to have to worry too much about the environment, because the countries don't require that. And social issues are dealt with in those countries by strong people doing nasty things to weak people. That's the traditions, and that's what happens. So you probably aren't going to have to worry too much about the social side either. Having said all of that, the reality is everywhere in the world, every single country in the world, every region, every village, they all have smartphones. They all have access to what's happening in the entire world. They connect to environmental and social NGOs in the world, who then take up the torch of those people with Canadian and American companies, like immediately. So You can't get away with things you might have been able to get away with 10 or 15 years ago, simply because there's instantaneous communication. If, for example, we have a tailing spill or anything for that matter, an accident, whether it's actually damaging or not, instantaneously somebody has taken a picture of that, put it up online, and everybody in the world who has a beef against companies or that particular company or its management, they have they have input. And they put up on social media whatever they want to say about it. So it's something you have to deal with. And it's not always right. People always have to be careful what they read. There's a lot of truly, false news out there that is put up either by naivety, ignorance, or maliciousness. And people have to sort that out as well. And remember, you simply cannot believe everything you read, particularly on blogs. All this garbage that gets put up on blogs by people who have agendas that are different. You've just got to remember that's one person's opinion or it's one person's rhetoric. It doesn't mean it's true. That's the world we live in today. You've just got to be able to filter that stuff. And yet it's a reality for companies. They've got to be far more transparent, far more honest about what's happening. And if they're not, they're going to be held to it.
I love it. And, you put your money where your mouth is. Last we spoke, you shared that your ambition for the next stage of your life is to give away all the money you've made, and you're focusing on environmental causes, right?
Yeah, for sure.
It's super, super inspiring, Ross. So I want to pivot to the silver market a little bit. Top performing commodity in 2021. You've described silver as the schizophrenic metal with 1 foot in precious metals, 1 foot in base metals. So some interesting trends. I mean, historically, silver demand has only been about 10% investment driven, 90% industrial. The investment appetite's massively increased in 2020. Do you think that's going to continue, Ross? And what are the main driving forces of silver, you think, in 2021?
Yeah, I mean, silver did really well in 2020. It was undersold, and it was very easy to make a case for silver going up. It has this schizophrenic attitude. It doesn't know where it stands, either industrial metal or precious metal. But last year was a world of precious metals. And so because gold went up, silver followed and actually outperformed gold. It just had a great year. And don't forget, silver is a much smaller market than gold. It's 1/10 the size of the gold market. So a little money sloshing into this business or out of it will make an outsized performance either way. And last year was a bull market, so silver did really, really well. It also did well, by the way, on the industrial side. Silver demand last year, industrial demand went up because a lot of silver is used in photovoltaic cells, for example, notwithstanding the fact that the world, economies were in turmoil last year. Silver is the most conductive metal of heat and electricity, and therefore it's used in all digital products. And so every time we have, a lot of people said, oh, silver's finished 25 years ago when I first started Pan American Silver. Silver's finished because, its biggest uses in photography, and photography is dying as traditional silver halide photography in favor of digital photography. Well, how wrong they were. It's true, silver use in traditional photography is gone, but silver use in digital everything goes up crazy. For example, every electric car uses more silver than regular cars because there's so many more things that need electricity in an electric car. And you could say that all the way through the chain of digital products. So silver's got all these amazing industrial uses, and the big one now from nowhere 10 years ago has been photovoltaic cells. So it's a great metal, and I would say a lot of these uses are silver price insensitive. So just because the price of silver doubles, you don't change your demand that much. You're still going to have these enlarged demand. So it's got long-term great legs in terms of its industrial demand. And as a precious metal, it's got great legs to the extent that we have a bull market in gold, and silver's going to follow as poor man's gold.
Okay. Yeah. And you touched on the size of the market, 1/10 that of the gold market. It's like 800 million ounces were produced in 2020. It's, collectively, what is it? 22 billion. That's half of Barrick's market cap alone. Yeah. And you mentioned some of the driving forces now with the Democrats in the U.S. Controlling the Senate. Biden's pushing forward his $400 billion clean energy stimulus plan. Yep. So there's going to be a ton of activity with the size of the market, Ross. Do you expect a supply squeeze, like a significant one, or what are your thoughts?
Yeah, I mean, the supply side is going to catch up with demand. It always does, but it does take longer these days. And this is bullish for all metals, not just gold and silver, all metals. The reality is it's harder to build mines. It's harder to get social license, longer to get approvals, government approvals. It's just a more difficult business today. And so it takes, from discovery to development, maybe 20 years now, where it was only maybe 10 years ago. And this is going to slow down the supply response. So you're going to see prices stay higher longer than normal.
Okay.
We're seeing that all over the place. We saw that a month ago when the Pebble deposit in Alaska was shut down. You can't guarantee development just because you find a deposit these days. It takes a lot longer. It's much more difficult. There's more people with more money, more entitlement, fighting mines that get built anywhere in the world. That's the world we live in. It's right. It's good for metal prices, though.
Yeah. Okay. Well, we can't have this conversation without talking about copper. And, we're sitting at 7-year highs, I think. Ross, has the price gotten ahead of itself, or have we not seen anything yet? Or what are your thoughts on copper moving forward?
Yeah, no, the price is fundamentally based. Copper has fabulous legs. It's a wonderful demand-supply balance right now. You have tremendous demand from all things electrical, all things energy. It's an energy metal as much as lithium is, because it's used in electricity generation, transmission, and end use. And we're getting more electrical as a world. We're getting off fossil fuels in both generation and transportation use and other uses, because we're trying to improve our climate and reduce global warming. So that's very, very good for copper. And you're seeing that in the price today. You're also seeing the reflation trade, right? You're seeing world economies that'll start to pick up again in 2021. China was the driver of this last year. China just drove copper demand because it's regrowing. And I think you're going to see more of that now with all the stimulus that's happened in Europe and the United States and Canada. You're going to see more fundamental demand for things like copper, not just copper, but lots of other metals. But I have to say, of all the base metals, I am most bullish on copper, and I'm certainly not alone in that opinion. No,
you're not. Okay. Back to the junior miners for a second here. I think we referenced the recent transaction, Equinox purchasing Premier, and giving you a property in Canada, completing the Americas, right? Do you expect more M&A? And I guess I'm asking this on the back of our inability to travel for the last 12 months in a market that's heating up. Typically, I think we would have seen more. And so I'm wondering if there's some pent up demand you think will be released once we can get on airplanes again. And you probably for sure. I mean, it's actually a good question. Definitely, there is pent up demand, and definitely companies were not able to do M&A last year like they might have wanted to, simply because we've got a project, for example, Lumina Gold. We're trying to sell that. It's in Ecuador, and Ecuador's been locked down. And companies, and even if it wasn't locked down, companies in say China or the United States or wherever have had, or Canada, have had problems flying there, doing their due diligence. The companies just don't allow it. They just don't allow travel. So you can't buy a company unless you've actually touched the ground and seen the reality of what you're looking at. So for sure, there has been a slowdown of that kind of thing. And I think that will pick up in 2021 as everyone gets the jab and we have a return to normal. But at the same time, there is a restraint happening, and it's been going on now for 5 or 6 years, really since the blowout of 2014, 2015, when companies that had done deals, larger companies especially that had done deals in sort of 2011, 2012, even 2013, they were just castigated because they blew so much money on dumb deals. Right. And they lost huge amounts of shareholder wealth, and shareholders fought back and said, you know what, we're not going to let you do this again. We want to return to shareholders. We want normal metrics. You're seeing all the stuff that VRIC's doing with Mark Bristow's management. He's trying to run that as sort of a business that could compare with other businesses. I don't understand that personally. I think gold is so different and so special and is unique to just about everything. I don't know. I don't particularly support that management strategy, but at the same time, a lot of investors have wanted return of capital, and they've wanted companies to pay dividends instead of doing acquisitions.
especially larger companies. So whether that changes or not, I don't know. I think, there's a lot of discipline in those companies, and they're run by more conservative people. Right. They're directed by shareholders who want return of capital. They don't have the growth obsession. We're fighting that a little bit in Equinox Gold, because I happen to think that in that particular company, with that particular set of dynamics, the growth model is a very good one, because it creates wealth per se. You've got a higher multiple. And as you get a higher multiple, the bigger you are, the more that translates to value. So there is a point at which that changes. And I would say we're getting very close to that point right now in Equinox, because we now have the critical mass. We have the internal growth. We don't need to go and raise more money. We don't have to go and do more deals. We've actually got that scale right now. So from now on, I just don't see the need for us to be doing that too much longer. We'll do internal growth. We'll demonstrate value. Shareholders love that. And I think, just watch what we do there in terms of development of our existing assets. So it sort of depends on the kind of company. On the whole, though, 2021 should be, just to sort of sum up, because I could go on for a while on that. I think 2020, you're going to see more deals than in 2020, but there's still going to be some restraint. And I don't think we'll see many mega deals that we saw a few years ago.
Okay, got it. So final question for you. I mean, you touched on the competency of management today versus 2013, 14. You expand that to company valuations, health of the balance sheets. Is it safe? Would you say the market is in a better place than it's been in a decade?
Oh, it's for sure been in a better place. I mean, again, it depends on what metal you're looking at. If you're a coal company, I wouldn't say yes. It's a pretty terrible new business. But if you're a gold company and a silver company, which I guess is really what your question was. Correct. I mean, at $1,800, $1,900 gold producers are making buckets of money. The costs are usually around $1,000 an ounce, and they're making, they're selling it for $1,000 or $800 margin. They're repairing their balance sheets. They're increasing their dividends. Their valuations are going up. They're in really good shape right now. And of course, that typically has meant a lot of indiscipline in the past, where they use all that cash flow and they start buying companies to get bigger, because there's more glory and ego in bigger companies. And that has been one of the problems in the past. So we'll see what happens now. And smaller companies have been able to finance. There's lots and lots of risk capital out there, and so. One of the symbols of sort of the late innings gold game is when, small companies that might have been able to sensibly raise $3 million to fund a drilling program somewhere, for example, they raised $30 million. And when that happens, then you can say, okay, we're getting real close to the top of the market. We're not there now for sure. We were there maybe a little bit last July, but it closed pretty quickly, and we'll see. That's definitely the sign of wobbly kind of. It may not be the ultimate top, but it's going to be maybe a cyclical or a intracyclical top that will be followed by some intracyclical. Or say head fake bear market, but
that's a good indicator to look out for. That makes sense. Indicator. Yeah. Okay. Well, helpful. Look, Ross, thanks so much for coming back on, and thanks for your time. It's been great reconnecting with you.
My pleasure.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome.
Okay, what's up, guys? Jay Martin here, CEO of Cambridge House, and we are searching for our next investment opportunity. I'm joined right now by Christian Malau and Greg Smith of Equinox Gold. We haven't had you guys on before, so welcome. Good to see you.
Thanks, Jay. Glad to be here.
Yeah, thanks, Jay.
Well, I'm excited to dive into the story because, Ross, your chairman, Ross Beaty, has been on our show 3 times in the last year. And so through him, we've talked about Equinox a lot. But usually when I sit down with Ross, I'm hitting him with questions about the gold market, the silver market, the copper market. Most recently, it was the renewable energy sector with his experience at Terra. And so I'm excited to sit down with you two and get into the Equinox story. And obviously what everybody wants to hear about right now is your recent acquisition of Premier Gold Mines. I thought that would be a great place to start. And so Christian, I'll open it up to you. you could just walk us through your rationale for that acquisition, why you did it, and what it means for shareholders, that would be a great place to start.
Yeah, sure. Thanks, Jay. It's very topical. I guess about a year ago, we actually announced the merger with Leagold. And so about almost a year to the day, we announced the acquisition of Premier Gold in December. And this story just fits perfectly into our strategy. Our goal really is to become that sort of million-ounce producer on a sustainable basis. And, we've got 7 mines and we have no presence in Canada. And this is one of those large-scale permitted deposits, basically ready to build. And we're building a bit of a track record here of almost building a mine per year. And so there's a lot of people that have seen that Terra sold its 50% in this asset called Hard Rock in Ontario to Orion. And Orion's one of the largest shareholders of Premier. But basically what happened was it unlocked a situation that would allow this asset to move forward and get into construction and built and up and running. And it'd be a 400,000 ounce producer in Canada, in Ontario. So that really attracted us to the story. And we've known the Premier guys for a few years. We also know some of their core shareholders being Orion and Sprott and that. And we just felt that with adding this Hard Rock asset and a smaller Mexican mine, which we'd end up picking up called Mercedes, it really fit into our portfolio where long term we have a quarter of our business in Canada, about a quarter in the US, a quarter in Mexico, and a quarter in Brazil. So it really balances that America's portfolio. And we were pretty bold a few years ago when we started Equinox Gold saying we want to be the premier America's gold producer. And some days in the early days, I think people are kind of wondering, how are you going to achieve that? Well, I think this is one of the key final puzzle pieces that fits in and really sort of balances that portfolio. And then also in addition to that, we're acquiring those sort of 2 assets with some exploration properties in Ontario as well. And then on top of that, there'll be a spin out of i-80 Gold, which is really the Nevada-based properties of Premier. And I'll let Greg talk to that in a second here. But it creates a second company that will share in some of the upside, which is great for our shareholders, but it allows Ewan, who runs Premier Gold, to go off and create some value. And, you look at Solaris Copper, or Solaris Resources, that's called now, was a spin out from Equinox as well, and is now a $600-700 million company. And it was on our books for, I think, $12 million for 30% of it. So we see ourselves as supportive shareholders of groups that can actually create some value and things that are maybe too small for us. And so this will be what we'll do is we'll bring in the 2 core assets of Premier and some of the exploration, spin out i-80 Gold. Ewan will run it. It'll be Nevada based. And I think both sets of shareholders will share in the upside. That's been a good track record of ours, is actually both sets of shareholders winning here. It's not just a one side wins. It's usually a 1 + 1 = more than 2. And I think this transaction fits that mold just like Leagold did last year. And if you're interested, Jay, when you have a second here, we can run through the i-80 transaction as well.
Yeah, I'd love to.
Greg will do that.
Okay. Yeah, let's go right to it, Greg.
Yeah, I think, backing up a bit, just to reiterate some of the things Christian said, we've been very, I think, vocal throughout the last number of years on how we want to build this company. We're building it, obviously, through development of our assets, but also through accretive acquisitions. Even at your conferences, standing up there the last several years saying the same thing. If a transaction comes to us that we think is going to be beneficial to our shareholders and is on strategy and helps us achieve our goal of, that million-ounce producer status, of course, we're going to look pretty hard at it. And this was a rare opportunity. It doesn't come along very often where you have an asset like Hard Rock. It's fully permitted. It's in Canada. It's engineered. It's effectively shovel ready. An opportunity to acquire a meaningful interest in that with a great counterparty in Orion Mine Finance, that's fully funded and shares the same sort of vision we do for building that asset. So, from an Equinox perspective, in the Americas, totally consistent with our strategy, fully permitted, high quality asset that we can put into our construction pipeline basically right away. So, the opportunity was one that we felt was incredibly compelling, and frankly, for Equinox, I think has been a fantastic transaction. And if I'm a Premier shareholder, I'm really winning in this transaction as well. In part because now Equinox is fully financed to build Hard Rock. Premier doesn't have to go and raise $500 million to build it.
Right.
But they also retain that exposure plus exposure to our existing asset portfolio, which also has a tremendous amount of upside. So Premier become, those shareholders become Equinox shareholders. And then on top of that, they get this 70% interest in I-80 Gold Corp. And I-80 is going to be an entirely Nevada-focused gold company. It's got production from the South Arturo mine that's a 40/60 JV with Barrick Gold or Nevada Gold Mines. They've also got McCoy Cove, and then on closing of the transaction, they'll also have the past-producing Getchell mine, also in Nevada. These are all in the same region, all highly prospective existing resources. McCoy Cove is one of the highest grade deposits in America, and they've got a great team in place in Reno that'll manage this company with the involvement of some of the existing Premier management team today and board members today. So, a good deal for the Premier shareholders as well, and we're going to end up with two companies that are holding the assets they should, right? Equinox has the large scale Hard Rock project, the mine in Mexico, which fits in with our Mexican portfolio. And then you've got the SpinCo, the I-80 Gold assets, all together in one company focused on developing those assets and bringing them into production.
Okay. And on the back of this is a $75 million financing that I believe Ross is underwriting himself. Is that correct?
Yeah, that's correct. So Equinox is going to undertake a $75 million financing. We haven't priced that and started to execute on that quite yet, but we'll do it in the context of the transaction. And really it gives certainly Ross a chance to maintain his interest in Equinox, which he's done all along the way as we've built this company. We may, have a few other people participate in that financing, but it's a small incremental bump to Equinox's treasury. I mean, when you look at that financing plus what we already have on hand, plus what we have available in terms of our revolving credit facility, we've got liquidity of over $600 million. So that's a small piece of that, but generally fully financed already, with or without that financing, to execute on all of our development, including construction of Hard Rock, when combined with our operating cash flow.
Okay. Now talk to me about jurisdiction, because, from the jump, you guys were set out to be America's premier gold producer. Why America's, and why is that? Could you see that strategy changing, or will that be the mission?
Maybe I'll just start off with that one. When we set out, we started out, I guess, with one development asset in Brazil, and we added a California asset fairly quickly. And in a sense, we were willing to go where the gold was or is. And running it out of, Vancouver primarily allows us to work through the time zones and actually travel more easily in the Americas. Ross has had a long history, obviously, of building Pan Am Silver in the Americas. Myself and Greg have built companies in the Americas, and it was also something that our shareholders were asking for. They said, we like the Americas sort of risk profile. And again, a number of us have worked in Africa and other places, and we really had a desire from our core shareholders, being Ross and Richard Warwick and a few others and a few institutions, that said, we think you can get a more premium rating, and you can also manage the business more effectively in the Americas. And I think that's played out that way, and there's lots of opportunity as well. So we've sort of started out in Brazil, California, but then obviously diversified into Mexico and now into Ontario or Canada. So it really does balance it. Would we never go elsewhere? I don't think I'd close the door on anything completely, but it's a lot easier to manage things in pockets or cores in these countries. Maybe we could add a country or two along the way, but likely in the Americas. But, as Greg was saying earlier, if an opportunity is really compelling, we do look at it, even if it is outside of those jurisdictions.
Of course. Yeah. Now, can you walk me through the production breakdown? You've got, Canada, US, Mexico, and Brazil. And Christian, you touched on, relatively 25% split. But how does that production actually break down between your four locations right now?
In due course, when everything's sort of ramped up, and assuming Hard Rock's up in the next few years here, because we hope to start construction later this year officially, you'll have about 200, sometimes between 220, maybe 230 or 40,000 ounces per year coming out of Ontario. In Mexico, you're probably looking at 350 to 400,000 ounces a year with the two mines. In Brazil, we've got about 300,000 ounces currently, and we probably move closer to 350 or 400 with Santa Luz coming on later, I guess this year. It'll be done, actually, construction there. And then the last one, California, once you've ramped up Castle Mountain Phase 2, you'll probably have, 300 to 400,000 ounces between the two mines there, because Castle Mountain's going to be a good 220,000 ounce producer on its own. And then you add Mesquite in. So, almost balanced between them. And probably in terms of valuation, net asset value, it is pretty reasonably equal. And also resources and reserves are actually reasonably split, almost 25% between them.
Interesting. Yeah, I like taking that. I like kind of zooming out, or looking forward those 3 years when you've got Hard Rock online, you've done your expansion of Los Filos, and you're completing your expansion at Castle Mountain, and you've got, north of 800,000 ounces a year just from those 3 mines. Then you still have Mesquite and Aurizona and Santa Luz and the other projects that take you well over 1 million, but you've got those 3 core mines that are producing 800,000 ounces plus a year. That's a really great place to be in terms of an asset portfolio.
100%. And when you start with 15 million ounces in reserves, and you kind of look at that, that's a 10 to 15 year sort of mine life at 1 million ounces a year. So it's a really nice starting point.
So you guys have been super aggressive in the last couple of years since launch. And Greg, you touched on your cash position. What was it, 600 million roughly in working capital? So talk to me about what's next. Are you guys in hunting mode? I've been curious about, with all the travel restrictions we've been experiencing, how much pent up M&A demand there might be, because people haven't been able to get on the ground and kick the rocks, so to speak. But I'd love to know what you're thinking. I mean, what's next for you guys?
You want me to jump into this one, Christian? I guess I would say, Jay, certainly the first 6 months of the pandemic slowed everything down from an M&A perspective. And it was really challenging for people to start new programs. I mean, we've been able to do a deal through COVID, albeit in Canada, and we had to use consultants to kind of go to some of the other assets, particularly in Mexico. But I think companies are finding ways to navigate COVID a lot better now, and the restrictions, and are able to get due diligence done. Certainly, we were able to do that in this transaction. We did a lot of due diligence. I think that this is the type of market that will breed more M&A going forward. For sure. And so I think we'll see a lot more of it in 2021. And I think there is some pent up demand, for Equinox, and Christian can stop me whenever he wants. Our strategy hasn't changed. We want to grow through development and then also accretive acquisitions of other projects. And, we don't have to do any deals. We have a great growth profile. I think the best out of our peer group. We've got a great portfolio of assets with a lot of development potential and expansion potential and exploration potential in the portfolio today. So we don't have to do anything, but, part of our strategy is growth through acquisition. And if we see transactions that make sense to us, and this hasn't changed from the day we started this company, we've got good access to people. We've got a great technical team. We're building this company so that we can scale it with our Vancouver head office. And so certainly I'm always hunting. Let's put it that way. Christian can say no and Ross can say no, but I'm always hunting. That doesn't change.
I think the one thing that is changed, though, is with the gold price increasing and valuations of, call it, just use an example, single asset producers in Canada having gone up, there are things that are less accretive or dilutive now. So you do need to be a little more creative or look at ways of unlocking value or doing something that relatively makes sense. So I'd say, a year or 2 years ago, it was slightly more straightforward in terms of valuation metrics to do acquisitions. So, we look at this deal, I think we unlock a situation with Premier Gold and allow both sides to see the value creation and accretion. So maybe a little more creativity.
Okay. Now I want to touch on any trigger points. So we've covered the assets and the recent acquisition and the exploration upside, and what we can expect out of Ontario moving forward. Any other trigger points that a new investor to the story should look for in terms of how, what's going to happen in the next near term, 1 to 2 years?
For sure. I can give you a few thoughts on that. I mean, we've got a bunch of drill results coming from various mines. Probably Arizona's first up. We'll be doing an extensive exploration program across the assets that are less than 10 years in life. So you'll see Mesquite, Aurizona, Santa Luz, Fazenda, et cetera, continue to show results throughout this year and next year. We've got 2 studies for upsize mines coming, one being Castle Mountain in California coming in Q1. Also, the expanded Los Filos coming around the end of Q1 as well. We'll be building Santa Luz, which is the Brazilian mine that'll produce 100,000 ounces this year. And it should be done around year end, pouring gold in early Q1 next year. We'll get into expanding and building Los Filos later this year, the carbon and leach plant. We will be permitting Castle Mountain, so it'll take us a couple of years before we actually get into construction of that one. And then Hard Rock, we hope to get into full construction later this year. And there's a great team in place in Ontario already, so it's kind of standalone and ready to go. It'll just take us a few months with Orion to get our sort of feet, or our hands, our seat behind the wheel, essentially. So there's lots of activity with kind of exploration and internal development and growth that we'll keep sort of, putting into the market, and it'll be fairly consistent over the next 1 to 2 years. And when you look at our valuation right now, we're sort of trading on that sort of 0.6, 0.7 times net asset type multiple. And that's more like a single asset producer or a smaller, more junior company. And I think it's a great opportunity at the moment for those new investors to get in and really look at the opportunity to get a re-rating. And most of our peers that are multi-asset, multi-producing companies in the Americas tend to trade more like 1 times net asset value. And so as we execute on our plan and we start to deliver and hit 1 million ounces of gold per year, I really see that re-rating as being something pretty exciting in our portfolio. And you don't see the growth profile like we have. I think we're at over 50% per year over the next couple of years here. And not many companies have that kind of growth, particularly at this scale. And the growth is coming back again. This is depleting industry assets, so it's coming back.
Mm-hmm. Okay, now, one thing I'm curious about, because everybody that watches this channel knows, like, I focus on the people first, every time, all the time. You got to play to your strengths as a retail investor. And my strength is my Rolodex because of the conference business. I'm really fortunate. I get to have a lot of conversations like this and connect with a lot of amazing personalities. So I'm curious how the dynamic works at Equinox Gold, right? We've got Christian, CEO, Greg, president, Ross Beaty, famously known as the broken slot machine in this business, as the chairman. And, an interesting bullet points is that Ross's first public company was Equinox Resources. And so he's talked about this on the show. This is the bookend to his career. And he wants to go out with a bang, which is, we're watching this unfold. How does the decision-making work between the three of you? And how do you delegate responsibility, et cetera?
Maybe I'll just kick off, Greg, but keen to hear your comments as well. But I see it as a bit of a partnership here. And, Ross has got the reputation and the history and a track record that certainly Greg and I can't compare to. But, we're probably the guys in the trenches who enjoy this part of it. The ego part we put aside, and actually Ross is roughly, call it, a generation ahead of us. So it's been really fun to work with someone who's had that track record and following and sort of work alongside him. And I think Ross has really valued the partnership aspect of it, because when it comes to decision making, it's a wider group than just us three, but certainly us three are a core part of it. And we're very open and have a lot of discussions. And I tell you, Ross, Greg, and myself probably talk every few days. He is a non-exec chair, but it's a very active non-exec chair in terms of financing and strategy. He's very active. And I think we respect each other. We have a very similar philosophy on building a business, keeping things frugal, keeping it as lean and creative and entrepreneurial as possible. And that's been Ross's hallmark over his career. And I think Greg and I come from that mold to a certain degree, and we put our own money into the company. So we treat it as though it's an owner-managed business, and that does change decision-making. Every decision impacts the bottom line for our own investments, and that does make us think hard before we do a deal or financing.
Yeah, I'd agree with that. I would say, we definitely talk through things. We're not scared to share our opinions. We'll beat each other up. You've got to have a thick skin. You've got to, Christian or Ross won't hesitate to tell me if they think something's a bad idea or a stupid course to take. And I'll share the same comments if I have them. And I think it's working really well. I mean, it's very much, it's still a pretty small team given the size of the company. We've kept our office small. We've kept the executive team pretty small, and we talk constantly. And, COVID, even with COVID, we're still either, if we're not in the office, we're on Zoom or we're on our phones all the time. And it's been good. And, Ross does play an active role, certainly in terms of forward looking and strategic thinking and thinking long term and big picture for the company. And, it's great fun for us, certainly, to have that kind of runway to build a company, and to have that support to build a company. That's part of what really makes Equinox a fun place to be.
Got it. Okay. Well, look, I'm really glad that both of you could make it on and, introduce yourselves to my audience so we could hear the story from you. Christian, Greg, thanks so much. It's been great connecting with you. and hearing firsthand about the recent transaction, but in addition, the grander vision at Equinox. So thank you both.
Great. Thanks, Jay.
Yeah, thanks, Jay. Appreciate it.
If you are just tuning in, my name is Jay Martin. I am an investor and the CEO of Cambridge House. Now, what we're doing today is diving deep into a handful of resource investment opportunities, talking to the company CEOs, and in addition, stress testing our investment ideas and strategies with some of the most prolific money managers that I know in the business. Now, the reason that I do this is because I'm an investor first, and I'm trying to grow my portfolio. In addition, I'm trying to identify blind spots I may have that would be compromising my decision making. I do this through conversation with industry personalities and company CEOs right here on the channel. Now, today we have a killer lineup of amazing content, and the whole agenda is right beneath this video in that YouTube description. Check it out, stick around. I'll be active in the live chat. Drop me a line, say hi. Please hit subscribe to stay tuned with what we're up to at Cambridge House, and enjoy.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined right now by Mike Timmons, the CEO of Fury Gold. Mike, how are you?
Very good. Thank you for having me, Jay.
I'm glad to have you. Yeah, I'm excited to dive into this story because my audience is relatively familiar. You know, we covered Orin in the spring prior to the split. There was a lot of excitement around that story. And Fury is the first company to be trading. It's the gold company out of that Orin split. And, you know, I've been watching the story very closely. It's great jurisdiction, lots of optionality, you know, 3 projects in Canada. And truthfully, I think has the potential, Mike, to be one of the most exciting gold stories in the next 2 years. So expectations are high. Let's dive into it. Why don't we start with the origin, Mike, because I want to hear from you, you know, why this was spun out of Orin, why you joined the team, and let's start with that.
Sure. So Fury was formed, as you say, as a result of Orin's reorganization and the concurrent acquisition of Eastmain. That was announced on July 29th last year. At the deal, Orin spun out its 2 Peruvian assets, right? So it had the Canadian assets in the portfolio and had the Peruvian assets. And of course, you can't get paid for both, right? You can't have max value for both. The investors are in the name for various reasons, right? Yeah. When they spun out, obviously it allowed their Canadian portfolio to merge with Eastmain's Eau Claire project, right? Which was kind of the target acquisition and something a bit more up the resource development pipeline than Homestake and certainly than Kennedy Bay.
Right.
So the transaction and our $23 million initial financing officially closed on October 9th, forming Fury Gold Mines, right?
Okay.
So Fury is an explorer, resource developer focused on high-grade gold in Canada. And so the vision is to build a mining company, right? And so that was the whole design and the basis for why it was removed from Orin, right? Mm. So Peru, exploration focused, and this is going to be more, you know, ounce-based resource development.
Yeah.
And let's move, right? So that means, I mean, if we want to be a mining company, which is the vision,
yeah.
You know, that's growth through large-scale exploration and smart acquisitions, right? Out of the gate, we have 3.7 million ounces at an average resource grade of around 7 grams, which I think is a bit of a standout. 2 projects, as I said, are in resource expansion, and 2 of them are in pure exploration projects.
Right.
So we've planned, you know, 80 to 100,000 meters of drilling over the next 18 months to really support the launch and drive this introduction into the market.
Yeah.
And the mindset we're going out with is, you know, big action plans mean big gains in value, right? And that's what we've kind of have lined up for shareholders in 2021.
Right. Okay. Now, yeah, I'm totally with you. The split makes sense in that context because, you know, I think I understand the mind of the retail investors because I am one and I want to see a simple path to share appreciation or at least a direct correlation to something. And if you have too much optionality, it becomes a bit confusing, right? You're like, how is this going to perform, right? And that makes sense. And yes, it's very clear to me it's a development company, but you've got some exploration upside. So the retail mindset makes sense to me. You guys have some really smart capital behind you. I want to touch on that. So any highlights you want to mention, Mike, in terms of the management and the shareholder base?
I think you talk about, the first thing you want to do is talk about the team, right? I mean, you always hear, whenever you have a CEO on, they want to talk about, we've got the best team, we've got this, right? But I think you have to talk about the team members, right? It's not just one CEO making good decisions that things happen. It's not just, the team on the ground doing it. It's everyone. And the most important part of our strategy that you've touched on a little bit is people, right?
Yeah.
And when it comes to the team, investors, I think, need to know that there's three components of the team for FURY, right? There's the management and technical leadership, right? So the top three people of the team are from Newmont, Goldcorp, and Agnico, right? So that's decades of experience. All of our skill sets are around multiple asset platforms, running large teams, and shouldering the big expectations that you talked about on the front end, right?
Yeah.
We have, so that's one component of it. The second component of it is we have a very diverse and developed external technical specialists, right? That we use to kind of deepen our analysis for faster and better decision making, right? A lot of people have their consultants, but we have a little bit of a, it's the second line that comes in behind us, right? And the third aspect to it, I think, are the market and capital access, right? The marketing engines, skill sets, relationships coming in from Oren, will continue in FURY, right? And we've ignited those, and they're ready to hit the throttle, right? But the real force multiplier for us, I think, is in the stacking of these teams and skill sets, right? We integrate like you would do in a major mining company. I think that's going to be our edge. And our competitive advantage going forward, right? So, there are, our top shareholders and, some big names in our sector are supporters of FURY. And I think they see this for our approach and our people approach as a bit of a differentiator and remain long the story. And we're certainly grateful for that.
Okay. Now you mentioned, 80 kilometer drilling program now underway across all three projects. So my assumption is we should see pretty consistent news flow 18 months or so.
Yeah, I think for the next 18 months, we can just walk through the assets. The next 18 months, it's going to be busy drilling, really, and quite active, right? So we just commenced drilling at Eau Claire. It's in the James Bay region of Quebec. 1 million ounces at 8 grams, not the 6 grams that's in the PEA. 60% of the resources are measured and indicated, so it's a pretty high quality resource in our view, given the geological setting. 50,000 meters in that program, infill step-out drilling to test the down plunge extension of the deposit, which we can talk about further. We're 6 holes into that program. Assays pending, and the results will be out shortly.
Okay.
If we go over to Homestake, as you know that asset well. It resides at the southern tip of BC's Golden Triangle. Yeah. Has a nice starter resource, 1.2 million ounces at over 7 grams gold equivalent. And the approach in 2021 is really, for me, a return to exploration. And my goal there is to dramatically improve the ounce profile of that project.
Got it.
So we're going to absolutely hammer it this summer with the largest drill program that I think that project has ever seen. We want to do some expansion, we want to do some upgrading of the current resource, as well as testing some exciting theories and some deep targets as we chase the high-grade shoots, right? Okay. So Oren, hadn't had a program like that before, right? So it was basically, what is this? How does Homestake fit into Oren? The guys, largely in exploration, and it didn't seem really to have a home.
Right.
But certainly Homestake tucks in very nicely behind Eau Claire. And I think there's more potential there than has been revealed, right? So it's going to be 20 to 30,000 meter program we're going to do, kick off early summer. And the results of that program are going to come out as we go into September's conference season. So I think the timing is going to be pretty exciting.
Yeah. Okay.
When you go over in the Committee Bay, shareholders are uniquely positioned in a world-class, advanced exploration project in Nunavut, right? We control that greenstone belt that from Oren, high grade top to bottom, heavy lifting behind us. I'm spoiled as kind of the new guy coming into this project, just because of all the ingredients are there. Something interesting happened recently, though, which in the region, which was the acquisition of TMAC by Agnico. And I know you saw that. So you have the best mining company in the world doubling down in Nunavut with a second operating platform. So to me, that's compelling evidence of the region being one of the last few places on Earth where you can still find and develop large scale high grade gold deposits. So the feedback from our investors, even on the back of that news, right, we're all getting calls like, hey, you guys are well positioned there. This is going to be great. It was all good news for the region, and certainly good news for the sector. People, removing risk from the sector. It's good for everybody. I think that's, the investors remain positive, and they really, because they're starting to anticipate, what's to come when we go up there this summer, right?
Right.
Exploration plans for the summer are going to include probably the most impactful 10 to 15,000 meters that we drilled on that project to date, right? So we have a 1.2 million ounce at 7 gram resource at 3 Bluffs. So we're going to expand that resource and drill some mature regional targets that we have for a new discovery. So some big swings going up there this summer, subject to COVID restrictions, right? Which we're very sensitive with the vulnerable communities that we have up north.
Yes.
And I guess finally, if we're being thorough, let's talk a little bit about the news we put out just before Christmas on the Éléonore South joint venture.
Please.
Right. So this was an exploration partnership that we have with Newmont and Ascendant. And we're the operator of that GV, which obviously is key to have the hammer on the planning. It's 15,000 hectares contiguous to the south of the Éléonore mine, which hosts an 11-kilometer structural corridor. We're really focused on 5-kilometer wide geochem anomaly, good grades, and that's going to be the focus of our drilling at Q4 once we complete all the summer programs and get all of our data sets together to help with our targeting. That project held very little value in East Main, and so I'm pretty excited for the drilling and of the view that we can create and crystallize a ton of value in the stock with our work this year. So overall, very active, as you said. I don't think there's any shortage of geological potential at our assets, and we have a very busy technical calendar, which is a great situation to be in.
Yeah, 100%. Okay. And planning drilling into Q4 with the new venture. Okay. And that's kind of how I understood this story. Eau Claire is maybe the most exciting asset when you first take a look. Focus at Homestake is growing the ounces, increasing the ounces, and then there's some exploration upside at Committee Bay. Mike, are you now looking at the share price? And I guess, we're seeing analyst conversations talking about it's trading at a discount to the value they see. But what are your thoughts?
We are trading around 0.45 times NAV, which, as you pointed out, is low. I think it's very low given the quality of the team, our assets, and the game plan that we've put together.
Yeah.
And that's just the situation we have currently, right? And secondly, it doesn't really reflect the growth potential that we have, or certainly any of the plans that I've just outlined, right?
Yes, which is great.
Yeah, it's still early days. We've been a company now, for about 100 days, and we haven't really put any results out yet, right? So I think it is early. But generally, though, when I hear all the little tidbits and the conversations and certainly the questions we get from investors, I really kind of categorize them into two factors.
Okay.
There's a lot of residual trading sentiment and emotion from the Oren East Main deal, right? Where simply investors are exiting. So on the Oren side, it was, they were there for Peru, right? They had a bit of patience with Fury, but we're really there for Peru, right? And so they're selling. On the East Main side, I think generally it was fatigue. I think earlier last year they did a financing at 10 cents.
Okay.
And so, at the deal, it was a bit of a multiple for them. So most of the fatigued shareholders kind of rotated out and simply just wanted out, right? That is all based on emotion and not on logic. Obviously, given the ingredients for Fury and the excitement we have going forward, right? Drilling high grade gold into a rising gold price environment with high quality team, and a strong treasury, right? So again, the bucket one was emotion. We've done 150 to 70 Zoom meetings over the last 3 to 4 months. Whether it's a half an hour or an hour, people leave the meetings energized, excited, and vibrating for what's coming. But we're not seeing that in the share price, right? So to me, that's a big wait and see mentality.
And do you think they're waiting to see the Eau Claire results, or what are they waiting for?
They're waiting to see data from us and Eau Claire results, right? Yeah. And so that's a combination of things, right? There hasn't been a ton of recent technical work done on any of the assets.
Right.
When you couple that with us coming out of the gate with some pretty aggressive and heavy messaging on, we're going to rescale this and we're going to do a new discovery here. And I mean, this is just the large scale mindset that we're comfortable coming out. And that's our narrative. And that's really going to guide our activities as we go through the year. People are saying like, wow, like I love what you've put together. I understand it. I appreciate it. And I'm very, very, very interested. But you come up with some first drill results, and and then we'll be able to see, right? Give me some early conversion on this aggressiveness and this boldness, right? You want to be different. You want to be seen as a force in the market. It's exciting and everything else. Give us a taste, and then we'll come in. So I mean, I can feel kind of the latent energy. I see that in who's taking the meetings with us.
Okay.
And more, right? We're getting a bit of traction. I mean, in some of the larger Canadian banks are picking us up in their in the morning snapshots and things like that. So it's you can get some of those indicators.
Yeah.
That people do understand and are waiting to see what's going on, right?
Right.
Certainly the current investors and any new investor that's bought any shares since October 12th are obviously in line, right? We're going to have results out in the next couple of weeks, and I think that's going to change everything, right? Key drivers for the stock this year are going to be the rescaling of Eau Claire, right? And we want to be very very direct with what our plans are with Eau Claire.
Okay.
And obviously the continuous drilling results that come from that, right? Which is exciting. And secondly, ounce addition and the chance for a completely new discovery at Homestake Deep. And Community Bay, right? So, I mean, my personal goal, back to your comment on analysts, my personal goal is to test the consensus price target of 350.
Okay.
Canadian.
Got it. Okay, Mike, look, thank you for your time. It's been good to dive into it and hear the story from you. And I want to do it again soon. Yeah, I'm excited for these results. We'll keep our eyes open. And I'd love to have you back on when that day comes.
Perfect, Jay. Thank you for having me again.
This is shocking, actually. I know you're going to want to edit this for general consumption.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome.
Jay Martin here, CEO of Cambridge House, and I am joined this morning by Doug Casey, and we are looking for our next investment opportunity. Doug, how are you?
I'm fine and dandy, talking to you from the backward but very pleasant People's Republic of Uruguay.
Excellent. Okay. So, we had you on the show in November, right in front of your conference, which I attended, and it was excellent, by the way. So thank you for hosting that, and I hope you do it again. Most people on this channel are familiar with you, Doug, but for anybody who's not, we're talking to the founder of Casey Research, multiple times best-selling author. Doug's been at the forefront of the junior mining business and mining finance for 40 plus years. Crisis Investing was a book that Doug published, I believe, in 1980. But it was, we talk about best-selling authors all the time, New York Times bestseller, and not taking anything away from that accomplishment because it's huge in any regard. But there's multiple categories where you can become a bestseller. Crisis Investing was the best-selling book in the United States and remains so for many, many months. And Doug's the author of several books since then, including Speculator, up there on my bookshelf, which is part of a fictional series that Doug's now writing. And I love this because I read a ton of fiction. And, you know, in this industry, sometimes I feel guilty about that. Like, oh, I should be reading Human Action by Ludwig von Mises or Anti-Fragile and these bigger books, which are really important books to read. But I appreciate the perspective I get from reading good fiction, historically accurate fiction, authors like Edward Rutherford, etc. And in Doug's case, what he does is take real events that are happening all around us right now that we're all experiencing and just apply a new perspective to it, really challenging a lot of the status quo about how we think about certain characters. That's kind of the premise. Is that right, Doug, behind the Higher Ground series?
Yes, it is. What I'm doing is taking very unpopular and politically incorrect occupations and showing that our hero, Charles Knight, as he engages in them, can be a good and moral guy. And that's what happened in Speculator, where he gets involved in a gold mine in West Africa that he makes a lot of money on. Turns out to be a huge fraud. So we picked up a lot of stuff from the VRIC disaster on that. Then he still salvages some money after the government takes most of it from him, and sails around the world for 7 years and becomes a drug lord when he comes back to the US, where we talk about the illegal and legal drug businesses in the US. That's a pretty good book. And now we have Assassin, because Charles has made fortunes with both of those businesses and had them stolen by the deep state, by the government. So he decides that there are some people that just need killing. And this is a defense of, this is shocking, actually. I know you're going to want to edit this for general consumption, but it's a moral and ethical defense of political assassination as a possible means of regime change. So it's a morality play in many ways, but it's a hell of a good book. So pick it up. I'm proud of it.
Yeah, no, I love it. So all those books are available at higherground.com, and I encourage you to pick them up. You know, and so to your point about, am I going to edit this? I'm going to try not editing this, and just, we're going to post it as it is. It's so important to challenge your assumptions. Like that's a premise of my life, you know, is to be able to strip away the assumptions, the architecture of your thought process, the way you've been programmed, and truly think for yourself is a really challenging exercise, but an important one. And that, you know, so look, everybody wants access to you, Doug. You've been in the business for so long. What the Higher Ground series is to me is like a window into your thought process, and it's very valuable. So thank you for putting that together.
Well, I try to be suitably outrageous, which is helpful when you want to amuse people as well as educate them, and that includes me. I enjoy reading things that I'm both amused as well as educated. So yeah, thanks. And we all live in our own silos these days, where we tend not to hear narratives from without our silos. So I'll try to say a few things that might shock, hopefully not disgust too many people.
Great. Okay, now I want to dive into a couple topics today, mainly talking about the commodity sector. I mean, the purpose behind this content and these interviews, Doug, as you know, is when I get excited about an investment thesis. First of all, the genesis of that is a response to these conversations. I sit down every week with brilliant individuals and I get to grill them on where their mind's at, where their money's going, all of this stuff, and a variety of backgrounds and areas of expertise. But what I'm looking for is consensus. I'm looking for a common denominator from an eclectic mix of individuals. And that's where I start to zero in, because I can see a wave of capital moving in one direction from a variety of sources. And if I were to say I'm receiving the most consensus about one idea right now, it's absolutely the commodity sector. And so I want to jump into that. I know you're very versed in this. So I want to talk about this, get into where you're maybe deploying capital right now, get into specific commodities and some predictions or forecasts or just thoughts. And then actually this morning, I hopped on my YouTube channel, did a live stream, just told people I'm sitting down with Doug Casey in an hour. What kind of questions do you have for him? And I got a handful from the audience as well. So that's what we're going to do. And beginning, Doug, with the commodities, call it bullish sentiment in the commodity sector. And just real quick, do you agree? Are you bullish on commodities despite, mass global unrest, the fact that so many major cities all over the world are still in absolute lockdown? However, I'm seeing calls for the beginning of another secular bull market in commodities. What do you think?
Yes, I agree, because relative to stocks, commodities are at about the cheapest they've ever been. Relative to the S&P, for instance, the spread between commodity indexes and stock indexes is greater than it's ever been. So by comparison, commodities are really, really cheap. Also by comparison with the bond market. Well, that's an easy one with interest rates at all-time lows and therefore bonds at all-time highs. But there are other things with commodities. They last had a peak back about 2011, 2012, depending on the commodity. We're talking now almost 10 years, and they've been in a bear market for most of that time. So that many commodities, and they've been perking up recently, of course, but they were selling beneath costs of production. And commodity prices always rotate around costs of production. When it goes below costs of production, a lot of companies go out of business, production drops, shortages, it goes back up. And the same thing when they're above costs of production. So until recently, most commodities have actually been below costs of production. That's changing now. But I'm bullish on commodities because we actually live in a world where it's metaphysically impossible for everything to be overpriced. But actually, everything is overpriced with the exception of the raw materials of civilization, which is to say commodities. So yeah, I'm a bull on commodities in general. That's my argument in a nutshell.
Yeah. And so it's mainly from a value standpoint. Correct. That's what you're looking at. It's because you could look at like inflation or currency debasement as a correlation to price of these commodities. Maybe a vaccine-led recovery and a growth boom, the renewable energy sector driving specific demand. But any of those threads that you would tug on more than the other, Doug?
Well, like I said, commodities are about the only thing that's cheap left in the world. But actually, more than commodities themselves, I look first and foremost at gold for a number of reasons. But gold isn't cheap from a cost of production point of view. The all-in sustaining costs of the average gold producer now, about $1,000 an ounce. And let's say the gold is about $1,900 to $2,000 an ounce. So these companies are actually coining money now. So most of what I'm doing is not directly in commodities. Yeah, I know sugar's cheap. Soybeans have come up a lot. Think they're going higher. Corn is cheap. It's going higher. I mean, coffee's cheap. But we're not really talking about those things. We're talking about the metals. And here that means mostly gold and silver and copper. Gold miners are making a lot of money right now, Jay, but the stocks are lagging. They've gone nowhere. And I've asked, well, why is that? And the reason is that the people that manage stocks, the big mutual funds, of which there really aren't any that do gold stocks anymore. At the last gold peak 30 years ago, say, there were 35 gold stock funds. I don't know how many there are now, but not many. They've all gone out of business. The public's not interested in them. The public and fund managers basically believe what Warren Buffett says, gold is just a pet rock. Okay. This reveals a complete lack of understanding of basic economics, quite frankly. But it's wonderful. You can buy these gold stocks now, some of them selling at PE ratios of 7, 8, 9, and gold is going higher. Now, the public is going to pile into these things. The next bubble is going to be in gold stocks.
Okay, that's super bullish. Now, talk to me a little bit about, you mentioned $1,000 an ounce all-in sustaining cost as an average for gold miners these days. How much is the break-even price for a lot of these companies going to be impacted, though, if we continue to see further inflation? I mean, I don't think the money printer is going to stop. How much of an impact will that have on the break-even price of miners, do you think, Doug? And is that something we should be watching?
Okay, well, what are the costs?
All the inputs, I mean, right? Labor, fuel, machinery.
Yeah, energy, that's a big one. Fuel. And I am kind of bullish on oil prices at this point. And talking about oil, I'm very bullish on smaller Canadian oil producers. They're excellent bargains right now. Tangent, I don't know if we're going to talk about oil or not, but in case we don't, I'll throw this in. Back in the early 80s, when energy was something everybody thought about with the oil crises and whatnot, the S&P 500 was about a third energy stocks. Now, when everybody thinks the world is going electric and oil companies are going out of business, and of course, companies like BP have said they're getting out of the oil business. It's kind of like the bell ringing at the bottom of the market. About 2.5% of the S&P is oil stocks. So they've fallen by over 90% in that term, in those terms. I'm also bullish on oil. We're going to talk about metals mostly, but I wanted to toss that out there.
Yeah, I'm glad you did, because I have no exposure to the oil sector, Doug, and it's not an industry that I know well enough to have exposure to. So I'm glad you touched on it, because across the board again, whether it's what you just said, and a lot of the individuals that I follow, Maren Gatusa, brilliant individual in this sector, quite bullish on oil. Eric Townsend, Macro Voices podcast, brilliant individual, very bullish on oil, and it's kind of been off my radar. So I'm glad that you brought it up. But you're right. My focus is the metals. So getting back to that, I understand your sentiment on gold. What else comes out? I mean, I know you're invested, I believe, in the copper nickel space this year. What commodities stand out, Doug, to you as the top performers this year?
Two of the top performers have actually been, it's such a pleasure to say this, my two largest positions, Metalla Royalty, which I was a founding shareholder of, and now one called Nova Metals, which is another royalty company. And incidentally, there are only about a dozen royalty companies involved in the metals business. But royalties are the safest, and in some ways, one of the highest potential, certainly from a risk-reward, cost-benefit basis, way to play the whole market. And Nova has gone from, I don't know what it went public at, 50 cents, and it's trading now at about $4. It's done that in a matter of 6 months.
Yeah.
So, fantastic run. And there will be more royalty companies popping up, much the same way you recall during the uranium boom of how long ago was that? 15 years. There were about 5 uranium companies out there, and by the time the boom ended, there were 400 that had uranium in their name. Not that they mined any. So I think the royalty space is going to grow and fill up too. But I like guys that have got into it early and can pick the low-hanging fruit and know what they're doing, as proved by the fact that they're early to get into the space. So, royalties are a great way to play the metals markets in general. And most people are unaware of their existence even.
Right. And Nova's an interesting story, so I slid Alex Sukernick, the CEO of Nova Royalty, into the Gold Summit that we hosted on November 23rd last year as an outlier. It was all gold speakers, gold companies. And then just to test the market's appetite, I put Nova Royalty into the agenda. And it was really interesting to watch the live chat fire up when Alex and I started chatting, and we got into his business model and what he was doing, buying these third-party royalty agreements in the copper and nickel space. For anyone who's not familiar, that's what Nova Royalty is doing. And, a healthy debate fired up in the live chat between, call it like near-term copper nickel bulls and near-term bears, but maybe long-term bulls. Everybody was kind of aligned on eventually, but timing was the question. And it's an interesting way to play the copper market because you can get in a bit of trouble, and correct me if I'm wrong here, approaching the copper sector with the same lens that you use to look at gold companies, right? When you talk about the exit strategy of a copper company, you have far fewer options, right? The amount of cash and time required to get an economic deposit into production is vastly different. And the suitors that might acquire you, there's maybe 5%. I mean, how many really in the copper business? 5 or 6? Whereas in gold, you have hundreds if you look at the junior producers, mid-tiers, and the majors. Interesting. So yeah, I mean, Nova's been a favorite on the show. And I grill Alex on this because I feel like he's kind of got first mover advantage right now in this sector. But I haven't seen any other comparable companies launched yet, but I'm sure they're coming. Royalties.
Well, one that it's not in the same space, but it's not a gold and silver royalty company. And that's our uranium royalty, which I'm also a big shareholder of.
Yeah.
Because I'm a bull on uranium. In fact, I'm a super bull on uranium, as cheap as it is, and for all kinds of economic reasons. I've long held that nuclear power is the safest and the cheapest and the cleanest form of mass power generation. And that's going to be the case for several decades at least to come. So I'm really bullish on uranium, and Uranium Royalty is the only royalty company in the uranium space. So anyway, getting back to, well, you mentioned copper royalties and other metals like nickel. Of course, copper and nickel are looked upon as kind of being the two new green metals with the battery revolution. But I hasten to add that mining, this is why Warren Buffett, who hates gold, but entirely apart from that, he's never, until very recently, invested in a single mining stock. And why might that be? Because basically mining is the crappiest business in the world. It's a horrible business. It was a wonderful business in the middle of the 19th century when, after the Homestake mine was discovered in Leeds, South Dakota, from discovery to full production was a matter of months. And it was paying a dividend of roughly 100% of the price of what the original investors invested. It was a wonderful business. Finding a gold mine was like finding a gold mine. You were rich. But now, most of the low fruit has been picked. People have been looking for gold and silver for thousands of years, so that all the high grade, obvious, shallow, low cost deposits, they've all been picked. Basically all that's left are things that you need. You can only find with high tech devices or in places where you really don't want to go because the natives will try to steal what you got. So, mining is a crappy business, in addition to the fact that all your money is put in up front. And when we're talking copper, forget about gold or nickel, you're talking billions of dollars of investment. And that's after you spent many, many millions finding the deposit and proving it up and developing it. It's a horrible business. Only a fool would get involved in it. So what are we doing here, quite frankly? Well, the answer is these stocks are very volatile. And when they run, they go for wild runs. So it's a bad habit that I've got, but it's a bad habit that's treated me better than other bad habits that I have.
Sure. Okay. So I wanted to dig into some of your stock picks and maybe top CEO picks. You mentioned Nova Royalty, that's Alex Sukernick. You mentioned Uranium Royalty Corp, that's Amir Adnani. I had some questions from the live chat today, Doug. Specifically, people wanted to know about your investments in the shipping industry. And I wasn't even aware of that, but I was super curious about where you've put cash and why in the shipping business.
Well, there's lots of areas in the shipping business, but I'm interested in the oil shipping business. A big company to look at, I guess, probably the biggest is Scorpio, down like 90% from its previous peak. And the interesting thing about shipping is that recently, everything in the world is becoming regulated. It's like the whole world is turning into a giant people's republic. But anyway, ships, and the kind of fuel they burn and the contents of their exhaust is now regulated. And tankers shipping oil, well, first of all, the average tanker has a life of about 20 years, okay, from the time it's built to the time it has to be scrapped for any number of reasons. But now there's an additional complication is that existing ships, which have 10 years left on their life, they have to spend a lot of money on changing their fuel and the way it's filtered, all kinds of things like that. So, and of course, with oil down now too, you can buy these things. You can buy stocks like Scorpio for a discount of 90%, and oil is not going away. So, yeah, I think that's a real contrarian bet at the moment that's worth making.
Right. Yeah, it's interesting. I wonder if that's all the renewable energy conversation is why I haven't spent enough time looking at the oil sector, because inevitably it's going to be an incredibly important commodity for the rest of my life. The transition will occur, but that doesn't change everything right away. Okay, so Doug, can you share a little bit? I'd be curious to know, and I'm sure my audience would be curious to know, how you break up your portfolio right now. If you're looking forward, how do you break up your portfolio in terms of speculations, investments, and assets? Do you have hard and fast rules that you stick to? You're kind of a cowboy, and how do you make those decisions?
Well, look, I'm a believer in the old market adage. I think it was Jay Gould that coined it: be right and sit tight. And right now, the place to be, as I indicated earlier, is in gold and silver and some other mining stocks. So I am hugely overweight in this area. I have no interest in conventional portfolio management and distribution where you have so many consumer goods and so many industrial. This is banks and financials. Forget about that. It's all crap. We're in a bubble today. We're in we're in a hyper bubble in the regular stock market because not just the US government, but basically all the world's governments are printing up currency units by the trillions. And that money has found its way into the financial markets. And that's why we have this hyper bubble in bonds and this super bubble in stocks. And well, for instance, right now, margin debt in the stock market in the US is at an all-time high. It's $600 billion or something like that. It's an all-time high. So what's going to happen if there's some type of an accident that takes the stock market down significantly and there are margin calls? Then you got forced selling. People forget how cheap stocks can get. I mean, at the bottom of the last depression in 1933, the Dow Jones Industrial Index was yielding 13% in dividends after dividends had been cut significantly. Look, I recommended and I bought and I got very lucky with stocks traded in Belgium, Spain, and Hong Kong in the mid-1980s. Why? Because they were yielding, the major market, the indexes were yielding 12 to 15% in dividends. They were selling at like 4 times earnings, half of book value. That's how cheap stuff can get. And so I really have no interest in chasing the regular stock market right now. That's why I'm just in the golds, because they're really, really cheap. They're the only thing that really are right now. Mm-hmm. I don't know if I answered the question or if that's more you wanted to hear on that.
Yeah, I wanted to know more about your investment philosophy. So thank you. And so, okay, so to recap a few things, if I were to restate what I heard you most bullish on: uranium, Super Bowl in your words, silver and gold stocks, and then the metal royalty companies. And you took a position in Metalla, we've had, founding, and took a position in Nova Royalty. Okay, Doug, I want to.
And I'm bullish on copper and nickel, and I say that in spite of the fact that I believe we're well into what I call the Greater Depression. which is going to be much worse than the unpleasantness of 1929 to 1946, and very different. And during a depression, the use of industrial metals drops a lot because there's less economic activity. So why am I interested in things like nickel and copper? Well, for one thing, because governments are so in control of economies today, they're going to push forward the electric agenda. So there's going to be more usage of nickel and copper and those things. And the use is going to go up on those things, regardless of the economic environment, number one. But number two, it takes so long and it's so expensive developing base metal deposits that there are going to be shortages. So even with copper, well over $3 right now, yeah, I think it's going higher. It's going a lot higher.
Okay.
Same with nickel.
Got it.
And uranium.
Uranium. Yeah. Okay. And you mentioned 2 royalty companies to get you exposure. Okay. I want to call attention to, you're now publishing a daily, it's daily, or is it weekly? Your video blog, Doug Casey's Take. It's a YouTube channel. Search Doug Casey's Take. It's the first thing that comes up. You can just search Doug Casey and it'll pop up there. And you're producing a ton of content on the channel. I recommend people check that out. It's relatively new, right? What drove this for you, Doug?
That's a good question, because it seems like I'm working harder than I ever have in the past. And I need to work less than I've ever had to in the past. Good question. It's all a matter of psychology, isn't it?
Right.
Gee, I don't know. Why am I doing all these things? In fact, I'm coming out with a new version of Crisis Investing written with Nick Giambruno. I don't know. I guess I think I'm going to be right, and I want to go on record as being right. And you got to fill those idle hours somehow, I suppose. I mean, I read a lot of novels now myself, but you can't do that all day long. Mostly classics. In fact, I'm reading James Michener's Tales of the South Pacific now. Quite an interesting book. And just finished, what's his name, McKinnon's book, The Sand Pebbles, which was a great movie with Steve McQueen. So, look, I just want to keep busy. What else am I going to do? Lay in the sun by my pool? I mean, not very interesting. Not very intellectually stimulating. I guess that's the answer, isn't it?
Yeah, no, it makes sense to me. I get it. Okay, so I want to thank you for coming on, and I want to push people to higherground.com for the Higher Ground novel series. Speculator, Drug Lord, Assassin just came out. Doug Casey's Take is the YouTube channel where you'll find Doug on a regular basis, and always stay on top of internationalman.com. That was the producer of the conference that I attended, that you hosted in November, with a stellar lineup of guests. And thanks again, Doug. It was great to connect with you again.
No, it was a pleasure talking to you, Jay. I mean, talk about intellectual stimulation. It's a wonderful thing about Zoom.
You're expanding the resource and taking a different approach, doubling the production. I didn't realize it was that significant. Interesting.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome.
Jay Martin here, CEO of Cambridge House, and we are looking for our next investment opportunity. I'm sitting down now with Mike McAllister of Sierra Metals. Mike, how are you?
I'm doing well, Jay. How about yourself?
I'm good. Thanks for taking the time today. I'm looking forward to digging into this story a little bit and opening the curtain for my audience. So thanks for taking the time. Now, for anybody, maybe what we'll do here, Mike, is I'll share what I know about Sierra, how I view this story, and then I'll hand it over to you and let you tell our audience how I did on my summary. So Sierra Metals, cash flowing mining company, true polymetallic. I think 40% of your revenue is coming from copper, 20% from silver, 20% from zinc, 10% gold, 10% lead, I believe. And close. All right. 3 assets, Peru, Mexico. Kind of like the gem that I see in this story is Yaracucha in Peru. It's the biggest asset, the most cash, predominantly copper, silver. Is that correct, Mike?
There's actually quite a bit of zinc there as well. So
okay. I
would say zinc is it's actually the largest metal out of Yaracucha, but copper is growing.
Okay. And the Yaracucha asset produces 60% of Sierra Metals revenue. Two other assets in Mexico, Bolivar, which excited me the most when it came to exploration upside. So I'm excited to hear that from you. And then Cusi, which was the kind of the small asset, almost the outlier from what I saw initially, 10% of revenue. But, recently you guys put out some news on some further development at the Cusi project. So I'm excited to dive into that. So how did I do, Mike? And what did I miss?
No, I think you did great. In terms of the company, yes, we are cash flowing. We had free cash flow of 24 million in the third quarter, EBITDA of 37 million. I think you're going to continue to see those type of results into 2021. In terms of the assets, Yaracucha, yes, is our flagship asset, and I think there's a lot of growth there and a lot of opportunity. We're waiting for a permit from the government to be able to increase that 20% in 2021. Probably expect that around the end of the first quarter. Bolivar, we finished ramping up to 5,000 tons per day this year. And so going into next year, that mine will be running at 5,000 ton per day capacity. That mine is just going to continue to deliver. And then Cusi will be at 1,200. But as you mentioned, we have some new development, including a new discovery at Cusi, where we discovered a new area to the northeast that was previously thought to be unmineralized. And we had some great results there, including about 400 meters of about 400 grams silver. And then we also had about 5 meters of about 1,100 grams silver. So there's actually, while the Cusi is kind of the junior of the family, there's a lot of opportunity there in the sense that we're starting to find some much higher grade material. And, people always wonder, what trend are you on? Where are you close to? One of the most recent IPOs is Gato Silver. I'm not sure if you're familiar with that. And we're actually on the same trend as them, about 40 kilometers away to the northwest. And so, there's still a lot of opportunity there for some much higher grade silver.
Right.
And then the biggest thing I would say is, aside from where these mines are now, is the growth. And we've actually just completed 3 PEAs that we've published to the market, and with excellent, economics on it. And so Cusi, we'll start with the smallest one, is going to be doubling to 2,400 tons per day. And then that had, and that, let me just give you an idea of that. So the after-tax NPV on that is 81 million. And the life of mine cash flow on that is about 130, after-tax cash flow is about 134 million. Bolivar, second mine. Sorry?
It's just interesting, backing up to Cusi there, just because, I was curious what your plans were with that asset moving into what looks to be like a sustained silver market here, right? And knowing it was only 10% of the revenue, but with silver price moving, the margins were improving. And then I saw this news from a couple of weeks ago, because I always wondered if you would maybe sort of package that out and sell it into the silver market as an asset to a silver producer. But you're expanding the resource and taking a different approach, doubling the production. I didn't realize it was that significant. Interesting.
Yeah, so we're going to go to 2,400. We're going to double production. Longer term, does Cusi stay in the company? The question's been kicked around a little bit by management.
Okay.
Because it's kind of the outlier and it doesn't really fit, but at the same time, it still offers a lot of value in the sense of expanding production and cash flow. And at the end of the day, it's about cash flow and eventually returning capital to shareholders. It still offers a lot of value. Whether that gets spun out eventually, it's a thought, but nothing's been decided at this point. And so I think Cusi still has a lot to offer, but whether it ends up with a silver company or even spun out as just a separate entity, so that it can, attract those silver multiples, those are options that the board is looking at as well.
Okay. And then let's move over to the gem, Yaracucha. I think you guys have spent about $15 million, if I'm right, in the last 9 months and updating the mine. Is that correct?
Yeah, so we've spent quite a bit of money updating the mine. We've we've been doing a lot of infrastructure because again, Yaracocha is going through an expansion, so it's going to increase 20% this year to about 3780 is what we're allowed. So we're allowed to 3600. The Peruvian government allows you a 5% over allotment on what you're expanded to, and so that 3600 will work out to 3780. And so we hope to have that permit by the end of the first quarter, and then be able to increase our production after that. And then again, we're looking to expand that to 5,500 in tons per day in 2024. And so a lot of the work that we're doing is not only expanding the short-term expansions, but also starting to support the longer-term expansion. And so we've been doing projects such as we put a tunnel in at the 700 level that communicates the entire mine, comes out of an adit at the side of the mountain. We're able to operate larger equipment on that, larger trains, larger locomotives to move more ore and waste. Also, what happens is that brings the surface of the mine from surface down to the 700 level. So that shortens the hoisting time. And so it just improves the overall efficiencies of the mine. And we're also doing a similar tunnel on the 1200 level. And that's allowing us to do some drilling on some new targets that we have there. It provides better underground access. And then overall, we're just finding other ways, like we've been putting in automated remote equipment. We're improving. They want to, as part of the expansion, put in an ore sorter underground. So there's just different projects that are coming along that will not only help us to reach those 5,500 tons per day, but help us to drive down the costs. When on the CRU structure, Yaracocha is in the bottom second quartile, and we think we can push that to the first quartile this year.
Okay. Yeah. I mean, that's what we want to see. I think we're going to see some inflated input costs for mining companies probably in the next 5 years. And so getting ahead of that game. How much of these initiatives, mainly the updates to the Yaracocha mine, were led by Luis? Because Luis Marchis took over as CEO in the spring, correct? It was like May, June. So relatively new to the seat still, less than a year. Is he driving these changes, or are these changes that were already in line and he's fulfilling the plan?
Yeah, so a lot of the plan had been put into place and approved by the board, and we had the path ahead of us. However, Luis is a very strong operator. He came from Anglo American, has a very strong operational background. He was running their Quellaveco porphyry project, and so he is not only focused on supporting what we're already doing, but finding other improvements and other ways to improve efficiencies at the mine. And one of the things that Luis was very good, he came in right at the beginning of the COVID issue, or the COVID pandemic, and yet still, working with the employees, has managed to find efficiencies and to help the reduced workforces that we were allowed to have during that time to work more efficiently. And so he's been a very strong leader in that. And, he's also helping us to overall understand the mines and how we can improve further efficiency. So, he's supporting the plan that we had, but he's also adding his own personal touches and, adding value in terms of helping us to find further savings and further efficiencies in the company.
Right. Yeah. I think 25 years with Anglo American, right? The direct advisor to the CEO. Quite the resume. So an awesome addition to the team. We haven't talked about Bolivar yet, which is the second asset in Mexico, Yaracocha in Peru. Luis is Peruvian, home country. So what about Bolivar? What can we expect, Mike, from Bolivar in the near term here?
So in the near term, what you're going to see is we're going to hit that 5,500 tons per day, we're going to hit that 5,000 tons per day, or we're there now. So you're going to see Bolivar producing not only at an increased rate, you're also going to see, we're continuing to work to improve the grade. So typically we had mined from an area called El Gallo, which is about 1% copper equivalent. We now have included a new discovery from a couple of years ago called Bolivar West. And so the mill feed right now is about 60% from El Gallo, 40% from Bolivar West. But Bolivar West has, from the drills, about a copper equivalent grade of about 2.55, because there's much higher grades of gold and silver in that area, as well as slightly higher copper. And so we're going to ramp that up, continue to ramp that up, to be able to sweeten the feed to the mill and increase the value per ton. Additionally, we have other ore bodies surrounding that, including Bolivar Northwest, Seneguida, and the Bolivar West extension, which offer the similar grades as Bolivar West. And so we're working to develop and bring those into the mine plan. We're also, similar to Yuracocha, putting a tunnel that connects the mines with the plant. And that offers, that'll help us to lower our costs and to improve efficiencies. It'll also offer us kind of an insurance policy against the rainy season, because sometimes when we get heavy rains, we end up getting the roads washed out. We have to take a couple of days to rebuild the road before we can continue shipping to the plant, which is about 7 kilometers away. So this is going to be a straight line, 3-kilometer tunnel. Should be done next year. We're working on it now. And, that's eventually down the road could be replaced so trucks can move to a conveyor system. And we've actually have been reducing our tail capacity, because we're using something it's not a complete dry stack. We put it in a paste. And so it doesn't take as much. It's a lot easier on the environment, but eventually we'll be able to ship that paste back and put it into the mined out area. So there's a lot of efficiencies that come from that tunnel. So not only is Bolivar going to see that happening in the next couple of years, we also have the expansion. We're going to double there as well to 10,000 tons per day. And so, Bolivar, while Yuracocha is the gem, Bolivar, with the current copper prices, is catching up.
No kidding. That's the metal of the future. Okay. Now, I'm familiar with yourself and with Louise and your background. I mean, 16 years within public companies, and either prior to that, BMO Capital Markets in the mining and metals division. So thorough understanding of how to evaluate these companies and create value. But I want to give you the opportunity, Mike, to touch on anybody else, directors, shareholders, that would inspire confidence from the retail investor base.
Yeah, so let's start with some of the directors. We have Doug Cater, who used to be the VP of Exploration at Kirkland Lake. Strong geology background, understands the technical aspects of the mine, very strong support of the mine there, or of the team. Also, Stephen Dean, I'm not sure if you're familiar with him. He sold Atlantic Gold to St. Barbara, so did a really good job there. And he's had quite a bit of success, and I think several retail investors will be familiar with him. So he sits on our board as well. So we have a couple of very strong members there. We also have Jose Alberto Vizqueras, which he worked for Osisco, and now he works for, the name's escaping me, sorry. I can't think of the mine right now, I apologize. But he, again, very strong geological background, good operator, his father's Peruvian, so he has a very good understanding of the politics and stuff in country. And then in terms of the management team, we also have some very good technical people on our team here as well. Ed Guimaras has worked for Ore Resources, which was bought by Tech Gaminco. He's our CFO, strong CFO. Alonzo Lujan, he worked for Trafigura. He worked for he's our VP of Exploration. He's worked for several large mining companies, and he's an economic geologist. So he's good at not only finding the rock, but finding rock that's going to make you money. And then we also have Augusto Chung, very strong metallurgist, who's worked for BRIC, Rio-Alto, and several other companies, and he's done a fantastic job improving our grades and our recoveries at the various mines. It's like for example, at Kusi, we've improved recoveries by 15%, and it helped us to improve our recoveries at Bolivar by about 10%. So, great job in that sense as well. So, and then we've also just hired a new manager of VP and sustainability called Gabrielle Pinto. And we're working to hopefully have, in the next year, have our first ESG report out, because that's becoming more and more important to investors. And we're doing a lot of this stuff already, so we might as well get some credit for the good work that we're doing.
Yeah. Okay. I want to touch on your cap table quickly. If you guys are sitting on somewhere around 60 million in cash right now, as of the last report I saw, I think September 30th. Can you touch on management ownership in the company, Mike?
Sure. So, we have 64 million in cash right now, and that'll probably grow this in the fourth quarter. In terms of the management ownership, we list it as 59%, and the reason for that is 52% is owned by Arias Resource Capital, which is a fund in New York, and the chairman of Arias Resource Capital sits on our board, and so he's an insider and controls a lot of that. So we list it as 59%. The other 7% is the rest of the board and management that are involved in that. And while that's a little bit lower than some companies, a lot of the board and management came in later on. And so these aren't shares that were given as seed financings. Most of this was bought just in the public market.
Yep. Got it. Okay. Very cool. Okay. So trigger points for 2021, Mike, when you're telling this story to a new prospective shareholder and they ask, how am I going to make money this year? I mean, you look at the chart, you guys have had a fantastic run since the summer. One of the better performing companies in the space, to be honest. And someone has a look at the chart and says, have I missed the opportunity? Mike, what do you have to say in response to them?
Definitely not. You haven't missed the opportunity. There's several things that are going to add value in the coming year. One is not only we did 3 PEAs, but we're going to be updating those to preliminary feasibility studies in this probably in the early second quarter, and that's going to include reserve updates. So, where we added in 2020, 28 million tons of resources, we're also going to be updating the PFSs in the second quarter or preliminary feasibility, which is going to add reserve tonnage. So reserves add value. That's one value point right there. We're going to see Yukon increasing 20% in the year. So that's going to add further exploration and cash accretion through the production there. Metal prices are strong for the year. And the last one is that, in 2020, you had Kusi and Bolivar, which were ramping up. They had been slowed down during the pandemic, and they only ran for partial days during the third quarter, or in the second quarter. But in the third quarter, you saw the ability to generate cash as we were ramping up, and those still weren't at full value. They were probably running at about 75% of their full capacity. We're hitting that in the fourth quarter and into next year. So you're going to have the full benefit of these mines running at full capacity, including an increase at Yukon, an addition of reserves and potential further resources in the company. And this is just on our way to, almost a doubling of expansion or production across the company. So there's still a lot of value to be gained.
Okay, excellent. I appreciate that perspective, and it's a story to be excited about, especially if we see commodity prices continuing to rise, which is the reason we do this content, because we believe that thesis to be true. Mike, so thanks so much for your time. It's been good hearing the story directly from you and getting clarity on how the 3 assets play off each other. Sometimes especially a polymetallic company, with 3 assets, it can be difficult for a retail investor to wrap their mind around how the share price is going to perform in relation to what, right? Because we have exposure to copper, silver, gold, zinc, lead, etc. So, but I appreciate you providing clarity on that and where we can look for growth, most importantly, moving forward.
Yeah, and often I tell people, when it's a polymetallic, stop looking at the individual metals, look at the cash flow, look at how the company is growing in terms of cash flow, and it provides a bit of a natural hedge against fluctuating metal prices because we're spread out. But I would say in 2021, the biggest 2 providers of revenue are going to come from copper and silver, and those both have very strong outlooks on them.
Yeah, well, that's the best answer right there. Focus on cash flow. That's a good place to wrap it up. Okay, awesome, Mike. It's been great hearing from you. Thanks so much for taking the time. I appreciate it.
All right. Thanks, Jay. Take care.
Hi, I'm Veronica Van Wollen, and joining us today is Jordan Trimble. Jordan is the president and CEO of Skyharbour Resources. Skyharbour is listed on the Toronto Stock Exchange on the Venture, as well as the OTC under the ticker symbol on the Venture, SYH. Jordan, thank you so much for joining us. How are you today?
I'm doing excellent. Thanks for having me. Looking forward to this.
Yeah, I'm looking forward to diving in, right? Uranium is one of those commodities that's kind of unloved. And I think we're going to really stand out here for any contrarian investors that maybe have felt they've missed the boat with some of the copper and gold runs. Before diving into kind of what the opportunity is here for Skyharbour, I'll give the viewers a quick summary, and then I want you to kind of dive into the summary in more detail. What we see here is a uranium explorer. Skyharbour has top tier assets in the Athabasca Basin. You have a very noteworthy shareholder base, as well as significant insider ownership. And I think that's all going to play in really nicely into 2021, especially with this green energy move. So off of that, why don't we kind of dive into it? Tell us a little bit more about yourself and Skyharbour Resources.
Yeah, absolutely. So for those of you who don't know me, I'm the president and CEO of the company, Skyharbour Resources. I started running the company about 8 years ago, and I come from more of an entrepreneurial and financial background. I was previously doing corporate development for a gold company called Bayfield Ventures, which we had a successful exit with. The company was acquired by New Gold. Been involved with several companies on the management side of things over the last number of years. I've been working in the industry for over 10 years, and Skyharbour is really my baby. It's a company that I started with my head geologist, Rick Kazmersky. We took a vehicle about 8 years ago and saw an opportunity in the uranium sector. At the time, it was a very depressed market. We are now starting to finally see the market turn around. We've had a couple of months here where we're seeing the sentiment improve, the narrative change, and renewed investor interest come back into the space. So just to give a quick summary of the company, as you mentioned, we are a high-grade uranium exploration and early-stage development company. We have 6 projects scattered throughout the Athabasca Basin, which is in northern Saskatchewan. They're all drill ready. 2 of them have deposits on them. We're currently advancing our high-grade Moore project. This is our flagship project that we own 100% of. We've had recent drill results announced there, and we have plans to follow up with drilling in the next few months here. That's a key upcoming catalyst for shareholders and prospective investors. But we also maintain a very large portfolio of other properties throughout the basin. And with these projects, we carry out prospect generation. So what we do is we go out and we do a little bit of work on these projects, but we basically package them up to have other partner companies come in and fund the exploration. So we've now consummated 3 deals with 3 separate partner companies, which I'll talk a little bit more about. But the key takeaway there is we now have agreements for a combined almost $18 million in project consideration, in cash stock issuance, and in exploration expenditure. So it's a great complement to our focus at our flagship project, where we offer investors high-grade uranium discovery potential. We all know some of the recent success stories in the Athabasca Basin, like NextGen and Fission, and more recently IsoEnergy. It's a great value creator for exploration companies. There's a long history of work that's been carried out and money that's been made in the Athabasca Basin. And so that's what we're looking to do with our, not just our flagship project, but with our partner-funded projects as well.
Yeah, and we'll get into more of your plans kind of for more, as well as your other assets in the portfolio. Let's talk about uranium first, though. It's unloved. There's a little bit more love. Why should investors care about uranium?
Yeah, well, I think you hit the nail on the head. It was unloved. The sentiment is improving, as you and I talked about offline, and it's been a long time coming. Look, when we started this company and started building it as a uranium company, it was very unloved. It was a true contrarian opportunity, and just to highlight the depth of the bear market back in 2013, 2014, 2015, we were able to acquire our portfolio of projects for approximately $5 million Canadian. Wow. Now, 2 of these projects were in a company previously that was valued at a few $100 million back in 2006, 2007. So this just shows you the serious cyclicality of this industry. But what really drew me and my team to this was, this contrarian opportunity, specifically with uranium, being able to build a portfolio and build a very good team, a strong team to advance that portfolio. The second component that particularly interested me was we were seeing some new exploration methods and techniques and thinking that were being used successfully to make new discoveries that had previously not been found in the Athabasca Basin. And so, that's something that we pride ourselves on. We're using the latest techniques, and we're testing some new geological settings to find deposits, high-grade deposits in the basin that had previously not been found. And so you have a combination of a metal that's been under pressure, that's been under siege for a while. It's finally starting to move higher. And we can talk a bit more about that, coupled with strong discovery potential using new exploration methodologies.
Yeah, no, it seems like, a lot of those factors are playing into what's happening now in the market. And we know that 2020 was a year of headlines for green energy. That's been a big trend right now. And I'm curious how, in your eyes, you see uranium and nuclear energy kind of relating to that whole decarbonization trend. So talk to us a little bit about that, and also about the supply and demand fundamentals when it comes for the commodity.
Yeah, so I'll start with the supply demand. I mean, this is what I feel like my peers and I have been preaching now for many, many years. I mean, it really is a truly compelling supply demand picture, where you now have a pretty major supply deficit that's formed to the tune of about 60 million pounds. So in 2016, we saw global primary mine supply ramp up to about 160 to 165 million pounds. Now, we've seen a major supply side response play out over the last several years, initially from the low prices, the low uranium price. So we saw production go offline. We saw project deferrals, and that led to a pretty steep decline down to about 135 to 140 million pounds. Now, this has all been exacerbated with the virus this year. We saw at one point back in April where almost 50% of global primary mine supply was shut down and disrupted from the virus. And so we are expecting in 2020, when the numbers come out, we'll probably see somewhere between 110 to 120 million pounds of primary mine supply. Now, that's all in the backdrop of growing demand at about 100 to 180 to 185 million pounds. And so it just shows you how fragile the supply side is. The risks to the supply side far exceed the risks to the demand side. And this is the case when you have a commodity like uranium, where the primary mine supply, the production, is concentrated both geographically and geologically as it is. 40% of global primary mine supply, for example, comes from Kazakhstan. The Athabasca Basin is another high concentration production jurisdiction. So you can see major supply disruptions happen quickly, as we did see this year, and it have an immediate impact on the market. Now, shifting over to the demand side, this has really been the spark, I think, recently in what we're seeing transpire and this building momentum, which is the green energy narrative and trend, and just the electrification that we're seeing happen globally. It's no secret we need more electricity. When you talk about the advent of electric cars, when you look at how much more electricity developed nations in particular consume, and now developing nations are consuming, we need a reliable, clean baseload source, meaning 24/7 source of electricity, and that is nuclear. It's plain and simple. It couples well with renewable energies, but renewable, like wind, like solar, are intermittent. Nuclear has a 85 to 95% capacity factor. It can produce whether the wind's blowing or the sun shining 24/7. And so it is that baseload clean source of electricity. And we see countries like China talking about going carbon neutral by 2060, the US going carbon neutral by 2050. Nuclear has to play an integral role in that. And that's what we saw post-election. And I believe that was one of the sparks here for this recent rally, is you saw now an incoming Biden administration that is going to put green energy and climate change at the forefront of their policies. And we've seen already a $1.7 trillion climate change budget. Included in that are the rollout and development of SMRs, small modular reactors. I think that that's going to be an incredible new source of demand, especially in the Western world. So, bottom line is it has a very important role to play as the green energy narrative and push continues to build momentum, and we see that continue to grow, especially with investors and the ESG crowd. I think you're going to see that translate into higher share prices for uranium companies and nuclear companies going forward.
And just for anyone who doesn't know what ESG is.
Yeah, so environmental, social, and governance. So in particular, obviously on the environmental side of that, the nuclear industry and as a result, the fuel providers, the uranium mining companies, are now getting attention from the ESG investors out there. And I think that that's a trend that will continue. There's a lot of money floating around right now with ESG investors and products. And so I think as we see more interest for nuclear over the coming years, that will continue. And also just note, getting back to the US, because it is topical, we've seen some notable recent legislation that's been pro-nuclear. I think we'll continue to see that. The Russian suspension agreement recently amended and extended a new domestic uranium reserve. Bottom line is that there's also a trend towards secure domestic supply and supply chains. And that's, I think, going to be beneficial, in particular in Canada and the US. I think that that's going to benefit North American uranium mining companies. And so that's something else to keep an eye out for.
Right. Okay. So a lot of things there that are driving your bullish sentiment on the space, especially tying into the whole green energy movement. I want to bring that back into how that affects investors' decision today, but we'll talk about that a little bit later. Let's kind of pivot and focus now more on your flagship project, the Moore Uranium Project. I know it's on the eastern flank of the Athabasca Basin. Tell us about how you've acquired this project and what is the work that's being done on it.
Absolutely. So this is our flagship project. We own 100% of it. It's really, I'd say, the key value driver for the company currently. We acquired the project from one of our largest strategic shareholders and partners, and that's Denison Mines. We acquired this in 2016, going in there to expand on a historical showing. There was a high-grade lens that was discovered on a 4.5 kilometer long conductive corridor called the Maverick Corridor. And so these high grade lenses or pods had been discovered historically, actually by my geological team led by Rick Kazmersky back in the early 2000s. And some very high grade mineralization up to 21% U3O8, basically at the unconformity. And so when we went in and acquired it, and since then we've carried out several drill programs, we've shifted our focus to not only discovering additional pods or lenses of high-grade uranium along strike in the sandstone and at the unconformity, but what we've been doing more recently is testing for what's called basement-hosted deposits. And so these are uranium deposits that are in the underlying basement rocks. And what's interesting about this project is there really hadn't been a lot of historical drilling or work carried out testing this geological setting. Yet this is where most of the recent discoveries in the basin have been made. So we know we have very high-grade mineralization at the unconformity and in the sandstone, but very little drill testing for the feeder zones that bring that uranium up. So more recently, and including this drill program that we just completed and announced results for, the focus has been on these basement-hosted targets. And just in this last program, we announced some of our longest widths of continuous uranium mineralization, 17 to 18 meters of continuous mineralization. We had one hole that returned 10 meters of 1% U3O8, and we feel like we've really just scratched the surface and that there's going to be more found there. So a key upcoming catalyst for shareholders to look out for will be another drill program that will commence here in February, continuing to drill test these basement-hosted targets and test that 4.5 kilometer corridor, which only about half of it has been systematically drilled.
Okay, so to simplify that a little bit, because I know there was a lot of information there, I want to make sure investors aren't missing the point. You own in full this project. Saskatchewan is a known fantastic region in the Athabasca. It's top tier, world class. And you're focusing with a large drill program this year on an area that hasn't had too much exploration. So you're hoping to really expand the resource here. Is how?
Yeah, exactly. Absolutely. Okay. We're looking to go in and expand known zones, but also discover additional zones of high-grade uranium mineralization. And again, that's a key value driver for the company over the next 6 months.
So Jordan, I want to backtrack just a little bit and talk about Saskatchewan, because your flagship project, as well as all your other assets, are located in Saskatchewan. So talk to investors about why Saskatchewan is significant, as well as your other projects that you have in the portfolio.
Yeah, sure. So Saskatchewan in the Athabasca Basin in northern Saskatchewan is the highest grade depository of uranium in the world. You see grades of deposits there that are 10 to 20 times the average global grade. It's also consistently ranked as in the top 3 mining jurisdictions to work in. Our team has focused expertise on uranium exploration and development in the Athabasca Basin as well. So that's why our focus is there. And now on our other projects, as I mentioned briefly earlier, we do maintain a large portfolio of properties, over 240,000 hectares of ground, again, scattered throughout various projects in the basin. Outside of our flagship project, we do maintain 3 partnerships with companies that are actively exploring our other projects. First and foremost, a strategic partner and industry leader, Orano Canada. Orano is France's largest uranium mining and nuclear fuel cycle company. They have an earn-in option to earn up to 70% of our Preston project, which is over on the west side of the Athabasca Basin. They've been actively exploring and advancing that project over the last several years. Another partner we have is a company called Azincourt Energy, based here in Vancouver. They have an earn-in option at our East Preston project, and they're nearing completion there of that 70% earn-in. It was about a $4.5 million earn-in, both in cash and stock, as well as exploration expenditures. So they're actively exploring. They have plans for future work there in 2021. And our third partner is a new company that's come into the fold called Valor Resources. It's an ASX listed company that we just announced a definitive agreement with late in the year, last year in 2020. They can earn up to 80% of our North Falcon Point project, which is over on the east side of the Athabasca Basin. And in order to complete that earn-in, they have to spend $3.5 million in exploration expenditures, make just under $500,000 in cash payments over a 3-year period. And then we get 233 million shares of the company, approximately valued at just over $1 million. And this is exciting for us, not just because it's a new partnership, but it's led by a very strong and capable management team based in Perth, a lot of mining experience with their team. And I think it's going to open up a new audience in Australia for not just Skyharbour, but for exploration, uranium exploration in the Athabasca Basin. So bottom line is we have 3 partners that are actively exploring our other projects. We're currently looking to option or joint venture out the other projects that we have in our portfolio that we own 100% of. So that's, again, a potential upcoming catalyst this year. But I think the key takeaway with those partners over the next 12 months is that it will provide ample news flow and exploration and project advancement over the next 12 months that will help complement what we're doing at our flagship project. I always like to think of it as having multiple irons in the fire, increase your chance, your probability of making a discovery. If we have partner-funded programs, we're going simultaneously with our program at our flagship project. There's an increased likelihood that we'll find something or a partner will find something.
Yeah, no, that's those are all really, really good points. And I like that. It's optionality for investors, right? Exactly. We're getting close to time, but I want to focus on 2 last questions that we have for you. Tell us a little bit about the team and the share structure, because I know you have some pretty significant individuals involved.
Yeah, absolutely. Well, the share structure is straightforward. There's 99 million shares issued and outstanding. We're trading around a 25 to $30 million Canadian market cap. As far as the team goes, I take great pride in having a very strong team around me, both on the management side, capital market side, as well as on the technical side. So I run the company. I work closely with my chairman, Jim Pettit, here in Vancouver. My technical team's led by Rick Kazmersky out in Saskatchewan. Rick's a 40-year veteran. He was a the senior geologist and exploration manager at Cameco for a number of years. Him and Dave Billard head up our technical team out in Saskatchewan. And more recently, we brought in some more capital markets experience with Joseph Gallucci, who's the head managing director of mining investment banking at Laurentian Bank in Montreal. And then last but not least, Dave Cates, who is a director of the company, is the president and CEO of our strategic partner, Denison Mines. So a very strong, capable group that has management and capital markets experience, as well as a focused expertise in the Athabasca Basin.
Mm-hmm. And David is part of, Denison is part of Lundin Group of companies, for anyone that doesn't know that connection. Okay, so a lot of information. I want to bring us all back to the most important questions that any new investor looking at this story would want to have, or existing shareholders. Why should investors look to add Skyharbour to their portfolios today?
Yeah, look, we have a very important year ahead of us at Skyharbour. First and foremost, we do feel like we've made a lot of progress at our flagship project over the last several years. We have drill targets outlined for the upcoming drill program that we feel can yield a major discovery and continue to add pounds at our flagship project, testing predominantly basement hosted targets, but also testing other targets on the Maverick Quarter and at the project that have had very little historical drill testing. So high-grade uranium discovery potential at our flagship is a key upcoming catalyst. But as I just went through with you, our other partners at our other projects offer additional news flow and additional discovery potential. Again, multiple irons in the fire. And if they have success at these projects and complete their earn-ins, we retain a minority interest. Again, we have that optionality value there. This dual-pronged strategy of focused exploration at our flagship and prospect generation at our other projects is quite unique to Skyharbour. And then last but not least, and probably more important this year than any year previously, we are now seeing the early innings of the next uranium bull market. I truly believe that. I've said in the past, we saw the bottom put in 2016. We've seen the spot price, the commodity price tick up. We haven't seen it really break out yet. I think that's the next shoe to drop. We talked a little bit about why and what I see happening in the uranium market. But bottom line is, I do believe there will be a very strong bull market over the next several years for this commodity. It's been beat up for far too long. It's finally getting the attention of the investment community, broad and generalist investors. If you look at the combined market capitalization of all publicly traded uranium companies, it's still less than $20 billion. So still a very small market that has a lot of room to move. And I think as we see the commodity price, the metal price start to tick up, which I think we will see this year, I think we'll see more interest come into the space. And I think we'll see that result in higher share prices across the board.
That's great. That's an awesome summary. Thank you so much, Jordan. Again, Skyharbour Resources, Jordan Trimble, President and CEO. Skyharbour is listed on the Toronto Stock Exchange on the Venture as well as the OTC. And on the Venture, their ticker symbol is SYH. Jordan, thanks again for your time.
Thanks for having me. It was a pleasure.
If you are just tuning in, my name is Jay Martin. I am an investor and the CEO of Cambridge House. Now, what we're doing today is diving deep into a handful of resource investment opportunities, talking to the company CEOs, and in addition, stress testing our investment ideas and strategies with some of the most prolific money managers that I know in the business. Now, the reason that I do this is because I'm an investor first, and I'm trying to grow my portfolio. In addition, I'm trying to identify blind spots I may have that would be compromising my decision making. I do this through conversation with industry personalities and company CEOs right here on the channel. Now, today we have a killer lineup of amazing content, and the whole agenda is right beneath this video in that YouTube description. Check it out, stick around. I'll be active in the live chat. Drop me a line, say hi. Please hit subscribe to stay tuned with what we're up to at Cambridge House, and enjoy.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay guys, Jay Martin here, CEO of Cambridge House, and I'm joined by Adrian Day, the founder of Adrian Day Asset Management and portfolio manager at Euro Pacific's Gold Fund. Adrian, how you doing?
Well, I'm fine, thank you, and thank you for asking me back.
Yeah, it's good to have you back. We last caught up in November and had a very positive response to our conversation, so I'm excited to share your perspective again, because even in a few months, tons has changed. And, why don't we start there? Let's start with the U.S. government administration. Looks like we've got a Democrat-led government. And does that impact your gold thesis for 2021, 22, and the near term?
Yeah, no, I think it's very significant, frankly. Now, you have to understand it's 50-50 in the Senate, it's 50-50 with the deciding vote cast by the vice president, who's obviously will be Democrat. But when you're 50-50 with one deciding vote, that means that means you can't afford to lose very many of your own supporters. So to me, what that means is that some of what we'll call the more extreme proposals probably will not get very far. The Senate, both Republican and Democrat, the Senate historically has been a body where it's easier to get, we'll call them defectors from one party to the other, if they feel that the administration is moving too far in one direction. So I think, it's not as though they have a 60-40 majority or something, which will be completely different, but they do control it. So that clearly means, that spending is going to be easier than if the Republicans retain control of the Senate. So that's a very, very significant thing, because if the US steps up its spending, as we know, most spending, certainly in the last couple of years, has been unfunded spending. Meaning, we're not collecting taxes for the spending. We're not even borrowing the money. We're just creating the money out of thin air. In fact, right now, if you look at what we'll call the untouchables in the US budget, which are interest on the government debt, transfer payments, I nearly called them welfare, that's probably politically incorrect, and defense spending, those three, which are the big ones, of course, but those three things, they're already 150% of the tax collected. So tax isn't going anywhere close to paying for what we have at the moment, let alone what's coming down the pike. And if the Fed continues to create money out of thin air, that is very, very bullish for gold, extremely bullish for gold.
Okay, I'm with you there. Now, so following that thread, there's a couple of questions I want to ask that sort of spin out of that. Number one, if this gold market and precious metals market continues to heat up, the risk factors for retail investors increase alongside, right? Because more companies enter the space, expenditures get more frivolous. There's more landmines for us to step on. And so, we always talk about how to pick a winner. You only do that if you avoid the losers, right? And so what are some common mistakes, Adrian, that you see retail investors make when a bull market is emerging in the commodity space? You've been in this game a long time.
Yeah. Well, first of all, I think it's important that we recognize as gold investors, gold stocks are inherently volatile, even in the best of times. You only have to look at, say, Franco-Nevada and look at, the drawdowns that that's had over the last 10 years. So it's an inherently volatile sector. And at the same time, it's inherently risky. Risk and volatility are two different concepts, of course. Risk is a permanent impairment of loss, and risk is a temporary impairment. Volatility is a temporary impairment. So it is more risky as well as more volatile. And I think you are if you're investing in gold stocks, particularly in juniors and exploration stocks, you are going to have losers. You simply cannot avoid it. Anyone who's been in this business 10 or 20 years says they've never had a loser. I don't know what they're investing in. or smoking. So you are going to have losers. So the question, of course, is partly how do you pick right stocks to begin with and try to avoid losers as much as possible. And then the other side of that question is, what do you do with the stocks that don't do what you expect them to do? But in the first part of that question, to me, the most important thing, which, I keep coming back to, is to stick with good people. And, people who've been around a long time, everyone's got to start out somewhere, of course, but people who've had experience at other companies, people who have good reputations in the business. And once they're running their own companies, people who simply do the right thing, do what they say they're going to do, don't waste money, et cetera, et cetera. And I think if you stick with the right people, to me, the people are so much more important in exploration than the projects. And I've said this before, because good people will be able to raise money and will know what and will get rid of bad projects and will be more likely to find good projects. Bad people can, I don't care how much money they have, they can waste it and they can destroy a good project. So people are the most important thing. And you're absolutely right, Jay, as the market develops, we'll see more. At the moment, I think we're on pretty good ground. We all know a few stocks that we might want to avoid, but we're on pretty good ground, especially, say, the seniors are being very disciplined in their spending. But as the market develops and the shortage of projects becomes even more critical than it is right now, for companies who are producing 2, 3, 4, 5 million ounces a year, slowly seeing those reserves deplete and not replacing them, I think, we're going to start seeing some of the old failings come back, frankly. Sure. But particularly for the senior stocks, we're a long way from that at the moment. Okay. And the juniors too, frankly.
Yeah, sure. Well, there's been a bit of a disconnect so far between the price appreciation of the commodities and the miners to a degree. And I want to talk to you about that a little bit. But beforehand, I want to get your thoughts on, your forecast for M&A activity in the sector. And, one factor that I've been sort of curious about is our lack of travel, due to obvious restrictions impacting the frequency of M&A because we can't get out and look at projects. We can't do the diligence required. And when these restrictions are lifted, do you think there's some pent-up demand? And do you expect that to pick up in 2021? And for that,
yeah, absolutely. Once the restrictions are lifted, and I've had this from many CEOs of companies, large and small, who aren't telling me specifically what they're about to buy, but they're telling me there's a lot of companies, projects we really want to take a deep dive on.
Interesting.
But until we can, we're just not doing anything. So I think there's definitely a lot of pent-up demand. And you look at a country like Australia, for example, which is closed, and it's closed even between the states. Now, some companies are comfortable hiring a local consultant to go and look at things. You've seen that, with a couple of recent, you've seen that with some recent royalty acquisitions, for example. So you have a local person that you trust, but he's still not an employee. He's still not directly responsible for you. Canada is also difficult, and Argentina is impossible, et cetera, et cetera.
Right.
I think once those, and we're not close to that, I don't think. I think we've got several months of that before people can travel freely to countries like Peru and Argentina and Australia. But at that point, I think I'm not sure that there's very many deals where they're about to sign on a dotted line once they've looked at the project. But I think there's a lot of deals in the works for being able to go on site is going to move along. So by the end of the year, we should be seeing quite a pickup.
Now, can I convince you to speculate a little bit, Adrian, on any projects, companies that you think are ripe for takeover?
Yeah, I'm going to skip that question, and I'll tell you why. I very, very, very rarely buy a stock or company simply because I think it's going to be taken over. I will look at companies that have, that aren't about to blow up because of a management or anything, but have good quality projects that don't have, big red, don't have anything like environmental or social license against them. And if you buy good quality projects which are undervalued, then clearly they're more likely to be taken over.
Right.
So that's the way I approach it, to be honest. I don't really look at it the other way around. I mean, I think there's several that sort of should be taken over, if you know what I mean.
Yeah. As a general rule of thumb, are you leaning towards scale in that conversation? Which projects are more likely to be appealing to a major?
I think initially we're going to see more of the large scale. We're going to see that the seniors are going to try and do mergers of equals, and that means larger companies, obviously, by its nature.
Right.
Or they're going to acquire specific projects. Yeah, definitely. But we're looking at larger projects, and we're looking at projects that are already in production from companies who perhaps want to get out of a particular geographic location, or want to rationalize their own portfolio or something like that.
Okay.
I think that's where we're going to start to see it, definitely. Then we're going to slowly move down to more deals like the Equinox Premier. Now, let's face it, Equinox is a pretty unique company when you think of who founded it, and the goal and vision that Ross Beaty has, and his demonstrated ability to execute.
Yeah.
But I think as time goes on, we'll see more companies of that size start to look for acquisitions. And of course, when they make acquisitions, by its nature, they will tend to be slightly smaller than what VRIC's looking at, or what Agnico tends to do. I mean, that deal with TMAC was a sort of a perfect Agnico deal, a tuck-in in a place they know, where they can execute and maybe a lot of other people can't, so they don't have to pay a huge premium to get it. Yeah, but definitely we're going to see more of it.
Okay. Now for 2021, do you think, who's going to shine this year? Typically when the sector begins to heat up, we see a lot of activity in the royalty space. It's a great way to enter the sector, especially if you have limited experience, decreased downside risk. You still get some of the upside. Start with the majors maybe. And then eventually, as the market matures and your experience increases, look at the exploration companies. What do you think is going to stand out in 2021?
Yeah, I think two things are. First of all, despite the fact that this bull market, gold really bottomed, beginning of 2016 and to 2015. So it's not as, it was slow for a while, of course. But to me, the seniors are remarkably undervalued right now. So I think when gold recovers from this little blip and starts moving back up, in the first few months of this year, we see gold at 1950, 2000. Most of the senior producers and senior royalties, which have really lagged, they've lagged considerably. I think they're going to take off.
Now, why do you think that is? There's been a bit of a disconnect between, the commodity price and the miners.
No, absolutely. And it shows up more in the big cap stocks. I think that's because, more generalists are obviously buyers of things like Franco-Nevada and Wheaton and Barrick and so on. And, gold was so flat to down since the peak in July. I think over the last 6 months, it's just kind of worn away at some of these people's, patience. And they are more likely to sell quickly. The generalist is more likely to sell quickly. The fund manager, who perhaps has a, big cap global fund and added 2 gold names, well, when they don't perform, he's just going to get rid of them. His Tesla's doing okay, and the things he really knows and he really likes, they're doing wonderfully.
Yeah.
What am I holding these stocks that I don't really understand anyway? Someone persuaded me to buy them, so they sell them. But when the gold sector, when gold starts moving back up again, I think generalists will come back, and they will go to Barrick and Newmont and Franco and so on first. So I think that's definitely one sector that we're going to see move, and I think that's going to move first in the next several months. At the other end of the spectrum, I think you're going to get very, very selected exploration stocks that either have, a discovery or have very, very good, promotion behind them. And promotion doesn't have to be bad. I'm just saying they have a buzz. I think we're not necessarily, I don't expect to see the whole exploration sector move strongly anytime soon, frankly.
Yeah.
And I think a lot of investors are going to look at, stock A, stock B, and they might say, well, it's got good management, it's got a decent balance sheet. Yeah, it's okay, but nothing's happened for 6 months or 6 years. Why am I holding this when the market's moving? So I think you're going to get people moving in the juniors. They're going to move very much to things that are, happening, as it were, where something's happening.
Yeah.
But those are the two areas I think we're going to see big movement.
Yeah. Okay. That's interesting. Now, to play devil's advocate, what could prove that? So I agree, the gold sentiment and the miners. What could prove us wrong, though, Adrian? If we look at, there's going to be record money printing again this year. And yes, that debases the currency. It's a strong case for gold. It's probably also going to push the broad market to fresh highs again, which captures people's attention. There's all sorts of alternative investments these days as well. Like you can hedge your bets against USD by investing in Bitcoin or cryptocurrencies. Is there anything on your radar that could change your bullish narrative on gold right now?
Yeah, I think if we look ahead, say for the next year, I think certainly the vaccine rolling out in most major countries, perhaps more rapidly than we're thinking, but more importantly, what that would lead to. If that leads to economic restrictions being lifted sooner and more completely, that's important too, more completely than we think. If a restaurant in Puerto Rico is now allowed 40% capacity instead of 30%, that doesn't move the needle very much.
Right.
Except for that. So I think if the economy comes back globally much more rapidly than we think it's going to, and consumers react by, getting on planes and doing things and economic activity, along with that, the dollar rallies and interest rates pick up. Now, I don't think the last two are going to happen. So if you have a very strong economic recovery driven by strong consumer demand, people get back on planes much sooner than we thought they would, and the planes are all full, restaurants are all packed, etc. Unless the dollar rallies and interest rates pick up, I think that's going to be very, very bullish for gold.
Okay.
Very bullish, because you'll start to see consumer inflation numbers that have been missing. But to answer your question, I think a strong economy, interest rates beginning to move up, and a stronger dollar would all derail gold.
Okay, so yes, negative correlation to gold, but then what's the play there? You could say in that case, then let's look at base metals. Let's look at copper, maybe silver for its industrial uses. Where do you go in that scenario?
Sure. The base metals are not going to do well, or then a strong dollar and rising interest rates are not a positive for base metals, right? So they will do well in a scenario of a strong economy.
Yeah, right.
But if you see a rising interest rate, that's not going to be good for base metals either. I think a lot of the base metals, frankly, since you touch on that, have maybe moved a little too far, too fast.
Interesting.
I'm a big bull on, as we've talked before, on things like copper and nickel. But I think now the market is perhaps looking just a little bit too far, into the future.
Okay.
But anyway, yeah. So I think the base metals will do well if you have a strong economy, particularly strong Chinese economy, so long as interest rates don't move up too much. The base metals can tolerate higher interest rates than, say, the gold market can. Because once you flip from negative real rates to positive real rates, that's a big negative for gold.
Yeah. Do you see that? How realistic, in your honest opinion, is that likely to happen?
I don't think it's likely in the year ahead. Frankly, with all the money printing, I mean, if you look at not just the Fed, but you look at the Fed as well as, well, look at what Canada's done. Their stimulus, I think, is per capita one of the largest in the world. You look at what Britain's doing, the Bank of England's talking about, they're studying negative rates. And, the Chancellor, Sunak, who says he has a picture of Gladstone on his wall because Gladstone was such a fiscal conservative, but he's handing out money like he's a drunken sailor. Mm-hmm. You've got the ECB, where they're not even talking about cutting back. And Powell, Jerome Powell, the head of the Fed, in his big press conference last month, I mean, he was as dovish as he ever has been. And he said that interest rates are going to remain low for the foreseeable future. And I don't see why we shouldn't take him at his word.
Right. Okay.
I mean, I think the more difficult decision will be when the Fed says we're going to start raising rates and shrinking the balance sheet. Then the question will be, do we believe them? But when they say we're going to continue printing money and we're going to keep rates low, I don't think there's any reason not to believe them.
Okay. Yeah, I'm with you. Now we've spent a lot of time on gold. I mean, we touched on copper and like what, seven year highs at the moment. But Adrian, if you had to pick one commodity from three, being copper, silver, and uranium, right, top performer in 2021, which one do you go with?
I think gold, as I've said before, this is not new. Gold has the best risk reward at the moment.
Sure.
But if we get a strong gold market, particularly one that's accompanied by economic growth and the signs of inflation, then silver is going to do much better. Silver tends to act as a monetary metal. If you look back over the last 20 years, it tends to move much more with money supply and the credit cycle than it does with the economy. But nonetheless, some of the fundamentals about silver are really quite interesting. I mean, you look at the silver supply that has been shrinking for the last 10 years, and it was down last year on the year before, and 2019 was down on 2018. That's pretty significant when you consider that you didn't have the same scenario, in gold. In a strong market, I think silver will outperform.
Okay. And are you watching the uranium market at all? Any thoughts?
I know people are going to hate me for saying this. In the near term, and by near term, I mean the next year or two, there is sufficient supply of uranium in the wings. So that if we see the uranium market go up 20, 30, 40% and hold those levels, at some point, Kazakhstan can step up their production and exports, and Cameco can resume production at MacArthur and Cigar Lake. So, it's an artificial shortage that we've got in those metals in the short term.
Right.
Because if you look at copper, copper could double from here. And it would be very, very difficult to increase the copper supply meaningfully in anything like the next couple of years. You just plain couldn't do it, physically couldn't do it. That's not true of uranium.
Okay. I'm going to pivot a little bit just to some basic investment advice, Adrian. If we are, we've made some smart decisions in the market and achieved some capital gains, I find that the harder part of the trade is selling. We spend all of our time talking about what to buy, when to buy, how to buy. Rarely ever do we talk about how to sell. And I lose more sleep over that than I do over buying. So any life experiences that you want to share with our audience when it comes to you're staring a gain in the face and debating your next decision?
Well, first of all, if you have a plan, I think it's important that you stick with it unless something is dramatically different. In other words, you've heard of people who say, Doug Casey, I think was the first one that talked about the Casey free ride. When the stock doubles, sell half of it and it's a free ride. I don't follow that philosophy, by the way. Okay. But if that's your philosophy, that at least I think it's important to stick with it. Some people use trailing stops. Now, I don't like stops in gold stocks or any commodity stocks, frankly, because they are just so volatile. And I mentioned Franco-Nevada before. I mean, I could pull up the graph, but Franco's the biggest, right? And the best and the most conservative. But Franco's had drawdowns to 30% and more over the last 10 years. Now, where do you put your stop? That's the question. In what I call a normal market, you can say, let's put a 5 or 10% stop. Keep my losses reasonable. Yep. But if you put a 10% stop on gold, you'd be out of every single one of them, almost every week.
Yeah.
And if you make it, someone I know said, well, I use a 50, he only invests in exploration stocks. Said, I always use a 50% stop. Well, his rationale was that if I lose 50%, I know I can get a double at some point. But if I lose 60 or 70 or 80%, getting 200 or 300% becomes more difficult. So 50% is his. But, do you really want to say I'm going to sell these stocks for 50% loss? So I don't like stops. I don't like stops, particularly as stop losses in the gold market. Now, I'll use stops as protect profits, which is something different from stopping losses.
Yeah.
And I do that when the stock clearly has momentum. It's really moving. Maybe the market's strong, but this particular stock is really on a roll and the volumes are good and everything else, but I just think it's grossly overvalued. We'll put a stop in to protect the profits. So the way I do it really is I really look at fundamentals, which I know is much more, subjective. It's not a rule. It's not objective. But I look much more at fundamentals. And I have a couple of principles, if I may. One is I divide my portfolio. It's on a continuum. It's not a black or white, but it's on a continuum between my core holdings at one end and my speculative trades on the other end. And with the core holdings, things like Franco and Agnico, I'm not going to be concerned if they drop 10 or 15 or 20%, so long as I'm still bullish on the gold. At the other end, I will be very, very quick to take profits, and I will use stops. And so that's one thing. The second, so at least you're dealing with part of your portfolio, but remaining exposed. The second thing, frankly, is if a company doesn't do what it promises to do, and doesn't have a strong reason for it. Now, of course, in the exploration business, things are always going wrong. I mean, you can't help it. In fact, was it Robert Friedland who first said Murphy works overtime in the gold business? I mean, anything that can go wrong will go wrong. And that's true of the biggest producers and the smallest exploration companies. But you have to be disciplined. If you bought a stock because they're about to do a drill hole program on this very attractive project where they had one nice drill hole last summer and now they're about to put 10 drill holes in, and you're expecting whatever. You're expecting this to prove up the core, and you're also expecting at least one of their step outs to be attractive, and it isn't, then you have to sell, to me. If it goes wrong, even if it's not the company's fault, if it goes wrong, I'm out. If a company says we've raised X amount of money and we don't need any more money for the next 18 months, and then 3 months later they raise money and they say, oh, well, this investment banker offered it to us, so hey, we took it. I'm out, so I'm very disciplined on that.
Okay. Yeah, no, I appreciate that. And I see your hard, fast rules, and thanks for sharing. Okay, Adrian, look, it's been awesome catching up with you and getting your perspective on a couple new things and some forecasts for 2021. Thanks for coming back.
Well, thank you so much for having me. Thank you.
As this transition happens and the market has yet to recognize this, we're not getting the valuation that a successful copper explorer co is getting. we're trading at 10 or 0.1 or 0.2 times our NAV relative to a lot of other copper exploration companies, which are much higher than that.
All right, ladies and gentlemen, welcome to the 2021 Vancouver Resource Investment Conference. My name is Jamie Keach. I'm from Resource Insider, and I'm here today to interview Chris Bunsick, the President, CEO, and Director of Ascendant Resources, a company exploring in Portugal. So we got a lot to talk about. We're going to get into this company. We're going to get into the details. We're going to get into Chris, and we're going to learn why investors should care about Ascendant. So, Chris, thank you very much for taking some time to sit down today.
Thanks, Jeremy.
So, for people who have never heard of Ascendant Resources, who are you? What do you guys do?
Sure. So Ascendant Resources, we're a TSX-listed exploration company based here in Toronto and in Portugal. Our ticker is ASND. And we are focused on exploring in the Iberian Pyrite Belt. We have a great project called Lagoa Salgada, which we acquired a piece of and earning into an option for 80% of the project. It's right on the Iberian Pyrite Belt next to large world-class mines like Neves Corvo, Aljustrel, Aguas Tenidas. This is the world's largest belt for VMS type deposits. The next doesn't even compare. It's about a third of the size. And so we are right in a great neighborhood. We already have a resource that we've established over the past 2 years. We've got a 20 million ton resource. We put a PEA out on a portion of that last year with great success. We're demonstrated at least a standalone small operation is warranted from an economic perspective. But we are growing this resource and think that down the line we've got something that could be 3 or 4 times the size that it is right now. And so we're very excited to be working in Portugal. We have a small team of very experienced Iberian Pyrite geologists there, and exactly that. We're keen to keep going. We have had some very successful drill results out just this past Wednesday, demonstrating some great grades. We're focused on copper, and so it's a polymetallic belt. However, we are seeing some great copper in the southern part of the ore body, and so we're following up on that, trying to grow that substantially. And so far, our thesis is panning out.
Okay, so let's dig in a little bit to something you mentioned. So you're in the Iberian Pyrite Belt. You said there were, several operations around you guys in that jurisdiction. So this isn't a part of the world that I'm particularly familiar with as an exploration destination. I think maybe some of our viewers are in the same boat. Can you give us a little bit more background on the mining history there? And you mentioned some of the mines, but who are the companies that are actually working there?
Sure. So Lundin owns Neves Corvo, and that's about 80 kilometers away from our location. Aljustrel is about 40 kilometers away from us, and that's owned by a private company. But in a past life, it was also owned by Lundin. Aguas Tenidas is in Spain, and they've got 3 mines. They're owned by Trafigura and the UAE Sovereign Wealth Fund Mubadala. But going back, a couple of centuries, a couple of millennia, the original Rio Tinto mine is located on the belt, and so there's been mining on this belt since Roman times. The original Rio Tinto mine gave name to the massive mining company now. And so, we've got Las Cruces, which is the first quantum mine, which is on the belt. So there are a lot of large players, Grupo Mexico, for example. Several ports are shipping out of there, both in Spain and Portugal, both concentrate and metal that's been produced that's headed offshore to other destinations. From the Fraser Institute's perspective, it ranks very highly. It's 5th on their list of countries to want to do business. So there's a rich history of mining in Portugal on the Iberian Pyrite Belt, but it's also a great place to be doing business currently, especially as other jurisdictions are running into problems. I think Europe is a place that's actually garnering a lot of positive attention.
Yeah, well, let's talk about that because something I'm always cognizant of is, mining companies in the EU, potential permitting challenges. Is this a problem that you guys are going to have in terms of getting, I guess, obviously mining permits, but also sort of maybe the lesser commonly known permits like the water licenses and discharge permits and, the various processing related permits you might need depending on which method you intend on using.
Right.
Has this been something that's been a roadblock for you guys, or has it gone rather smoothly?
Not at all. In fact, we when we acquired the project, it already had an exploration license. We have since transitioned that to an exploitation license. So the next steps in the development are producing an environmental impact assessment, which is going to start this year, and that should take about 12 to 18 months, doing environmental baseline studies and that sort of thing. And that transitions us from that exploitation license to a mining license. But there are very clear steps that are required from get us from A to B. Now, I should tell you that in the project, one of the partners is the EDM, which is the Portuguese Mining Authority, and they have a 10% interest in the project. Now, working with them to advance the project would be very helpful in the sense that they can help us navigate some of these roadblocks if they arise. However, I got to say, everything's gone very smoothly, and it sounds like it should continue to do so. I know that the mayor is very much on board with additional mining projects in location. He is looking for job creation. I know that the country is looking for additional mining projects to get up and running, because there are several, but they don't have nearly what they should in terms of the country's capacity, the infrastructure's capacity. Yeah. There's a lot of positive tailwinds in country to advance projects like ours, and we have the largest development project in country next to the operating mines that are already there.
And let's talk for a second about how you ended up getting involved with Ascendant. Were you one of the founders of the company? Did you come in later to help run the operation? How did this all come into being?
Yeah, so Ascendant and its prior companies, prior names have been around for about 10 years now. I joined the company about 7 years as we were looking for new assets to put into what became Ascendant, and it was effectively a shell company. And what we found was, through the process with Nearstar, they were divesting of 10 mines. We took a look at 3 of the mines that were still in operation, at that time, and at the end of 2016, closed on the acquisition of El Machito. And so El Machito is a producing lead, zinc, silver mine in Honduras. We acquired it for a very small amount of money, with an offtake for that Nearstar held onto. And we turned that mine around. So we took it from 1,200 tons a day up to 2,400 tons a day of production, run a mine. We got the head grade up from 5% zinc equivalent up to nearly 8% zinc equivalent when we sold the mine. In fact, at the end of 2019, that was our last full quarter of production. And so that was done by a number of operational methods, mine planning, cutting down on dilution, training. We got our costs down from $1.80 a pound to $1.05 a pound. Now, unfortunately, El Machito will remain a higher cost mine. We did, once we kind of plucked all that low hanging fruit, we did look at how to, what the next steps were. And so we identified some larger projects that required capital. It was the wrong market to be looking for $35 million for that. We did go down a number of different paths. And ultimately, just this past April, we closed on a sale of the mine after not having been able to find that capital. Now, in the wings, we had this project at Lagos La Gata. And so we did not want to dilute our share base to maintain El Machito, a money-losing operation, at the expense of our per share ownership of Lagos La Gata, which is a fantastic project. And so we shifted gears from producer to exploration company with Lagos La Gata because of what we saw on the ground. It had always been in weak hands. They hadn't spent a lot of money on it because it doesn't outcrop. It's under about 100 meters of tertiary cover, and so our geologists saw this. We looked at it pretty closely and decided, this is a diamond in the rough, and we need to have this and develop it. And so far, the last 2 years, we've taken it from an 8 million ton deposit up to 23 million tons. We've increased that grade by about 20% as well.
And what grades are you consistently getting these days?
So the exploration that we're doing right now is in the south zone of this deposit, and so some of the results that we put out last Wednesday included 25 meters of 2.25% copper equivalent, and it's a polymetallic deposit. We had some bonanza grade copper hits, 1 meter at 14% copper equivalent, 1.5 meters at 10% copper equivalent. So some great demonstrations there, and we are also having results, great across mineable widths of 2+% copper, 3+% copper equivalent, that we're going to follow up on. But these are on 50-meter step out holes. And so as we expand on this resource with 50-meter step outs, when we go to do our resource update, our new 43-101 resource estimate, we're very encouraged by the size of the step outs, the intercepts that we're seeing, and the grade that we're seeing, so that I think we'll have some positive news come out when we go to do that estimate.
Sorry, do you have a timeline or an estimate of when that estimate will be coming out?
I think it's a good policy to, as long as you're drilling and finding more, high grade mineralization, just keep drilling. Yeah. So I think we're following up on this, most recent set of holes with a continuation of this exploration program in the south. We've finished 3 holes. We're on to the next 4 to round out 7. Again, these are large step outs, and we're really growing the size of this ore body. I think the south really has the potential to be much larger than the north that we've outlined so far in our resource.
All right. So let's talk for a second about what kind of financial position you guys are in right now. You have a 20-cent share price, but just under a $20 million market cap. Do you have cash? What position are you in right now?
Yeah, we've got cash. We've got very favorable terms with our drilling partner. We've got enough cash to keep us going for the next 12 months if we choose to. I think as an exploration company, we always want to make sure we're not going so fast that we're burning through everything, but at the same time advancing the project. And I'm excited about this. I think this is a great project. So we're making sure that we're being good stewards of our capital, investing it wisely, and ultimately we'll be raising more money down the road to continue the development, but we're not under any pressure.
Okay. So for current investors in Ascendant, for people that are watching this, why is now a good time to invest in Ascendant, or is it a good time to invest in Ascendant? What do you guys have coming up over the next year that would get shareholders excited?
Firstly, the expansion of the South Zone. So the continuation of the exploration program there is, under my expectations, is going to continue to be very strong. And so we've demonstrated that it's there. We're expanding on it. We're on trend. It's open in all directions. It's open at depth, and we're still very shallow. And we're having great success through the drill bit. That's one angle. Now, the second angle is a little more structural, in the sense that we just came from being a producing company to transitioning into an exploration company. We were zinc, and we're now more focused on copper. And so I would say that as this transition happens and the market has yet to recognize this, we're not getting the valuation that a successful copper explorer co is getting. We're trading at 10 or 0.1 or 0.2 times our NAV relative to a lot of other copper exploration companies, which are much higher than that. And so I think as that transition happens and we are able to get the story out there more, there will be this natural revaluation that happens, regardless of the continued drill results, which again, I expect to be good. The drills aren't turning right now, but we're very optimistic about that.
So how are you guys going about achieving this re-rating, I guess? Is it a matter primarily of just getting the story out there, having conversations with people like me and doing things like this and telling this story better after the sort of the change of business? Or
absolutely. No, that's exactly it. Yeah, that's it. We're out there. We're being very vocal with the investment community and trying to get the word out. Now, I think that commodity prices have really turned. I think that juniors are starting to get recognition, and it's investors are coming down cap towards companies of our size and our activities, and so I think that we should be able to ride that wave with everyone else, and it's very well justified.
So you're based in Toronto. Do I have that right?
That's right. Yeah.
So, what kind of team have you managed to build in Portugal? It's not a part of the world, again, from a mining perspective, that I know a ton about. Are there good, high quality Portuguese and Spanish geologists in the region that you're leveraging, or are you bringing people in from other parts of Europe? How does that work?
Absolutely. Our team in Portugal are entirely Portuguese, and there are mining colleges there. There's a lot of expertise locally from the mining operations, both in Portugal and in Spain. There are European labs that we're dealing with that are doing, geological test work for us, metallurgical testing, as well as our sampling, of course. The expertise is there, and it's not hard to find. I mean, I think that Portugal, from a legacy perspective, was one of the less wealthy EU countries, and so when I'm budgeting, it's not overly onerous, I'll just say. And so, again, it's a great place to do business. There's definitely talents, and they're doing a great job. Now, we have our JV company, which employs, depending on where we are in our exploration cycle, anywhere between 1 and 2 people up to 5 or 6 people, but it's not a challenge.
And has the challenges associated with COVID-19, particularly in Europe, has that slowed down the exploration process? Has this been something you guys have been able to manage effectively?
No, it's definitely manageable. Everything is happening outside, and everyone's following all the proper COVID procedures, both within our operation and at the drill site, so at our core shack. And so we've been able to manage it. Portugal has, earlier in the COVID process was a little less impacted as other countries had been. Certainly, we're seeing, what's going on with the UK, et cetera. I would say that Lisbon experienced the most problems with respect to COVID, but we are about an hour and a half south of Lisbon, near a town called Grândola, which is not terribly large, and it's been relatively uneventful for us, despite all the precautions. Yeah.
Okay, so there's a lot of investors that are going to be watching this video. There's a lot of investors watching this conference in general. And there will be other copper companies presenting. I guess, my question for you is, if someone's looking for copper exposure, why Ascendant? Why Ascendant over the sort of plethora of other choices around the world?
Right. Well, I think you need to look at a few things. Firstly, we've got a management team that has operated, finance, built, run the gamut through the whole mining cycle. We've got a very strong team. So if you're looking for, you've got to look at it top down. Now, with respect to our project, again, the location is incredible. We are an hour and a half south of Lisbon. We're right next to high voltage power lines. There's great infrastructure in the country. We're a truck drive away from the port. It's not a challenge in that regard. Being in Portugal is great as well. And then with respect to the actual resource, this has the potential to be another Neves-Corvo. Neves-Corvo, 80, 90 million tons of resource, with enough exploration I believe we can get there. And so, it's early days for us. We've had great success so far, as you can see in our meters drilled, to resource ratio. We're at double or triple what they're seeing at Neves-Corvo and Aguastinitas, because those are more mature operations. We are, just at the beginning. We're shallow. It hasn't been drilled to depth, and typically you see these VMS deposits stacked on top of one another. We're only in the first. So it's a very exciting project, and it's early days. We're way undervalued for the reasons I mentioned earlier, and so now is the right time for Ascendant. Maybe more so than some of the other copper companies that already have a lot of the success priced in.
So for people who don't know anything about copper, who know they want exposure to the metal, but don't really understand the exploration metrics, I suppose, what would be considered a success for your exploration program over the coming year? How many tons are you looking to have there? What kind of grades are you looking to have? I mean, understanding that this is speculative, these are goals, these are not predictions.
Right. Well, let's look at so when we think about this, we're thinking about an underground deposit. So we're going to use a cutoff that's somewhere between 0.6 and 0.8% copper, or copper equivalent. And so anything above that is, subject to all the engineering studies and everything that happens, likely to be economic. And so, big caveat there. But so any grade that we get that's more than 0.8% is likely going to make money. I mean, that's yet to be proven through a full feasibility. But when we're getting grades like 2.5% and 3%, those are great copper grades. You look at some of the large open pit mines, Escondida at 0.4%, like some of these very large open pit copper mines in the world, they do it on a tonnage basis. Here we're doing it on a grade basis. And again, anything over 0.8 makes money. Like I said, I think that if we're pulling out 2 and 3% copper, people should be very excited about that. That's very comparable to what the other mines in the belt are pulling out, if not better. Aguastinitas is pulling about 4% copper, and they've got a copper stringer network underground that we believe our resource looks like as well. In their Magdalena mine, they similarly have a small VMS type deposit sitting over top of a copper stockwork. And we've got our North Zone, which is a VMS deposit. We believe all three of these zones connect and through a copper stockwork system. And so based on the grades that we're seeing so far, we think we can dramatically increase the size of this.
And these zones are the North Zone, the South Zone, and what's the third one?
We're calling it a Central Zone, but ultimately I think it's going to be shown that they connect.
And so that's the grade. What about scale? What size does this need to be considered economic, to be worth building? I mean, is it 20 million tons? Is it 80 million tons? Where do we need to get it to?
Yeah, I think you want to have an operation that's producing 4 to 6,000 tons per day. So you're looking at about 1.4 to 2 million tons per year. So say it's 2 million tons per year. You want a 10-year mine life. You're looking at 20 million tons plus not as your resource, but as your mine life at 2 million tons a year. And that's a really good size mine. That's a very good size mine. And so if you think you've got 50, 60, 70 million tons of total resource, you're well on your way. You're set up because you'll just drill that off and bring up the category, bring it into your reserves, and you'll be able to feed that for much more than 10 years.
All right. Well, Chris, thank you very much for taking the time today. Is there anything that I didn't ask that viewers should hear about or should know about Ascendant?
Yeah, well, I guess it's a polymetallic deposit, and I just want to highlight the fact that we're pulling these great copper grades most recently, but in our PEA, which we put out in January, it was on the North Zone. Again, that project itself was a 2,700 ton a day operation for a 9-year mine life, an NPV of 106 million US at a cost of 66 cents per pound zinc. So it's a high margin project. And if zinc's at $1.25 right now, you're looking at a 50% gross margin, which is great. In that model, 44% of our revenues come from precious metals. So we've got very good gold and very good silver, as well as lead, zinc, copper, and tin, which all pay. And so we produce 6 metals into concentrate that would come out of the North Zone. Again, that's our kind of starter project, but we will likely see a much bigger resource in the South that's got a bigger focus on copper. We'll be looking at, producing more concentrates, likely a copper concentrate as well, as time progresses. And so I would just highlight, we've already got a very solid project on our hands from a mine that we could build. We would have to take that through to feasibility. We've got this great precious metals component, but it's only getting better from here.
All right. Well, Chris, thank you very much for taking the time. And for everyone at home, this is the CEO of Ascendant Resources, and you can find out more at ascendantresources.com. And I am Jamie Keach from Resource Insider, and you can learn more about what we do at resource-insider.com. Chris, thank you very much for taking the time today.
All right. Thanks a lot, Jamie. Appreciate it.
We're now on to the most exciting target that I saw when I joined the company.
Hi, I'm Veronica Van Wallen, and joining us today is David Suda. David is the president and CEO at Terra Resources. Terra is listed on the Toronto Stock Exchange Venture under the ticker symbol YGT and also on the OTC. David, thanks so much for joining us. How are you?
Doing very well, thanks. Thanks for having me.
Absolutely, our pleasure. I'm excited for us to chat with you today. There's a lot to unpack. I see a lot of opportunity here for any new investors looking at Gold Terra or any gold exploration companies. Quick summary from how I see your story. You're in the Northwest Territories. You're a gold exploration company. You joined the company, saw a lot of opportunity for this story. And I know you've added some very impressive names to the board. Let's get into all of that today. Before we do, though, can you please tell us the quick overview of who Gold Terra is?
Love that you called it unpack. There is a lot to unpack. There's a lot of value to unpack in the story. That's how I saw it when I joined. And like it often is with anything that's early stage or happening in a tough part of a cycle, things take a little longer than you hope, or than I'm an optimist. So I joined the company optimistically, thinking that we were going to see a bull market in gold sooner than we have. But finally, it's here. And, we find ourselves in a very exciting position to hold 800 square kilometers of highly prospective gold belt in a great jurisdiction, Northwest Territories, as you mentioned. And we've got roughly 70 kilometers of strike. And we're on the doorstep of about 14 million ounces of high grade, historic past production right next to town, all the infrastructure that you could imagine a company like us wanting. And, we've got a tremendous amount of data and targets to work with, almost too many. And that was one of the struggles and challenges, was to really, make sure that investors understand what it is that we're trying to unpack first. Mm-hmm. And, it took us some time to do that as well. I think the most important thing investors need to know is that we're now onto the most exciting target that I saw when I joined the company, and we're just about to start drilling on it here in the next few days.
That's a great segue. I want to talk about 2021, your plans, because I think a lot of people see this story as being very undervalued. We'll get to that a little bit later. First, though, I want to focus on 2020 and start with a little bit of a recap. I know you raised $13 million last year. You announced a pretty significant drill program in November of 12,000 meters. Let's reflect a bit on 2020. What were some key highlights?
2020 was an interesting year for us because we were very excited to get to where we are now. We needed to make an agreement with Newmont in order to get onto an area of our property that we'll talk about later. But, we had other fish to fry. We still had, we were just on the back of putting out a resource, our maiden resource, 43-101 inferred gold, 735,000 ounces. We told the market we wanted to build on that, and in order to do so, we went after 10,000 meters of drilling at our SAM.NYSE deposit in the winter, early spring, and we managed to wrap that up even through COVID. One of the great things about being where we are, we didn't have to run camps and have people sleeping and eating in close quarters. So we learned something about our project. We'd said it was so great to be close to infrastructure and to a town. And, we never thought, I don't think anybody thought that we would have tested that in the way that we did. Subsequently, we were, as you said, able to raise some more money. And we attacked another target, high-grade target called Crestorum. This is, again, something that was part of our resource, and we wanted to grow. And we told the market we would drill this very aggressively. We were going to drill it deep. We were going to drill it in areas that had not been drilled before to see just how big it could be. And we just put out the last results from that program today.
Okay. Oh, exciting. So let's get into 2021 and kind of your plans for the year ahead, with the focus of the $13 million as well. I think that's a nice segue. So how does the results and the work that was done in 2020, what's going to happen in 2021 for investors?
Well, as I said, we were able to make an agreement with Newmont, which took us quite a bit of time for a myriad of reasons. But when we finally did, we knew that we wanted to drill, as much as we could. on the back of drilling at Sam Otto and Crestorum. And we actually have already drilled 2 holes there. We drilled 2 holes at the Campbell Shear on adjacent to the Newmont ground prior to Christmas. And then we gave our teams a break, and we're about to resume there to drill 10,000 meters, 10 to 12,000 meters through the first quarter here, and potentially into the second. So we're going to be delivering what we hope will be excellent results from a completely underexplored target. One that happens to be, we believe, the extension of a system which produced, plus 5 million ounces at least of high-grade gold, again, right next to town. And, for us, this is a pivotal moment. It's very exciting to be at a point where you're seeing a bull market and a burgeoning bull market in gold. I know we're still sort of in the stutter steps of the start of it. It feels like, but we're very confident that with that backdrop, we can continue to deliver investors news flow on this tremendous target, the Campbell Shear.
Right. Okay. One thing that stood out for me when I took a look at your company was Gerald Panneton, who I know you, as part of you joining the company, you brought him in onto the board. Tell any investors that are not familiar with Gerald his significance and the kind of pedigree that he brings to the story here.
Yeah, I can't understate the importance of some of the events that have happened in the last couple of years in setting up this drill program that we're about to start. And you've aptly pointed out that Gerald's involvement, was a coup for us. I think it speaks to the quality of the project. Gerald has a tremendous track record. He's spent 12 years working at Barrick, where he put 2 mines into production. He founded Detour Gold, which recently sold for close to $5 billion. And so having somebody of his caliber as a geologist, as a gold finder, as a mine builder, really as a visionary in the industry, obviously speaks to the potential, I think. And I think if you couple the arrival of Gerald and his vision with the fact that when he did show up at the company, he said, I want desperately to explore this area, the Campbell Shear, that was host to all the high-grade gold at the Con Mine. Those 2 things have put us in an incredible moment here.
So he seems really excited about the project.
I mean, that's an understatement. To say that he just joined the board is also, it doesn't give investors an appreciation for the level of commitment and passion that he has for the project. There are times when I'm looking at my phone on a weekend at sometime in the evening, wondering, does this guy ever stop working? And I appreciate it so much. So he's more than a board member. He's involved with every little detail. He lends a tremendous amount of support to Joe Campbell, who is the founder of the company and remains our COO. So, we just have this mix and this energy. And it's really why we changed the name of the company from Terra X, because we knew that, there's a gold market coming. We weren't looking for X, we're looking for gold. We believe we have gold on the property, and we changed the name but kept the word Terra because we wanted to show continuity and also project energy. And that's what we are. We're just a very energetic group.
Love it. And I think that's a good segue to my next question, right? With, I was looking at kind of your cap table, and one thing that I noticed is all of your warrants and options, the lowest price that they're at is 30-40 cents, which is close to where Gold Terra is trading right now. So from an investor lens, that's very encouraging, because anyone that's new to the story is coming in at price points where management is very incentivized to perform. So why don't you talk to us a little bit about that cap table and how the team is incentivized right now?
Look, it's very challenging for companies. In exploration, junior companies have been through the ringer over the last at least half decade, and to come out of the back of that with the ability to raise funds and not have a completely blown out cap structure is a real blessing. We are, custodians of shareholder value. We truly want to be aligned with shareholders. We're in this to be shareholders and to generate value. So we're very much aligned. My first batch of options when I joined the company, was priced significantly higher than we're trading today. And, we try not to issue warrants because we don't want to cap the stock price when we, finally do get momentum, which I feel is, we're on the cusp of here. So, look, for us, I said the other day to somebody who called to offer us a service, I view myself as as a jail guard and, at a penitentiary, and every dollar is a prisoner. And, I really think of what it would be like to be in a position to see, everybody do well. And that's really, all I want to say about the cap table. We're aligned. Nobody got free stock. Everybody's here to make this work and to unpack that value that you mentioned at the beginning.
Yeah. No, I'm glad you spoke to that, because that is really important for investors to make sure management is aligned with their efforts. Let's talk a little bit more about this agreement with Newmont. You mentioned it briefly earlier. What does this mean?
Well, I think, look, first of all, it's very significant to have a team that is able to negotiate amicably, constructively with a major gold company. Not every junior has that ability, and major gold companies don't, deal with every junior. So the sheer fact that we were able to make an agreement to explore what we think are, some of the most prolific areas on the property is a feather in our cap. It's kudos to Gerald, who was the primary driver behind that initiative. And also, I think what it says about our property is that, look, if we find more than 5 million ounces on those claims, then Newmont wants to have a back-in right. Well, what does that tell you? I mean, it would be a moot point. It wouldn't be in there if nobody thought we could find that many ounces. So, look, there's a lot of potential there. We have a very friendly agreement, which we believe could grow from what it is today. Right now, it's baby steps. We want to show them that we can do the work properly and that we can keep our word as far as our sort of technical plans are concerned. And we're very excited to be just starting down the path with them. Particularly with the backdrop of Agnico Eagle buying TMAC recently.
No. Really, really good points, right? And they're also very motivated to make this work and are excited about the project. I want us to talk about now kind of the most important question for any new investors looking at the story. Why should investors be putting their money into Gold Terra now? What is the option here for the potential?
Well, there's been a tremendous amount of work done, turning over the float. As I mentioned, some of these companies, including ours, have been through the ringer for a long time. There's a lot of shareholder fatigue throughout the sector. And, we've really put a lot of stock into good hands, new, energized, long-term, smart money. And I think that we're at a point now where we're cashed to do what we said we want to do, which is drill the Campbell Shear at a minimum with 10,000 meters. We've been adding or certainly drilling to add ounces to our existing resource at our other deposits. And we absolutely, think that with the backdrop that we have, having drill results on a highly prospective target, and being able to continue to deliver drill results, say into the end of the first half of the year, is a tremendous opportunity.
Yeah, to me, it seems like positioning.
It really is. It's, timing is everything in this business. And, I'd hope that we'd be in this position sooner. But, I think we've just really given the audience watching today the chance to join the party, at a time where I think it's a critical juncture. Our job is to lay out, to set the table. We can't tell people what to do as far as, their own investing goes. But we are certainly here to lay out what the opportunity is, to outline why we think we can succeed, and to then do our darndest to work our butts off to, realize our goals.
All right, David. Well, I really like how you sum that up for investors here. The potential to position themselves now, really bright future ahead, a lot of drilling on the horizon. We're at time here. Is there any final remarks that you want to leave investors with?
No, I just hope that we all get to see each other in person at a show, inside of the next 12 months. I feel like that time is coming, and we're all looking forward to unpacking some value for you guys.
I agree. I'm looking forward to that time. Okay, so again, a summary for everyone watching here. Gold Terra Resource. We had David Suda joining us, President and CEO. Gold Terra is listed on the Toronto Stock Exchange Venture as well as the OTC, and their ticker symbol on the venture is YGT. David, thank you so much again for joining us today.
Thank you very much for having us.
If you are just tuning in, my name is Jay Martin. I am an investor and the CEO of Cambridge House. Now, what we're doing today is diving deep into a handful of resource investment opportunities, talking to the company CEOs, and in addition, stress testing our investment ideas and strategies with some of the most prolific money managers that I know in the business. Now, the reason that I do this is because I'm an investor first, and I'm trying to grow my portfolio. In addition, I'm trying to identify blind spots I may have that would be compromising my decision making. I do this through conversation with industry personalities and company CEOs right here on the channel. Now, today we have a killer lineup of amazing content, and the whole agenda is right beneath this video in that YouTube description. Check it out, stick around. I'll be active in the live chat. Drop me a line, say hi. Please hit subscribe to stay tuned with what we're up to at Cambridge House, and enjoy.
What I love to do is introduce the right people to the right people, assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today.
Please give my panel a round of applause. Welcome.
Okay, what's up guys? Jay Martin here, CEO of Cambridge House, and we are searching for our next investment opportunity. I'm joined right now by Mike Maloney, the CEO and founder of goldsilver.com and the best-selling author of Guide to Investing in Gold and Silver. Mike, how are you?
I'm doing great. Thanks for having me here.
I'm glad to have you back on the show. We haven't seen each other in a few years. Yeah. I can't recall the last conference we had you speak at, but a benefit of doing this remote is that we can get in touch with people like you easier. So I'm excited to dig into a few topics with you today. And I want to start, Mike, by getting your thoughts on which macro themes you're going to be paying the most attention to in 2021.
Well, the macro theme, because of the lockdowns and the contraction in GDP around the world, the macro theme is just basically watching the economy and all of the major governments' response to this crisis. And their response, the central banks have shown that the only thing they know how to do is create currency. By the way, I'm trying to get as many people to refer to the proper definitions of currency and money as possible. Money, there's some attributes that currency and money have to have. And currency has to be a medium of exchange, a unit of account. It's got to be portable, durable, divisible, something called fungible, where all the units are interchangeable. If you loan me a $20 bill, I can pay you back a 10, a 5, and 5 ones, and you don't care. That's fungibility. Money has to be all of those things, plus a store of value. Currency does not have to be a store of value. Money has to be a store of value. Gold purchases relatively the same amount as it did in ancient Rome. I mean, it stores value over the centuries. It stores value. It bounces up and down in a range of purchasing power. Right now, its purchasing power is very, very low compared to all the stuff that we have in society. You know, a couple thousand years ago, people had a bed, a goat, a pair of shoes, one outfit of clothes, and that was like it. Today, everybody's got cell phones and TVs and cars and all this other stuff, but there's relatively the same amount of gold per person. And so gold should be purchasing many, many, many times more stuff. Why doesn't it? Because we diluted gold's purchasing power with all of the other liquid financial assets that we've created in this 2,000-year period. But really, there's about the same amount of gold per person on the planet. And so its purchasing power, when those other assets, things like bonds and stocks, when they become less trusted and people run back towards safe havens, the purchasing power increases many, many times. And I believe that is what is going to be happening over the next couple of years here.
Yeah.
And this year, you asked about what I'm watching out for this year. I'm watching out for the massive currency creation that they're going to do, the dilution of the currency supply. And I'm also trying, like I said, I'm trying to get people to call. There is no national currency that is money. Stop calling it money. It's not money. It doesn't store value. Its very design requires that it constantly loses value, because when they create currency and buy a bond with it, that's how the Federal Reserve or a central bank gets their currency into circulation. They whip up numbers out of thin air, just type them in, and then they buy something with those numbers. Those numbers are not money. Those numbers that have an official designation of a Canadian dollar or a euro or the US dollar or the Aussie dollar, those numbers are just currency. They do not store value. And the reason they don't store value is because typically the central bank will purchase a bond of that country. And the bond requires that principal plus interest be paid. So what is backing that currency is debt. And when you back the currency with debt, the country has to tax the population in the future to pay the principal plus the interest on the debt, except the currency to pay the interest doesn't exist yet. There is always more debt than there is currency. And so to pay that interest, you've got to create more currency. So they have to dilute the currency supply constantly over the years. It's impossible to not dilute the currency supply in a fiat currency system like this, a debt-based fiat currency system, without collapsing the whole thing. Right. So they have to steal purchasing power from people constantly through this dilution. Anyway, that's a tangent. I went off way too much, but I am looking for, I do think that this year there's going to be some tremendous market correction. I think that people are going to start coming to the conclusion that they have to sort of run for safety in this.
Interesting.
Now, a lot of people think that the markets are so manipulated now by the central banks and the governments that they can't crash anymore, that they're just going to go up. Well, why did they do such an enormous pullback in March? I believe that the world's central banks can manipulate the markets, but they can't overcome the free market in the short term. What they can do is create a tremendous amount of currency after a market crash, get the markets to go up. And when they do that, they steal wealth from the poor and the middle class, people that are holding on to currency, and they boost financial assets such as the stock market, making Bill Gates and Jeff Bezos centibillionaires. You know, so they're stealing from the rest of the population, and they're bestowing that stolen wealth upon the wealthiest people on the planet.
So, okay, there's a bunch of stuff in there I want to unpack, and I just want to begin by saying a lot of what you're talking about, you've covered in a series of videos called A History of Money. I think there's
The Hidden Secrets of Money.
The Hidden Secrets of Money. That's right. And these were put out like, what, 7 years ago, Mike?
It was over a 10-year process. The last one was just about two years ago, I think.
Okay. Okay.
And we're coming out with a couple of new episodes that are actually part of a different series, The Formula for Prosperity.
Okay. Hidden Secrets of Money. And I found these, I guess, 5-6 years ago. They're excellent. And, there was like a 6-part series when I found them. Everybody should check this out, and provides a lot of expansion on what you're talking about currency versus money. So
they were originally made we were going to do a series for PBS or the History Channel. So this is shot in 18 countries, 2 full-time animators. Dan Rubach is my producer, director, and he edits the thing and scores it. And these are done to a very, very high standard.
They are.
When you're shooting in 18 countries, I mean, these things are not cheap. We've spent more than $1 million on this 10-part series. And it's not your average YouTube stuff. And then we give it away for free. It's just good knowledge. And if you want to see the production quality, start with the last one, episode 10, and then go back and watch some of the others. But episodes 9 and 10, to me, I think that it's worth somebody making a bowl of popcorn and putting it on their big screen TV.
Got it. All right. Okay. Now, you mentioned a couple things there, forecasting and market correction. A lot of the people that I talk to are completely aligned with this. If this occurs 2021, it's hard to time these things. I don't ask for specifics, but, in that scenario, Mike, would you expect a similar response this time to the crash we had in March, where there's a flight to US dollars before cash gets redistributed to probably hard assets instead of financial assets?
There will be both, because each time it's going to be less and less a flight to US dollars, because when you talk about the US dollar, you're usually talking about US treasuries.
Sure.
And bonds are becoming, if you have a population that isn't as rich as it was the previous year, and our GDP contracted because of these lockdowns. So if you have a smaller tax base, the bonds become more and more suspect over the years, because the bonds rely on future taxation. This is part of, we live in a modern monetary system that is it's a feudal type of system. We are serfs because we have to work to replace stolen purchasing power that they do through taxation to pay the principal and the interest. We're paying off in the U.S. We've got 30-year bonds. So we're paying off the prosperity that we enjoyed under the first George Bush, back in the 90s. We just finished paying off the Ronald Reagan era. There is a market crash coming, but each time there is a flight to safety, you're going to see a higher percentage go toward gold, silver, and cryptos, and a smaller percentage going toward bonds, because bonds in a shrinking GDP, and the big brokerage firms can figure this out. It takes them a little longer. I'm surprised that it took them this long to start identifying cryptocurrencies and stuff. As we're starting to see big firms that are normally investing in only traditional financial assets starting to go into cryptocurrency. We're starting to see big pension funds announce that they're going to be purchasing gold. And this is just something that is a transition. And these guys are late, but they can still make the party. They're just not early for the party. You and I were early for this party, which is great. Gold and silver have been the number one behind cryptocurrencies, Bitcoin and such.
Yeah.
They've been the number one performing asset of this century. And people still think it's a lunatic fringe thing.
Right.
The average person. I remember back in 2001, 2002, I was trying to get people to take a look at gold. And they'd say, gold, that's been going down for 20 years. That's the worst investment you could make. And I'd say, exactly, it's been going down for 20 years. Don't you get that?
Right. Yeah.
Can't go down forever.
Now, have you been surprised though, Mike? Because 2021 got off to a crazy start. You know, there's been some chaos. I'm in Canada, but south of the border, there's been some events. Gold hasn't responded the way it typically does or historically does to chaos. And has that surprised you? Or what are your thoughts on that?
It surprises me, except the official price of gold is set by paper contracts, the gold futures. And during this period of time, for some reason, you know, the stock market was going up. So the big brokerage houses and so on, the really big investors weren't shaken up that much by all of the violence over the summer and the rioting and the shutdowns and everything else. What was happening during that period of time is the Federal Reserve created massive amounts of currency, and then they have to they have to try to make the population comfortable, get the population to believe that everything is all right. And to do that, for some reason, people think that the stock market is the economy these days. Right. It wasn't like that back in the 60s, 70s, 80s. But ever since the NASDAQ bubble of 2000, people have identified the stock market with the economy. And so what the Federal Reserve does, you know, under their normal open market operations, when they used to stimulate the economy by buying or selling financial assets, they would do that from the big brokerage houses that are the primary dealers that purchase bonds directly from the Treasury. When Ben Bernanke introduced quantitative easing, they started buying financial assets from non-bank entities. And the Federal Reserve doesn't create the dollars that you and I use. They only create dollars that circulate within the Federal Reserve system, only accounts at the Federal Reserve. So those dollars never leave the Federal Reserve. So when they buy something from a non-bank entity, they can't pay them. What they have to do is they pay their bank that has an account at the Federal Reserve, and then their bank creates a dollar for each. For you purchase $1 billion worth of bonds from some fund, a pension fund, a hedge fund, and then you pay their bank a Federal Reserve dollar. That dollar can't leave the Federal Reserve. It's in the bank's account at the Federal Reserve. The bank then creates a bank credit dollar and puts it in the account of that pension fund. So for every dollar of reserves that you see, there's actually $2 that got created. When they do this, there is this incredible correlation between the amount of base currency that the Federal Reserve creates and the stock market. During the years that Ben Bernanke was doing QE 1, 2, and 3, the correlation was 0.976. That means it was 97.6% the same. With a little bit of time delay, the stock market went up by the same percentage over the same period of time. Right. And so I'm sorry, I can't even remember what the question was. I went off on a tangent.
That's all good. No, I was wondering. Yeah, I mean, we started talking about your thoughts on what would occur in the next market crash. Okay. Because in March, you know, there was this flight.
Well, they won't be able to control the crash. All they can do is transfer wealth after the crash and make the richest people on the planet richer by stealing from the poor and the middle class.
Yeah. Okay. Now, this system, you know, it works as long as we're growing, right? A debt-based system works as long as there's growth. I wonder, you know, thinking back
to... And we've had contraction lately. You know, we're not back up to the levels where we were in February of 2020.
And I have to think that contraction is just getting started. If you look at so many small to medium businesses, yes, I mean, we're going to float the big corps, right? But it's restaurateurs, it's the hotel operators. They're operating 40 to 50% capacity. It's not profitable.
Right. And they're out of their backup capital at this point.
That's right. 100%.
They've been squeezed and squeezed and squeezed. And the ones that haven't gone out of business are hanging on by their fingernails.
Oh, yeah.
And here the government comes along with a pair of nail clippers.
Right.
This I'm sorry I'm laughing. I shouldn't be laughing, but it's you can see the predictability of this stuff and how, when you look at the CDC and so on, you see the death rates, the new data that they've published, and they've closed down the world economy, and they are going to be killing far more people through this collapse in GDP. There is a direct correlation to a country's prosperity, financial prosperity, with their lifespan. And so if you reduce everybody's lifespan in the country by making them poorer so that they have less access to quality health care, high quality food, and so on, then it's basically tantamount to committing murder. They are, they're going to end up doing the equivalent of killing more people than they're saving. And this is all to make some drug companies just uber wealthy. So,
okay. I want to cover a couple other things while I still have time. And, one thing that struck me about you and your business, Mike, is I think you were the first precious metals dealer to accept crypto as payment for metals. Yes. Is that true? Yeah. So what were you seeing? And I guess, how did those two asset classes play together for you right now?
Well, I see them playing on the same team. They're both safe haven financial assets, and they offer you a bunch of different attributes. Gold and silver are three-dimensional. They have weight. They can't vanish. They probably, Bitcoin started from zero. It had no value. Its first value was established in 2010 when 2 Papa John's pizzas were worth about $15 a piece, were traded for 10,000 Bitcoins. So that established a price of 1/3 of 1 penny. And then more and more people discover it. This is the first new financial asset in 400 years. There's, the first representation of a bond that we know of goes back to 2400 BC in Mesopotamia. Stocks were traded they started trading about 500 years ago, and a little over 400 years ago was the first common stock issued from the British East India Company. Real estate and commodities have existed forever. And so this is the first new financial asset class in 400 years. And it started from zero. Of course, the gains have been spectacular. They've been the biggest gains in all of history. There is no bull market that can compare it's Bitcoin right now from its initial price is up 1.2 billion%.
Right.
Billion.
Yeah.
Now, is it going to have gains like that again in the future? I doubt that very much. And now Christine Lagarde, former chairwoman of the IMF and now the head of the European Central Bank, has said that she's calling on governments to try and regulate Bitcoin. Well, they can't regulate Bitcoin, but what they can do is they can cut off the gateways to being able to convert Bitcoin to fiat currencies and make it very difficult for somebody because it's not being used in transactions. The big hope and dream in 2014, I went to a Bitcoin conference, Bitcoin on the Beltway in Washington, D.C. And I saw that this was a tool for freedom, that it was this awesome thing. And I invested in it. I told all my insiders that I was going to be putting a percentage of my portfolio in it. And I started accepting Bitcoin. I was first precious metals dealer to accept Bitcoin, Bitcoin Cash, Ethereum. And we're still the crypto friendly dealer. But what I do is I ride these things for their spectacular gains. And when they're going into a top, I convert some of the profits into precious metals because if there's a problem with the internet, then there's no cryptocurrencies. If there's a problem with power, there are no cryptocurrencies. And these are genuine risks that you have to plan for. And so to be on both sides of the fence here, to have investments in both is the safest thing that I think somebody can do.
Okay, I love it. Now I want to touch on some of the content you create because, you mentioned the $1 million budget on these videos. You've written A Guide to Investing in Gold and Silver, the best-selling gold and silver investment book of all time. And I know you've got a pipeline of books that you're working on. I mean, you're always writing.
Yeah.
So a few questions for you, Mike. Why do you do it? What's the mission? What's the driving force behind creating all this content? And you invest in it, right? Like you said, it's not just off the cuff. There's a lot of work put into this stuff. And how relevant is A Guide to Investing in Gold and Silver today versus when you published it?
It's actually more relevant today than when I published it. And what's interesting is I've watched all of my predictions come true. And about 7 out of, there's like 10 bases. There's some premises of the book. And I said some things that I thought were going to happen, the most likely scenarios. And about 7 out of the 10 have come true, and the rest of them have yet to come true, but I believe that they will. And so it's still very relevant. I would like to update it, but it is a tremendous amount of work. And, I'm dyslexic. Writing is an enormous amount of work for me. It's a very laborious task, and I really don't enjoy doing it. I have the concepts and I want to get them out there, but it is a tremendous amount of work. I've got another book that I've been working on that I'm hoping comes out, and it's the urgent book called Great Gold and Silver Rush of the 21st Century, because I do believe that this will be the greatest rush of all time. It's going to be global. It's never been global before. With the scale of what is about to happen is absolutely mind-boggling when you consider that gold went up about 25 times in the gold rush of the 70s. And silver went up about 35 times in the gold rush of the 70s. This time, and back then, about 2/3 of the world's population couldn't legally buy gold. You had no markets in China. Right. In the USSR, it was illegal to own gold. You could be, for hoarding gold in China, you could be put to death. India was just absolutely, I remember back in the 70s and 80s seeing Life magazine, this giant magazine that was meant for your coffee table, beautiful magazine, with pictures of after monsoons, there would be all of this starvation and the starvation that was going on in Africa. And now you've got billionaires in all these countries. And when the billionaires start trying to protect their wealth, billionaires all over the world start trying to protect their wealth with precious metals, you're going to see some fireworks. It's a complete, in the U.S. citizens couldn't participate until the first day of 1975. And for Australia, it wasn't until the first day of 1976. So you had the U.S. wasn't even part of the first half of that gold rush. It's going to be something breathtaking. And so that's that book. And while writing that, I was trying to describe the difference of price versus value, because people are just, when you measure things in US dollars or just one fiat currency, fiat currencies all lie to you. You cannot see what the true value of something is unless you measure, if you sell that thing, how much groceries, how much gasoline, what percentage of a house can you buy with it? How many shares of the Dow Jones Industrial Average could you buy with it, or the S&P 500? When you measure barrels of oil, tons of iron, bushels of wheat, when you measure it against other stuff, you'll discover that throughout the centuries, everything is trapped in this valuation channel, bouncing up and down. You measure your house in ounces of gold, you'll see this. And the trick is to sell something when it's up here and identify the things that are down here and buy them. And now you've escaped that thing I call a valuation channel, and you're gaining true wealth. And I did a tremendous amount of my researchers have done tremendous amounts of study on this, gathering data on prices of things going back, 400 years or more in some cases, to prove this. And so that's called Wealth Cycles. And that's a book that sort of, when when the great gold and silver rush of the 21st century frayed, it split into 2 books, and it just became too much work, and I put it off because there's a really important book. Great Gold and Silver Rush is an urgent book. Wealth Cycles is a very informative book, but the important book is Formula for Prosperity that I've actually been working on since 2011.
Wow.
And there's the formula I actually put out there in 2013. It was a early version of the formula, so there's some mistakes in it, but it's a literal formula where you can sort of there's some of the equations in it that are somewhat subjective. You have to pick a value, but when you have a lot of data, that becomes fairly easy to do.
Right.
When you're comparing it to other countries or other societies or other people. So this is a formula that can be applied to the world, to a country, to a state, a city, or an individual.
Okay. Mike, look, it's been awesome having you.
One last thing.
Yeah, what's up?
It's about where prosperity comes from and what extinguishes it. The goal for Hidden Secrets of Money has a mission of enlightening the world that maximum prosperity can only be achieved through individual freedom, free markets, and sound money. The goal for Formula for Prosperity is just to bring maximum prosperity for all of mankind.
I love it.
That's the reason I do it.
Yeah. Okay. Mike, look, it's been great catching up. I'm glad we did this. It's been a few years, so it's nice that we connected, get you back part of our audience, and
your viewers can download the Guide to Investing in Gold and Silver at my website, goldsilver.com. It's free.
Appreciate that, Mike. Thank you.
Okay. Thanks, Jay.